If you've searched for how to day trade or day trading for beginners and you're tired of endlessly scrolling through confusing and useless videos, then just stop, because you have finally landed on the video that will end your frustration and confusion forever. By the end of this video, you will have a complete blueprint to go from absolute beginner or even a losing trader to what I call a level 1 profitable trader. This means that you're going to have the skills and strategy to consistently earn between $30,000 and $50,000 per year. Now, just imagine for a second, how would your life change if your rent and all your basic expenses were completely covered from trading alone? Now, we all start at level 1, but the incredible thing about trading is that there's absolutely no ceiling to the amount of profits you can make. If, after mastering level 1, you're still hungry to reach level 2 and 3 and discover exactly how I personally achieved multiple 7-figure profit years, I have advanced trading that's going to be linked in the description below. But trust me on this, you can't get to level 2 and 3 until you've mastered the foundational skills of level 1 first, which we're going to cover step by step in today's video. And yes, you're definitely going to want to stick around to the end because I'm going to show you exclusive behind the scenes footage from the life of a level 3 trader. Yes, that's me. You'll get to see exactly how having multiple 7-figure trading years have built and shaped my life beyond my wildest dreams. You're going to get to see everything from my trading setup and the thought process while literally in 7-figure trades. You're also going to see the dream villa that I live here now in Bali that I personally built and designed myself. You're also going to see my future investments here, along with joining me on a tour of my restaurant and gym investments. And most importantly, you're also going to meet my girlfriend. So do yourself a favor right now, hit subscribe and click the watch later button, because you'll definitely want to revisit this course multiple times to fully master and ingrain these powerful trading principles. So let's get started. Grab your notebook, clear your distractions, and prepare to finally become a profitable trader. Now, before we dive deep into this educational content that's going to teach you how to make a lot of money trading, you have to make a very important decision, and that is, which broker are you going to trade on? And are you going to go with a funded trading account or a self-funded trading account? The reality is 75% of traders have accounts under $25,000, and that leads to most traders making crazy bets trying to turn this small amount of money into a large amount of money. And that typically just leads to them blowing up their account. And that is why if you have a small account, it's typically better to go with a funded trading account. Now, there's a company called Hydrafunding.io that I am affiliated with. And what it does is allows you to get access upwards of $1 million in trading capital to trade with without having to risk your own money. You can either choose forex, crypto, or futures. Now, I'm a predominantly forex and crypto trader, primarily crypto, because I believe that is where you can find the most gains. Now, typically how this would work is you take a funded trading challenge. But what is great is that Hydrafunding just launched instant challenges, where you never just launched instant funding, where you now no longer have to take any of these challenges that you see here. Typically in a challenge, you would have to take a 2-phase challenge and earn a 14% profit without first going into a 9% drawdown loss. And that would cost you $900 to get access to 100K in capital. So if you pass that challenge, you would instantly get access to 100K in capital and then get to keep 90% of those profits. But now with this brand new account that's not even listed here yet because it's launching in the next week, you can pay for an instant challenge where you no longer have to take this very difficult challenge to get access to capital. This startup fee is going to be a little bit more because you get direct access without having to take that challenge, but it is an absolute game changer. I believe the instant funding is also coming to forex and futures accounts as well. And if you want to get started with Hydrafunding, you can get 20% off of any of these plans using the coupon code FOOST20. Now, alternatively, you can also trade altcoins on some of the best no-KYC brokers. I highly recommend either Blofin or Phemex. You can decide. Now, there is going to be sign-up bonuses when you click my affiliate links below. What those are, I don't know. They are constantly changing them, but typically it's like a $500 sign-up bonus when you deposit money on these accounts. Now, what is the benefit of a no-KYC broker? Well, KYC means know your customer. Typically, most brokers require this, but the thing about crypto is most people want to remain anonymous, and these two brokers allow you to remain anonymous and still get access to deposit and withdrawal and trade altcoins. Now, these are both amazing brokers if you want to trade futures, of which is what I trade and what you're going to learn how to trade in this actual educational course. So if you want access to trade futures on a no KYC broker, either Blofin or Phemex are great opportunities. There are going to be links below to get started on these. Or if you want to go with a KYC route and you're not an American citizen, I highly recommend Bybit, of which there's also sign-up bonuses with my link below. So those are your 4 options. I highly suggest, if you're just getting started, to start with a funded trading account challenge. It's way less capital upfront to get access to a large amount of capital. And now that they have instant funding at Hydrafunding for crypto, That is an absolute game changer. Then you have no KYC options, Blofin and Phemex. And of course, if you want to be a little bit more traditional and KYC and you don't mind not being anonymous, I would suggest Bybit. There's going to be links to all those below. And again, and of course, use the coupon code FOOST20 to get 20% off any plan at Hydrafunding. Okay, guys, now let's get into the educational part of this, okay? Because in order to make money on these platforms, we have to know how to trade. So let's learn how to trade. Are you tired of getting stopped out on all your trades, feeling like you're always on the wrong side of the move? Well, you're not alone, because 98% of traders are failing because they are missing this key ingredient to profitable trading. And that, my friends, is the ability to read supply and demand properly by tracking the footprints of the largest institutions in the world and trading alongside them rather than against them. In today's video, I'm going to show you how me and thousands of my students use this secret framework to consistently be on the right side of the trade and maximize profits. We're going to cover everything from understanding the core principles of supply and demand to tracking the footprints of the largest institutions so we can predict their next move, and exactly how I personally set up my trades to make huge gains every week in the markets. All right, guys, welcome to the lab. We're going to go over this nice and juicy little diagram that I just made. And what we're going to talk about first is the money pool. And the money pool is where 98% of traders fail due to the misunderstanding of supply and demand. So when we're looking at the money pool, which is just the market in whole, the participants who are actually involved in this game that we're playing, well, there's institutional pro traders, there's retail pro traders, which is us, people like me and you who we are trying to become, and then there's sheep, of which who you might be right now, which is not a problem. I spent 3 years as a sheep when I first started trading in 2005, trying to figure out how the fuck to become one of these guys over here. So who makes the money in the money pool in just trading in general? Well, it's about 5% of traders. These are the wolves, who are the institutional pro traders and retail pro traders. The 95% of sheep are likely who you are right now. If you're watching this video, it's probably because you're having a misunderstanding of how to make money in trading. You've tried, you failed, you don't know what the fuck is going on, and you're really trying to figure this out. So there's not a problem to be in this category if that's where you are right now. And the good thing about that is you have so much upside potential, right? You're at rock bottom right now. And what we're trying to do is get you over here to the 5%. The problem with sheep is they're the ones that have no proper training to have the full understanding of how to make money. So when we look at the money pool, where does the profit actually come from? It all comes from the sheep. What you have to understand is without sheep in the market, wolves can't eat. Wolves can't make money because there's no profits to be had. If there was no sheep or just dumb money being flown into the market and deposited into the market, wolves would be competing with wolves. And that makes it much more difficult to actually profit. But with such an abundance of sheep continually depositing money into the markets, it makes it much easier for wolves to pull money out of the markets because there's so much lack of knowledge. And all it is this a gap in knowledge and a wealth transfer from sheep to wolf. So how exactly does this work? Well, there's about 2 to 5% of wolves in the market, 95 to 98% of sheep. Wolves get properly trained through mentorship or other programs, what have you. Then the sheep just FOMO in, try to account flip, try to turn $100 into $10,000 very, very quickly. They bet way too big, don't understand risk management, and start fantasizing about that Lambo lifestyle that you see in all these forex traders' Instagram pages without having any real logic of how to actually make that happen, right? So this is what happens. Both sides deposit money into the money pool. Now everyone is competing on the open market. And on the other side, after the trades are closed, wolves exit the market with profits taken from the sheep. The sheep exit with absolutely zero money, and they basically just donated money to the money pool. Now the sheep have multiple questions to ask right now. One is, do I just want to quit and call it a day? Like, this is bullshit. Nobody's really making money. All these forex guys are scammers, and they're just doing whatever, and I have no idea how to do that. Okay, so they can quit. Or they can continue to be sheep and it's like, you know what, maybe I just was doing it a little bit wrong. I'll try again and FOMO in and just bet it big again and try to just flip my account. Or they can decide to get mentorship and then try to get over into the category of the 2 to 5% of wolves, get properly trained, deposit money back in the money pool. And this cycle just repeats itself over and over again, where the wolves continually siphon money out of the market. And all that's really happening here is just a wealth transfer from a knowledge gap. The sheep have no idea what's going on. They're betting big. They're risking everything, trying to turn a small amount of money into a large amount of money. And the wolves are just like, okay, snap, 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 snap. Thank you for your deposit. I will take that. And that's all that's happening. It's just a wealth transfer. And all it is just a lack of knowledge. Okay, NOLEDGE, however you want to spell that. Just a lack of knowledge. It's a knowledge gap. So sheep are clearly buying and selling at the wrong levels and the wolves are buying and selling at the right levels. So that's exactly what we're going to talk about, is how do you become a wolf and buy at the right levels instead of the wrong levels, okay? So let's just get into kind of the basics of what exactly is supply and demand when we're actually talking about this, okay? So supply and demand is simply just zones of balance or imbalance of price, where balance equals stability between buyers and sellers, and imbalance is aggressive buying or selling out of that stability. So when we look at this, we can draw these zones of an area of balance where we have a lot of these candles, which are called like doji candles or hammer candles or shooting star candles. They're basically candles with small bodies and wicks on either side. And price is basically just kind of flatlining. Rather than seeing aggressive selling like these large candles, that we're seeing sideways where the buyers and sellers are actually neutral. Imbalance is when we see a massive aggressive buying to the upside or massive aggressive selling to the downside outside of these zones. We're essentially breaking out or breaking down outside of the areas of balance. Now, that zone can be considered an area of supply or demand. In the area of demand down here, we know it's an area of demand because it would take a large accumulation of buyers all at once to push price out of this level. And we know that the biggest institutions in the world, especially in the world of like forex, they're the only ones with enough buying pressure to cause a candle that powerful. So we know that at this zone where price previously was balanced and then all of a sudden became imbalanced as price rapidly fired out of that zone, we know that it took a lot of money and a lot of capital for that to happen. And it's the same thing that goes on the downside for selling. We know that to see a big candle like this, it took a huge amount of buyers to make that happen. Now we know that this is an area where there's going to be more sellers if price actually returns in that zone. We know that this area is going to be an area where there's going to be a lot of buyers if price returns back into that zone. Retail traders cannot push price out of balance. Only institutions can. And that's what we call footprints, okay? So what exactly is our goal? Well, it's to track the footprints of the largest players in the game so we can follow in their footsteps, since we know they will have the most impact on price. So as we can see, when we have areas of balance, we know that these are footprints, but they only become footprints if we see a large boost or a large aggressive candle outside of that area. And that's what we would call a footprint, okay? Because even though they push price outside of that zone, it's very difficult to get all their orders filled at once. So we can assume that they still have a lot of buy orders down here if price returns, okay? And we can also assume that if this price goes into this zone of balance and then out of balance, we can assume that they have a lot of orders left to be unfilled at that level, okay? So if we look at what happens here, this would be an example of price returning to that level, tapping into it, and then explosively coming out of it because, well, there's multiple things that happen here. One, we know that the institutions still had a lot of buy orders there. And also, retail can also come in and help push price because if you understand supply and demand, you would now know that this is a footprint. So now, while we have no idea why they did what they did at this first zone, we now know that they have a footprint there that we can track. And now retail traders who properly are trained and understand supply and demand will have buy orders in this zone, and then we can all push this thing back up, and that's where we actually make the profit. We almost rarely never make profit on this push right here because we don't know. Unless there was another footprint back here that we could understand, then we have no idea why price came out of this zone. But once we have a footprint, we can understand that price will possibly have a higher probability of bouncing off that level due to the fact that it used to be an area of balance, and then there was huge aggressive moves outside of that area, okay? This is just an example of the US dollar, okay? We can see an area of balance here. This is an area of balance up here. And once price returned to that area, what happened? It hovered in that area for a little bit, but then skyrocketed outside of it. We can see price coming rapidly outside of it. Once price returned into this footprint up here, price rapidly declined outside of it. Now, price actually went and dropped to new lows below this level, okay? And then created a new footprint down here, of which then created a new footprint up here. Now, when price returned back into this zone, what happened? Skyrocketed out of it. What happened when price returned into this footprint? Came all the way back down. When it came back and retested into this zone, what is happening now? Price is rallying outside of that zone, okay? So this is just an example of how to read the footprints of the largest institutions Why this happened here, we don't know. But now that they have that footprint, we can then trade the secondary return into these zones. So essentially, again, what we're trying to do here, guys, the goal is to buy from stupid traders and sell to stupid traders. In order to dramatically increase your odds, you should never be executing trades in what I would call the gray zone. We only want to be buying in the blue zone or green zone. We only want to be selling in the red zone. In the gray zone, this is nothing. We don't want to be doing anything in there. So blue zones would be areas of demand. Red zones is areas of supply, okay? As we can clearly see in these zones. Now, idiots are going to be buying in this level saying, oh man, the dollar's pumping. It's time to, buy into this momentum for this move right here. Wrong. We're in an area of supply, an area where the pros are going to be selling, and then price continues to drop rapidly, okay? Down here, people who bought up here into the momentum or here, they're getting down here and they're panic selling down at these levels where pros are buying, okay? So we need to be buying from idiots who are selling down here for this push right here for the next move outside of that zone. Brief interruption here, guys. Did you know that 75% of traders have accounts under $25,000? This creates a huge problem because even if you double that account in a year, which is almost impossible, you're still only making $25,000. Introducing Hydrafunding, where you can potentially get access up to $500,000 in capital. All you have to do, guys, is sign up for a challenge account, which is going to give you potentially access up to $500,000. And if you earn a 10% profit in this demo account without going into a 5% loss overall or a 4% loss in a day, you will then pass their evaluation phase and yes, get access to an account with the selected size account. And now, instead of trying to double a $10,000 account, you could potentially earn only 10% on a $100,000 account to earn the same level of profits. And the benefits of this are huge. Rather than risking your entire $10,000 on one account, you can use just $1,000 to potentially get access to $100,000 in capital. You can trade crypto, forex, stocks, CFTs, gold, oil, everything under the sun, all on MT4 and MT5. If you're interested, if you have an account under $25,000, like 75% of traders out there, you're not going to make any money with that account because it's too small. Get access to pro level funding and pro level capital with Hydrafunding. Link's going to be below. So again, this is just the weekly chart of that same US dollar that we're looking at right now, okay? And this is actually a trade that we just recently took. Price was coming into this zone, but there's also this level down here just below it, of which we'll talk about. And then price is rapidly pushed outside of that. So that is a huge area of imbalance now that price actually thrusted outside of this candle. And now, what does that mean? This is now a new footprint. For the next time price to return into this zone right here, that is going to be a buy signal, right? So if price does return into this zone, this is an area to be buying for another potential leg up on the US dollar, okay? But now that price had already returned into this zone is bouncing, we have multiple areas here that could be considered as supply. We have this one here, which it already tapped into. And then we also have this one up here, which is the next level. You can even draw it to these two and combine it, okay? So now that we know that we got in long down here, our two profit targets are essentially these next two levels of supply, of which we can then short into as well. And we know that if price comes back all the way down into this level, that would be considered an area of interest to take our profits. If we do actually sell short into these levels, our profit targets would be down here when it returns into this. And then again, that's another buy signal down in this level. So it just continually goes back and forth between supply and demand. Now, all these areas in between, right? So we have supply here, we have demand up here, and then in the middle, what is all this? This is gray zone. There's no point in doing anything. A lot of traders are selling down here and panic selling, or they're FOMO buying at the top, and that's completely wrong. And then, or they chase down in the gray zone, which that ruins their risk reward. So we never want to be trading in between supply and demand unless we're just locking in some profits along the way because we got short up here or we long down here. Now, if you want to take in profits, even if you long down here and then you wanted to take profit here at this high, just in case that was the top, that's fine. You can take profits during the gray zone and then take profits even higher up here. But we never want to be entering new trades based on a supply and demand zone of the actual time frame that we're doing within the gray zone. That means you're FOMOing in and chasing, and now your risk reward is pretty screwed. Okay, so we want to be buying from idiots and we want to be selling to idiots. That is basically the principle of what we're trying to do with supply and demand. All right, guys, let's talk about the types of candles that we're going to be looking for in supply and demand, just to really get down to the nitty gritty of what we're looking for. How to identify candles that make up supply and demand zones. One, we need to look for the balanced candles. This is where buyers and sellers are neutral. Typically, they're going to be either dojis or shooting stars. Essentially, a doji is just a body like this and wicks on each side, just like this right here. Or there's a hammer candle, which is this right here, or a shooting star candle, which is the exact opposite, which is a bearish signal like that. This is a bullish candle. This is a bearish candle. It doesn't really matter. All we're doing is looking for candles where the body is about less than 50% the size of the entire range. That means it's going to be a very small body with wicks on either side. And that's just showing neutrality between buyers and sellers. And if we see a range of those together, that's now an area of supply and demand. Then we have the candles that are imbalanced, where these are aggressive buyers and sellers that are pushing outside of those zones. Typically, we want to see big white candles or big black candles, depending on whatever your color scheme or schematic is on your actual chart, okay? And those are going to be the candles that are going to signal that we do, in fact, have an area of supply or demand. So let's just take a look at USD JPY here and look for some decent areas of supply and demand. First and foremost, we can see just up in this area right here, this is clearly going to be an area of supply. We have a lot of different neutral candles, right? Doji, 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 and then a huge aggressive selling candle out. So we can assume that if price returns back up into this level, this is the daily chart, that there's going to be some resistance there and a lot of more sellers that are going to continually sell if price returns. But we can also see this area right here, right in the middle of a rally or a decline. Okay, so this is also an area of supply. So we can assume that if price returns into this level of this zone, that's going to be an area where there's still sellers, institutional sellers that still have yet to fill their orders, and they're going to dump this thing off that price zone. And we can see that there's areas of balance with these candles and then huge explosive selling candles outside of that. So we definitely want to see those huge explosive candles. There's different examples where we have this, an area of imbalance right here, or we have an area of balance right here, a lot of small candles. But the problem with this area, right, is that it's not an explosive candle outside of that zone. So what happened when price returned? Price is shredded right through it, okay? So it has to be an explosive candle pushing out of that zone to make it significant, because then we know institutional buying pressure or selling pressure was sitting at that zone that influenced price. Whereas this, it just kind of slowly dragged out of that. And then that return to that just shredded right through it, okay? So let's talk about the different types of zones that are actually formed on supply and demand. First and foremost, there's the rally-based rally, or RBR. That is where we have explosive candles to the upside and then sideways candles that are then balanced, and then an imbalanced candle outside of that zone. That's a rally-base rally. Then we have the drop-based rally. We have big aggressive selling candles coming in, and then we have a balanced zone that happens with some balanced candles, and then aggressive buying pressure on the other side, and then that's a reversal. That's a drop-based rally, or DBR. Then we have the drop-based rally, where we have a huge drop in aggressive selling, followed by an area of balance, and then a huge selling pressure candle outside of that level, and that's a drop-based drop, or DBD. The last one is we have a rally-based drop, which is the exact opposite of the drop-based rally. We have a huge rally with aggressive buying. Then we have an area of balance and smaller candles, and then huge aggressive selling pressure outside of it, and that is a rally base drop. So just looking at some of these examples here, again on USD JPY, this is a rally base drop. So that would be the rally base drop example. Then there's a drop base drop example. We have the drop, then we have the base here that we can drop, right? So this is also a drop base drop, then a drop base drop. So these are both areas which are now going to be considered supply zones if price returns into those levels. On the opposite side of that, we do have a rally base here and then a rally out of that. It was short-lived, but that's basically the same thing, rally-based rally. But now in returning into that, it just wasn't getting any momentum. But we can see that the lead-in trend was also extremely bearish. Now, it wasn't until about here that price actually started reversing off those levels, okay? And then we have a drop base rally here, which is just one candle outside of it. We can see momentarily price did return on this one wick into that zone and then rallied back outside of it, and now it's rallying back up. So those are the four areas of supply zones, supply and demand zones that we want to be looking for. The rally-based rally, drop-based rally, drop-based drop, and rally-based drop. All right, let's talk also about the zone requirements, of which we did touch base on there briefly. Is once we have a zone, we must have aggressive buying or selling outside of that zone. Here's an example of what could be a drop-based rally. This is a drop-based rally that looks good because we do have a huge exit candle and aggressive buying pressure. But if we just have like a zone like this and just kind of like mediocre candles pushing out of it, that means that it's not institutional, okay? That doesn't mean really much at all. This could just be a slow, mediocre, nobody's really that interested. It's just price did slightly shift. What we want to see is big, juicy candles like this because that means it's institutions loading up on this area and they love to buy in this zone, okay? That means if price returns into this zone, they still have orders open and we can have a much higher probability that price will rally out of it. But if it's just a slow, mediocre move outside of that zone, a return into this zone doesn't really mean much because there isn't institutional buy orders lined up here that will then support and defend this price. Okay, so that is why we must have these huge exit candles outside of that zone, because if we don't, there's not institutional backing, and that basically means it's just not a footprint and not a valid zone, and it's much more likely to just shred right through that level. So if you're buying into this zone, you're likely just going to take a loss rather than seeing something like this where price exits strongly outside of that zone. All right, guys, next we need to talk about drawing the zone. Whether you want a high reward or a low reward, it's really up to you, and you got to test. You're probably going to do both. I use both, just depends on how I'm feeling about the chart. So we can either enter at the body of the candle or enter at the wick. And basically what this does is kind of give you a framework for how to make your entries based on if price was going to return in that level, right? That's really what we're trying to do, is figure out what are we going to do if price does return to this zone. Because obviously there is the zone that we draw from the top to the bottom. But if you want to increase the RR, aka risk reward of this trade, you can enter at the body, okay? This is gonna give you more profits if that entry does get filled. Now, you can enter at the wick, which is gonna give you a higher probability of getting filled, but lower return on the successful trade. You can enter right here at the top of the highest wick of the actual base of that area of balance, okay? So your entry would be here, your stop would be down here below the actual low of the range. Here, your entry would be here, and your stop would be somewhere down here below the low of the range. So you can see, if this was the same exact trade, down here, you would be entering slightly lower. So that means the distance between your stop and entry is going to be smaller, which increases the RR. The distance between your entry and your stop is going to be much bigger. That means you have a much wider zone here, which not only increases the probability of getting filled, but you're going to have a lower return because the distance between your entry and stop is wider. Okay, but sometimes price maybe only comes in to like right here and then bounces out of it and never actually gets into this zone. This happens quite a bit. Whereas in this zone, you do have a higher reward, but sometimes price maybe only just dips slightly into that zone and then bounces out, and you never even get a trade at all, right? So you have to decide, which one do you want? Do you want a higher probability of actually being part of this trade, or do you want to lower the probability of being part of this trade, but if you do, you get a higher return? So let me just show you on the chart of what that would actually look like and why this actually works this way. All right, so let's just take a look at NZD USD. This is US dollar daily chart here, and just taking a look at an example of how that might work where your risk reward might actually be a little bit higher. If we look at this, we have an area of a drop base rally, okay? Big explosive candles outside of that, so we know that institutions probably have a footprint right here that we could then potentially trade for a bounce. So we can enter this right here, right? If we draw the top of the wick to the low of the range here, and we open up an actual long position here, stop, let's say, down below it. Let's say the stop is at the low right there. We can draw this across. We can see the RR here, let's say, and then we wanted to trade this all the way up into this zone. That would give us a 5.32 risk reward ratio. But what if we wanted to, make this a little bit higher reward in our favor, and rather than entering at the top of the wick, we want to enter right here instead. Okay, so we went from a 5.32 risk reward ratio, meaning that for how much we're risking, we're going to earn 5.32 times more that. But if we make this a little bit more in our favor and actually go to the body of the candle, look at this. This can now turn into almost double that, or like 50% more, to a 7.3. We'll now earn 7 times more rather than 5 times more on our RR, simply by just adding a little bit of push here, because that reduces the distance between our entry to stop. So the smaller distance between you have your entry and stop, the higher RR the trade is going to be, but the less likely you're going to get filled on that position, okay? Because price might only dip into that level. So you're going to take less trades. You guys are going to miss. But if you do hit those trades, that's where you see the huge RRs. Because you can see that just 2x'd the amount of money that you could be potentially making. Where before you're going to make 5 times your money, now you could potentially make 7 times the amount of money that you're actually risking per trade. So that is just a decision that you have to make, whether or not you want to increase the probability of actually just being part of this trade or actually just going for that big win, because that's where those big juicy gains can come into play. All right, guys, next up, let's talk about some confluences, things that make these footprints more reliable. First and foremost, if you see a fair value gap on the actual imbalance exit candle, that makes it a lot more clear that this is a very powerful actual candle out of that zone, okay? A fair value gap is essentially just a space of uncharted territory on a candle between the top highest range of the wick prior to the candle and the lowest range of the candle following that. And basically, if you have any sort of gap in between this high here and this low here, that is what we call a fair value gap. This is like part of like ICT, SMC bullshit, but identifying that basically ensures that that is a powerful candle outside of that zone, and that increases the odds of a move back into that level to be a powerful institutional zone to then trade this zone for the exit out of that zone. The next one is what we would call a flip zone. This is an area where there was a previous peak. This could potentially be a supply zone up in that zone right there, like previously, of which then price came into that zone, created an area of supply at that zone, but then just shredded right through it. Basically a rally, base, rally out of that zone. So now we have a flip zone, because this could be drawn as an area of now support and a lot more increased demand, because we have demand here and we had this demand here at this flip zone where price actually flipped back over that level. So now a return into this zone that we can draw across here is now going to be a higher increased probability of that becoming an institutional zone and a nice juicy bounce off that level. And this is a zone that we can definitely trade and take advantage of. The next thing that we got to discuss is the freshness of the zone, okay? Because a lot of times you're going to see this over and over again where we do have a zone. This would be a drop-based rally, huge candle. Outside of that, we do have a fair value gap, FVG, outside of that zone. So that is even increasing the probability. Now there is a first test of that zone, and we can see price exploded off that level, which made this a nice institutional zone. But if price comes back into that zone, this is no longer fresh, because it's now just retesting this area, okay? And all that means is that the previous orders, because the logic behind these moves is that this is institutions buying this zone. And obviously, and the likelihood of them filling all of their orders is not very likely. So they still have orders just sitting and waiting down here for price to return to then rebuy. But if price returns again, they're going to have less orders this time on this time than this time, because they already got filled. So now the likelihood of this turning into another huge bounce is becoming decreasingly less, because there's less demand in this zone. It was already pushed into this level once, and now there's less orders to buy at this time, which increases the probability it just shreds through that zone and does not actually bounce. So you want to have a fresh zone, not being tested multiple times. It's typically the first test is the time that's going to work the best. The next thing we want to see here, guys, which increases the probability, and this is where a lot of people screw up, is when we see stacked zones, right? Where you see like a level here and then a level here, but you're seeing price return to it. On this one, you're like, wait a second, which one do I fucking do? They're literally right next to each other. Okay, so typically in this situation, you almost always want to take the lower level, okay? Because these are two levels that are stacked on top of each other. And a lot of times this level is going to get broken down to the downside, and this level is going to be the push. There are going to be scenarios where price just comes down into this level only and just shreds out of that. And you're like, well, I waited for this one and it never fucking came. That's just trading, all right? It's not going to be perfect. But more often than not, this is where most traders screw up, is they see this and they're like, all right, I'm going to take this level because I'm going to FOMO in, and I don't want to have the patience to go down here, and I don't want to miss it in case it does bounce here. So I'm going to take this one. And rather than taking this one, they get stopped out right here in this zone where they should be buying, okay? You don't want to get stopped out in a zone that you should be buying, okay? So when you see levels like this stacked up on top of each other, that is where you want to take the wider range on top of both, from the top of the candle to the bottom of the candle with the stop down here, that is where you want to see the actual move, not on this first level. So when you see it stacked like this, you want to take the lower level almost always. All right, guys. So I'm actually taking a 500K Hydrafunding challenge account at the moment. You can see the equity is 533,000. This has to get to 550,000 for me to pass. In this particular challenge, we're a little over halfway there. You can see I'm up 24,000 in unrealized profits, already locked in gains on all these positions. So I just want to show you guys exactly how I'm making money with these trades, kind of using the same exact principles that we just walked through in this entire mini course right now. So I have something called the Quantum Cipher Report. This is what I send out to the Wolfpack every Monday, basically giving you the top trade setups for not only Forex, but also a lot of trades in crypto as well, and futures and Forex. So we're going to talk about some of these trades that we're actually long right now or short that were live on the actual Hydrafunding $500,000 challenge account, and just give you an example of how and why I got in these trades. So first and foremost, we were looking at the US dollar. And when you're looking at like Euro USD, NZD USD, USD JPY, anything with a USD pair in it, you're basically essentially trading the US dollar. So the best thing you could be doing is analyzing the US dollar. And we can see here, looking at the US dollar, first and foremost, we can go to the weekly chart and look for some significant zones that we have here. So let's just look at this, okay? For one, we have this weekly zone right here. And then we also have on the weekly, this zone right here. And you'll see why this is significant. Even though this doesn't have an area on the weekly chart of indecision or candles that are a little bit more balanced, as this just bounced, dropped, and then instantly bounced with a relatively strong candle. This is a much more clear area of demand to potentially be buying into. But we'll see when we break this down to now the daily chart of what that looks like. And we'll talk about something that we just learned based on this stacked example right here, okay? So when you look at this right here on the US dollar, we can see this zone that we can draw, that was the weekly. We can even break this down a little bit or cleaner on the daily. We have the top of the wick here down to the bottom of the wick. That is the demand zone. And if we just use that zone right there, that could be troublesome, okay? Because we can draw this across. Say if we were looking to trade this right there, and we can see that if you did enter at the top of the wick here, and then the bottom here, and then you have a stop somewhere down below it, right? You could have easily been stopped out at the bottom right there. And that would have been extremely frustrating to be stopped out of a beautiful bounce right out of that zone. And how you mitigate that is, okay, is there a level below it that is stacked? And there is. We can see here on the daily chart, right? We have the top of the wick of the candle, the bottom of the wick of the candle, then the explosive candle out. And we can draw this across here. And now we can see how that is a much safer zone that we should be trading. Where now, rather than using this zone of where you could be getting stopped out down here, where you should be buying based on this stacked level, now your entry essentially would be here, stop down here, and now you're taking advantage of this whole move. Rather than if you stacked it, if you did this one on this zone, your entry would be here, stop down here, and it's very likely you could have gotten stopped down on that trade and then watch this thing just absolutely shred without you. So it's almost in all cases, you want to take the lower level below it because that is where there's going to be a stronger area of demand and probably price being manipulated to stop everyone out below there and then actually take the move up. Okay, so I didn't trade the US dollar because we don't have the US dollar pair, DXY at Hydrafunding. But what you can do is trade other pairs outside of that are also a USD based pair. So if we look at Euro USD, of which you can see we did short here. Right, we're short the US or Euro USD at this level, coming back down. I already locked in profits here. I locked in profits here. Now I have moved my SL to here, and I would like to see price come all the way back down into here because you can see that this is a demand zone, huge explosive candle outside of it, and you can see that price even has bounced off this level, right? Price came right into that zone and started to bounce slightly, but there's also this zone here of imbalance and explosive out of it. So I would like to take my profits down there. You could also say that's kind of a stacked level, right? Where we have this level and then just below it, another level. And then I actually want to go long on this down in that zone as well after I shorted that. So that is Euro USD, currently short still, but let's just take a look at the chart of how that kind of came into fruition. If we want to look at the weekly chart here. This was also a similar situation where we had this zone right here on the weekly, right? But if you took that first level on the weekly, what's going to happen? You're likely going to get stopped down because just above it is another level. Same exact thing as the US dollar. And you can see almost how this is an exact mirror of the US dollar because this is the Euro USD, but the US dollar also had this candle on the weekly chart at this zone, but then just above it, or actually below it, because that was a long position, there was this zone. Now, the weekly is a little bit less clear, but when we break this down to a daily chart, we can see that we can draw this zone here with price like this. But then if we take this one, the low of the wick to the high of the wick here, and then draw that across and see how that actually played out, we can see that that was actually the perfect entry on here. Okay, now I didn't catch this move, but I caught it on the secondary test into that zone and then caught this move to the downside. As you can see, the entry here was right about here. After it dumped down to here, then retesting this zone, I got in right here. It did do a little bit of a retest before finally coming back down. But you can see this level right here had that push right above it. Again, you don't want to get stopped out of a level when there's a level right above it where you should be actually selling. And so that is the stacked level that we can see coming into fruition, and then finally the move to the downside. And now when you're looking for TPs, because we can do this, TPs is in take profits, what are the actual zones that we're looking at here? We can see here, here's a zone, but there's also a zone just below it. So you could even take this whole zone, like even take the closing of the candle of this one and then the lower of the candle. Now this is going to be an area where potentially going to be buying because the zone here, there is even a zone here, but there's already two right here. So this is a third zone down here. And in this situation, once you have two, that's the kind of initial zone that you want to be watching. So for me on this short, the ideal opportunity to be locking in profits is right in this zone. But I don't know that for sure. So I want to look for areas to be locking in profits along the way. So even if we look at the daily chart here, this was a zone that I wanted to be taking a profit because you can see this was also a flip zone, right? Breakout here, come back down, retest, then rip. I took profits here. I took profits here. I want to take profits right here. And then I definitely want to take profits down here and then even go long, of which you can see I do have an order to take my profit finally down here at this zone. And I also have an order to go long at this zone for the secondary push outside of that zone. So all I'm doing is just flipping back and forth between supply and demand zones using these exact same principles. So that was Euro USD. What's another one you want to look at? USD JPY, which is also an example here of which we do have this zone right here. If we look at the weekly chart, actually get rid of all these zones. You can see USD JPY. You can see I did actually get stopped out right here on this push because I didn't actually cover myself enough on this, but I did get back in, and now we're shredding this thing all the way up here. Locked in profits here, locked in profits here, locked in profits here, and now I'm still long, just continually moving my SL up, my stop loss, as we push into that zone. Currently still up about 4,000, but I've already locked in a significant amount of profits on this trade. So let's just take a look at the analysis of USD JPY. If we look at the weekly chart here, we have this zone right here, okay? Boom. Huge explosive candle outside of that move. Stop slightly below it, of which I was a little bit too slightly below that zone, right? And I did get stopped out on the weekly chart. So that's weekly demand. You can see price came right into that zone and has just shredded outside of it. If we break this down to the daily chart, we can either do something like this, and that would even increase your probability. Or if you wanted to go like here, right? The body of the candle to the low of the candle. Now that is going to increase your risk reward on this to earn a higher profit. But you can see that this is likely to get stopped out if you do it too much. But if you take a wider zone, like on the weekly chart here, and consider this your zone, now that you have this wider zone, that induces that your stop should be significantly lower below that zone, right? Because you want maybe like about a quarter of your zone, 30 to 40% of your zone. That's how about how low you should put your stop below it. So if your zone is this small, right, then 30 or 40% of that zone is going to be right here. But if you're taking a wider version of that level, like on the weekly chart, your stop is going to be lower, okay? And that increases the probability of you not getting stopped out, right? When you're going for big R or those like 10-to-1 risk reward ratios, that dramatically increases the probability of, one, you not even taking the trade, or two, if you do take the trade, you just get stopped out. So it's almost always better to take a wider range with a wider stop. That ensures you have more wins. You're going to have a higher winning probability, but you're not going to see those huge 10-to-1 risk reward ratios. You're going to see more like 3-to-1 to 5-to-1 risk reward ratios. Okay. So we can see what happened here. I did get stopped down in that first trade, but then take a look at this. We can see price action, and I'll show you the before and after screenshots because I have all the before and after screenshots because I give out the alerts for the setups before they actually come into fruition. So after this push came back down in here, which was also at this level that was still basically covered by the weekly zone, we can see I said, hey guys, if this dumps back into that level, I want to buy. And it happened the exact second day after that candle came into that zone and then it's absolutely shredded out. So you can see that actually executing on the chart. Me initially getting stopped out here, enter here, stopped out here, but then on that secondary candle, I said, hey guys, if this dumps back into this new demand zone that just got created, because that was the imbalance candle outside of this drop-based rally, price came into that zone briefly, then shredded outside of it, and we can see then price has absolutely crushed it outside of that zone. We can see the actual report that I sent out on the Quantum Cipher here. On this live trade, I said, okay, we're going long. We're going to be getting in at this price. And this was the chart that was actually sent out. I said, hey guys, if this price dumps back into this zone, because I did get stopped out below that weekly zone right here, I will get in right here at the top of the wick of the candle for the next move up to this zone. We can see that playing out right here as we speak into that zone. And now I'm still this long, right? I will stay long as long as it just holds up above the next demand zones, and it is currently right now. And I also just put out an alert today on the QCR for setting up that I want to get short USD JPY. If it comes into this weekly area and daily zone, we can see this is a drop, base drop. If price comes into that zone, I want to get short in that zone because I think we're now kind of bearish on USD JPY after this massive drop in selling pressure. And then I want to catch the next leg down. So you can see I give out all these setups way in advance before they actually come into fruition. Same with NZD USD. This was the chart at the time. I said, hey guys, if we're going to come into this zone of weekly supply, we have the level, another stacked level. I just took the whole range to ensure that I wasn't going to get stopped out. If we look at NZD USD now, we can see NZD USD absolutely dumped off that level. Okay. And now it's coming back down closer to my TP and potentially even looking for a long on that trade. We can actually see that on GUI trade. The entry on the short here, all the way down. I've been locking in gains here, and I'd like to lock in gains again here, and I'll just continually moving my stop loss down on all these trades as we push into my levels. There's also USD CHF, which is a similar pattern. Price came into weekly demand here, dumped into it. I took partial take profit at this zone because that is a rally base drop, right, on the weekly chart. But ideally, this could push all the way back up into the significant supply level. That's the weekly chart. If we look at the daily chart here, we can see this zone here on the daily. Price came down, tapped into it. It consolidated for weeks before it finally actually rallied out. Now, I took about 50% profit as it came into this zone here, but now I'm just riding this thing out to see if it actually pumps up. So that's all we're doing when we're trading supply and demand, is just looking for these zones of influence and looking for actual big levels where we can identify the footprints of institutions, because that gives us a lot better understanding of where is price actually going to reverse, right? And that's all we're trying to do. We're trying to stay away from what? The gray zones in here, right? This is the gray zone, okay? We don't want to be involved in the gray zone unless we're taking profits. What we want to do is have the patience, which can take months if we're swing trading like me, before things come into those levels. But when we do catch those levels, that is when you capture these insanely massive moves to the upside and insane massive moves to the downside. But anyways, guys, that is my explanation of supply and demand. If you want to join the Wolf Pack, get the Quantum Cipher Report every Monday for crypto, forex, and futures. Again, all these trades, I give you what's happening way ahead of time before price actually enters into these zones and then actually rips outside of them. Okay, so they're not alerts where you're scrambling to figure out what is he even talking about. Can I even follow? Is it too late? Okay, I give you the alerts in the Quantum Cipher Report way before it happens. And also, we are absolutely crushing it on crypto right now as well. So if you want to trade crypto, you have to be a multi-asset trader. That is where you make big, big gains. Forex is awesome a lot of the time, but if you're not taking advantage of crypto bull runs as well, you're missing out on like insane gains, because that is where you can truly make some big money. And also these supply and demand principles also apply to crypto as well. And also, guys, if you do want to get funded and take challenges like me, I'm taking the $500,000 Forex challenge right now on Hydrafunding. We also have crypto challenges as well that we just launched. With Forex, you can get up to $1 million in capital. With crypto, you can get up to $200,000 in capital. So I'm excited to pass the challenge. I'm almost there, especially if the latest trades from the QCR come into fruition. I think that'll push me past the 50K profit mark, and then we'll start getting some payouts on that actual account. But anyways, thanks for tuning in. We got a lot more coming, so definitely subscribe, and I'll see you guys in the next one. Basic technical analysis principles are probably the biggest BS lie being told today.
What do hedge funds think of technical analysis?
Some of them love it and some of them hate it.
And it's being told to you by a bunch of people.
Everybody else is looking at the same charts and the same fundamentals,
Who are manipulating you into thinking you can just draw a bunch of squiggly little basic lines and start making money trading.
For me, in terms of my ability to make a decision, I prefer technical analysis.
The reality is the smart money is using a different strategy to actually make money. What you have to understand is that trading is nothing more than a wealth transfer from millions of people who are basic and don't understand what's going on, that deposit money on an account. All that's happening is that deposit is then ending up in the account of a small group of people that I call the wolves. There's about 98% failure rate in the market and only about 2% of people who collect all the money. So if you want to become part of that 2% who is collecting money, well, then I suggest that you hit the subscribe button, turn on the notification bell, and get out your notes, because I'm going to drop some dark truths about technical analysis and how this game is actually working. So first of all, what exactly is technical analysis? It's basically just the study of chart patterns. What you can do is go back and look at the history of all charts, all price action that's happening on any asset, and you can see exactly what happened in the past. And all you're trying to do with technical analysis is look for patterns that have consistently repeated themselves. And by identifying those patterns, if you see that same pattern forming up again, you can now create a game plan and a trade strategy based on the fact that you know that in the past, this similar situation played out in a certain way. Now you can anticipate what might happen again and hopefully make a little bit of money off it without losing too much. That, in a nutshell, is how technical analysis works and what its theory is. And these theories of technical analysis have been around for hundreds of years. And in fact, it started in the 17th century when the Dutch East India Company were the first people to start plotting the price of stocks on a chart. And that was the origination of looking at an actual stock chart. In the 18th century, this is when candlestick patterns were introduced by the Japanese rice traders, who were able to identify patterns just by looking at some candlesticks and understanding the open and close and high and low, which we now see every day on candlestick charts in basically every chart that you look at. And then in the late 18th century, Charles Dow created what is now known as the Dow Jones Industrial Average. All it was a compilation of stocks which enabled him to identify the macro trend of the actual market, which consisted of three trends. first was the primary, which was just the long-term trend that you could identify, then the secondary, which was the pullback to the actual long-term trend, and then the minor trends, which was just a bunch of fluctuations in between. And then in the 1970s and 80s, we saw a bunch more patterns pop up, which you might be more familiar with today, such as the head and shoulders, ascending triangle breakout, double tops, double bottoms, and what have you. So what is the actual mechanism for why technical analysis appears to be working time and time again? Well, it all comes down to what is known as the self-fulfilling prophecy, where we begin with a belief, and our belief creates an expectation. Our expectations influence our actions or our behavior, and our actions and behavior influence the actual result or outcome based off of our actual behavior. So let's just take a look at the Bitcoin chart and see how the self-fulfilling prophecy based on technical analysis theory actually works out. So we have the beliefs, expectations, behavior, and results. And in this example, based off of technical analysis, the belief is that there is resistance at 19,621 plus or minus, okay? Now that creates an expectation that if price breaks out and pushes back up into that level, that there is going to be an area of what is called resistance. That means that there's going to be less buying pressure at that area. It's going to be increased selling pressure. There's also going to be a bunch of people who are taking profits in that area, or people who are going to begin to short sell in that area in expectation that price will come back down off of that level. So our expectations of that influences our behavior, which will create a bunch of selling pressure at that level. The result could be that we actually see a pullback off that level. So let's just take a look at the chart and see what happens. As price pushed up into that level, you can see the expectations initially created a big sell-off, right? So the expectation was there was going to be an increase in selling pressure and reduced buying pressure, which would create a pullback. And you can see that there was a 16.5% pullback immediately after we tapped right into that level. Now, we then began to form up another pattern, which is a flag breakout pattern to the upside. This basically resets the cycle of the self-fulfilling prophecy. The belief is that this pattern is a breakout pattern, which is bullish, which could lead to increased buying pressure if that level of about 19.6 to 19.7 breaks out to the upside. So if it does break out to the upside, that is going to create the behavior of a bunch more people buying in that level, as well as people who were short are now going to get stopped out, which then increases the buying frenzy that happens. If we can look and go into the future and see what happens, we can see as soon as that actually broke out to the upside, that creates the expectation and behavior of higher prices to come, which creates the actual human behavior and action of people buying and buying and buying. And you can see the result as this thing just went on a monumental run all the way up to 42K from there. So that's all technical analysis is. It's a self-fulfilling prophecy playing out time and time again based off of the patterns that we have identified to repeat themselves over and over again based off of the technical analysis theory. The next thing we need to discuss are breakouts and breakdowns, which are for the most part also a lie and a way to manipulate you into believing that an all-time high breakout could lead to you becoming extremely wealthy. Well, if prices are down and suppressed for a while and you see a breakout to the upside and you're in the beginning of super cycle bull market, maybe that happens. But for the most part, this is the exit liquidity zone where big and smart money is actually making you believe that it's time to buy when they're actually manipulating you to buy so that they have someone to sell to. This was actually introduced by someone in the late 1800s to early 1900s known as Richard Wyckoff, who created the Wyckoff method. And he created something that was called the composite man. And this is a quote off the internet that says, "The composite man attracts the public to buy a stock in which he has already accumulated a sizable line of shares by making many transactions involving large numbers of shares, in effect, advertising his stock by creating an appearance of broad market or a market as a whole." Basically influencing people to think that this is the next big thing, this thing is blowing up, you should potentially buy as well. And then as soon as prices break out, all that is a big chunk of buy volume for that composite man or smart money to exit out of that position, okay? And we can see the actual schematic of the Wyckoff method here. That final breakout to the upside, all that is liquidity and a manipulation of telling people that this is the time to buy. This is when you see Bitcoin breaking out at all-time highs, headlines everywhere, everyone on the news talking about Bitcoin on all-time highs, breaking out, here we go, everyone at the dinner table, should we buy Bitcoin? And then next thing you know, that turns into a reversal or a trap that I call, and then everything comes crashing down, and everyone who bought at the top now just lost all their money, and the composite man or smart money use them as exit liquidity to lock in their gains as they had already been accumulating in a prior period. If we look at the actual Bitcoin chart here, this exact scenario playing out. Everybody thought that we were breaking out above 64K to go on all-time highs, and everybody was saying that we're going to 100K, CNBC, all your favorite crypto guru influencers. Everyone is telling you that now is the time to buy, and we're going to all-time highs and going to 100K. Whereas me, myself, someone who has had a little bit more experience, 20 years in this game, I did not look at that as a buying opportunity, rather a selling opportunity. You can see me tweet on November 16, 2021. I said that's what we call a trend reversal on Ethereum and a bull trap on Bitcoin. This is the actual chart that I was looking at the time. And if you also look at the Wyckoff method, this is a pretty similar pattern to that final exit liquidity zone before we see a big reversal. And if we look at actually what happened in the markets, that claimed the top of the bull market in late 2021 in November, and then we saw a push to the downside. You can also look at this on the other side for looking at a bottom. You can see the similar schematic, but in reverse of this actually breaking down to the downside, faking everyone out, and as soon as that broke out to the upside, that claimed the bottom of the market. Now, it's obviously easier said than done to actually identify these things. While I did identify this as the top of the bull market, I did not identify this as the bottom of the bear market. I was expecting a little bit more and coming back all the way down to 10K. So I'm also human and I also make mistakes. And that's also why technical analysis or trading is as difficult in general, because we don't know actually what's going to happen in the future. We can only make an educated guess based off of the things that we see to potentially try to protect ourselves going forward. Now, speaking of breakouts and breakdowns, you can make a shitload of money buying breakouts in a super cycle, such as this breakout that began down here at about $12,000 on Bitcoin. This is when I turned 20K into $1.7 million as the markets just absolutely ripped to the upside for the next 1.5 years. Then when I called this trap or Wyckoff end of the cycle exit liquidity zone here, I made $500,000 going short and long during the bear market. The most important thing that you have to understand when looking at technical analysis is the market moves in different cycles. And if you're using a strategy in a bull market, you can't use that same bull market strategy when the market shifts to a bear market. The problem is most people use one strategy, they're a one-trick pony, and they can only make money in a certain type of market. All bull markets come to an end, and typically, especially in crypto, you see 80 to 90% drawdowns after the bull market ends, and it usually wipes out everyone with them. So the most important thing that you need to do when it comes to trading is understand that this is a game of psychological manipulation. If you're thinking like everyone else, if you're watching the news to get your trading advice, you're not going to be making money, because those are the people who are trying to manipulate you, or basically working for the composite man, who are trying to use you as exit liquidity. So the goal is, don't become exit liquidity. Think differently. Think of this as a psychological game in trading, okay? And you're not just going to draw some basic squiggly lines. You have to understand that you need to take advantage of people that aren't in the know. You need to take their money. All trading is a transference of wealth from dumb people to smart people. So try to become smart, try to make some more money, and try not to become exit liquidity.
In today's video, I'm going to show you exactly how to finally become a profitable trader and start earning your first $10,000 per month. How? Well, we're going to identify where are the big institutions going to push price next. And in order to do that, we need to understand market structure. The biggest problem I see traders out there is reading market structure wrong. But in today's video, I'll show you exactly how to do this correctly so you can dramatically increase the probability of you winning more consistently.
And so what we're going to talk about right now, guys, is technical analysis. And for most noobs who are just getting started in trading, they look at technical analysis as, okay, we're going to predict the future and then place our bets and then make some money, and we're all going to get rich, and we're going to fantasize about how rich we're going to get. And that's like the fastest way to lose all your money, approaching with that mindset. Whereas a pro level trader, and from my aspect of from doing this for almost 20 years now, and how I think about it is technical analysis has nothing to do with predicting the future. It's the study of the psychoanalytics of the neural network of traders as a whole, so we can anticipate and then potentially react to potential probabilities, knowing full well that we have a good probability of being wrong. And when you open up every trade, you should expect that you are wrong on this trade, because if you don't prepare for that, you are gonna blow up your account and you're never gonna find success in the long run. So as I've stated multiple times in the book, that the most important thing that we can focus on in the beginning as traders is learning
how the hell we're just going to even survive and not blow up our accounts, because it is extremely easy to lose money, but somehow so difficult to make money, and more importantly, keep that money. And then after we learn how to do that, we need to learn how to grow that money so that we can continually exponentially grow our account through compounding, right? And so that's just kind of what we need to kind of grasp here and kind of just, again, slow down in our process of what we're going to do and really get a good grasp on how we're actually going to make this work over the long run. We need to hit singles and doubles on a consistent basis and have a good batting average instead of trying to swing for the home run or hit that lottery ticket trade where you think you're going to change your life, because you're fucking not. It's not how this game works. In my 20-year career, every time I've gone through for the big win, I've regretted it. Even if I did pull off a big win or lottery ticket trade, that same behavior would later lead to losing all those gains and even more on top of that, because that's just the chain reaction of picking up these bad habits. If you make a big trade, it doesn't matter because you broke rules to get that big trade. And once you break those rules, now that'll become a habit of breaking those rules, and it'll be a chain reaction where you eventually lose everything. So we need to understand that this is a get rich slow game. That's what we're going to talk about here. Is this is the process that needs to be had when we get started in trading. But now, right now, we're going to go over kind of just the basics of technical analysis from my perspective of doing this for the last 20 years. And how I think you should be approaching this in a safe way so that you can get rich over the long run. First and foremost, technical analysis really just works based on the fact of the self-fulfilling prophecy, where people, one, believe something, and those beliefs influence expectations. And then those expectations influence the behavior, aka people buying and selling. And that behavior influences the results, aka things going up or going down. And so let's just take a look at the actual illustration from the book and look at what we have here on Bitcoin. This is the chart. Once price topped out over here, we made a local new top. This was an all-time high for Bitcoin, I believe, at what? This was 44,000 at the time. We came all the way back down to about, I think, 20K. No, this was 30,000. So now, on this low, we now have basically what we would call a low pivot. We'll call it an LP, all right? And now going into the future, we could expect that if price comes back down in that level, we're going to see some sort of shift in supply and demand. And when we look at supply and demand, all we're doing is, prices go up, prices go down. When things top out, right, this is an area of supply where there's more sellers than there are buyers. That's why the buyers and the demand, as it goes up, stops, and the supply takes over, price shifts and goes back down to a point where there's now more buyers than sellers, and that's when things shift down here in a demand zone, and then price continues to go up from there, okay? And so that's just the shifts of supply and demand. And when we look at the technical analysis of how that works, these beliefs of understanding what technical analysis is, understanding of what supply and demand is, creates expectations. So now that this created a low here on Bitcoin, and now this is considered what? This is basically demand took over supply, aka there was more buyers than sellers at this level, and then we saw the reaction to the upside. And now going to the future, we now have this expectation that if we see heavy selling into this level, we'll probably see the supply or selling stop at that level again. And now we have those expectations of that potentially happening, and that creates the behavior of it actually happening right at that level that we can see exactly happen right at that level again. And then what happens there? We get results based on that behavior. Every time price came down into this level, right around this level here on Bitcoin, we saw the behavior of people buying at that level, aka demand overtaking supply, aka buyers overtaking sellers at this now support level. Then we saw the results, and that is the price going up off the support zone and then pushing to the upside. Okay, so that's all technical analysis is. It's people believing that technical analysis will work. And so they expect price, once it goes into these levels, quote unquote, from technical analysis, that it'll influence behavior. And we actually see it over and over again over the course of history when we're looking at charts. And that influences the behavior, which then influences the results. And that's why we see price continually bounce off these support and resistance levels based off of supply and demand, which is based off of the self-fulfilling prophecy. It's kind of a weird concept of how this all works. And that's why this isn't really predicting the future. All this is, guys, all this picture right here is on Bitcoin is just a literal painting of how the entire neural network of traders as a whole, or you hear people saying that the markets are manipulated, the hedge funds and the big banks and the institutions and the algorithms and the high frequency trading is manipulating the market. You can't compete with them. They're all going to take your money. In some senses, that is true. Where do you think they get most of their profits from? It's from the 98% of people out there who are losing money. How can we say that they're scamming us or rigging the market when we literally have all the data in front of us right here on the chart? We can see exactly how institutions, how hedge funds, how HFTs, how algorithms, how quantitative, whatever you want to fucking call it, AI models. We can see literally here on the chart how they reacted and how they behaved in every situation in the past. So now that we have that data, we can't say that they're going to scam us or rig the market in the future because we can see exactly what they're doing, at least in the past. And that gives us an idea to look at the same situation when those same situations form up in the future of how we should react like them so that we can make money, as opposed to reacting like a fucking emotional degenerate and getting all our money took. Okay, so the markets are not rigged. Yes, they have a lot of money. They can influence price action, but that doesn't mean we can't see literally right here on the fucking chart exactly how they are rigging the market, exactly how they are playing this game so that we can potentially take advantage of what they're doing because we have the data right in front of us and we can study it. So let's just take a look at one. We got to look at and understand the candles. If you didn't understand what that was in the book, or if you don't already know, all it is, there's either white candles or green candles or red candles or black candles, where white or green are up days and green or black are down days, where the opening price is the low of the body of the candle. The closing price of the day is the top of the candle, whereas the upper and lower wick is essentially just where price action shifted throughout the day, right? Say if this is a daily chart, a daily candle, this means that there's 24 hours on Bitcoin, only about 6 hours on the stock market for that candle. And so this is all the action that happened within that day, right? Price could open here, hit the low of day here, come back up during the day, hit the high day here, and then come back down and close right here. Same exact thing for the red day, just the opposite of the opening closing price, where the opening price is here and it's red because the closing price of the body is down here. And so it's just basically just shown here on colors, whereas the white days means that the opening price is down here, closing price up here. It was a positive day for that. Next up, if we look at how I typically draw resistance and support, the easiest way for me to do this is just looking at the closing price of the lowest pivot, and then also looking at what was the lowest or highest of that. So for a resistance, we want to look for a high pivot, like right here. This would be a high pivot. We want to find the closing prices and then extend our resistance range to the top of the potential wicks. And I always look for ranges in support and resistance because there's no such thing as a perfect support and resistance. There's no such thing as perfect trend lines. There's no such thing as perfect anything in the markets. So we always have to have some sort of breathing room or a range to work with. Otherwise, we're going to continually get stopped out by actually trying to predict the exact price where things are going to reverse. We have no idea. History never repeats itself, but it rhymes, okay? And when we're looking at technical analysis, all we're trying to do is look at the past, the history, and then see how it might rhyme in a similar way in the future. But we know it's not going to be the exact same. So trying to pinpoint the exact price you think it's going to reverse is stupid, which is why I like to look at ranges for support and resistance when we do it. So let's just take a look at example of how we would draw support and resistance on Bitcoin, basically similar as what we saw in the book, right? So the high pivot of this move right here. So if we want to look at what's going to happen in the future, we would look at the highest high of the pivot, of which you could be fooled a few times here, right? Because if we actually look at what happened here on Bitcoin, there was a high here, and a high here. You might have thought, okay, this is the high here, right? So we're going to draw the resistance here. But no, it was actually this high. But no, it was actually this high, right? So that's the thing, is you don't know when that high pivot is actually gonna happen at all times, right? But what we do know is that there's a curveball over here with this low. And so we could potentially anticipate like, okay, we have to factor in this high right here, and we're almost getting there right here, and we're almost getting right there here, and then we almost got there right here before finally seeing an actual pullback off this level. And we can actually see degenerate trend actually finding support here, 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 and here before finally breaking down here, of which we'll go over later and we already discussed in the book. But basically, what we're trying to look for is the highest pivot that any sort of, supply and demand shift made. And in this case, it's this spot right here, right? And now we have a level, especially now that we saw a big pullback off that level, to push that forward to try to anticipate and react to what's going to happen in the future. And if we look at it, how this reacted here going forward, right, we can see price action pump almost into it right here. And it did make a little pullback. But what happened? It just spiked right back into that level, faking everyone out, thinking that this is the high right here. Like, oh, maybe it's just not going to actually reach in that level fully. Time to short. We're going to dump here. Boom, right back in that level, stopping everyone out. But where did it actually go into? It perfectly retested into the closing price all the way up to the highest wick of the actual pivot right here before actually seeing a big push to the downside. And we can actually see the nice divergence that we talked about here that we can see forming up on degenerate shift, right? But we can see price making new highs. But what is the indicators doing? They're making new lows. That basically means that this move right here is running out of steam and also perfectly tapped into this previous resistance level before dumping back down to the downside for a nice shorting opportunity to get in. Now, if we look at support levels here as well, what is the low pivot of this move right here? It's right here. The closing prices right here, and then the lowest wick. And so we can drag this across here and see how this actually played out going forward in the future, right? So this is quite a big range. We're not trying to predict the exact price of where things might go into. We just know that it's probably going to be somewhere around there. It's going to rhyme a little bit, but it's not going to be the exact same. So if we look at what happened going forward, we now have this support right here, came back up, retested a little bit right here, came back here, retesting the range here, retest the range here, retest the range here, retest the range here, before finally breaking down. Then coming back up, failing to break out to the upside of that range here, coming back down below it. Now, at this point, you don't really know what's going to happen. And then all of a sudden, we saw this massive pump to the upside, which was rumored to be triggered by Binance buying a bunch of the BUSD and then or getting out of their BUSD position prior to it getting banned in the US, and then buying up Bitcoin with that BUSD. And that's what was the initial trigger for this big pump to the upside. And also from a technical perspective, right, this is what we saw come back into this level, faked everyone out below this support level. And as soon as it started pumping back into this range and actually broke out above it, things just went chaotic here and saw a massive pump to the upside, which then retested potentially this level, came back down, retested here before finally coming back down to the downside here. But it didn't actually go all the way back into that level as of right here. So it's not perfect, right? There's no such thing as perfect in the markets. But we can look at other small areas of significance, like, right, we have this pivot right here. We can drag that across here. We have this pivot right here. We can drag that across here. And we can see also these areas becoming somewhat significant, okay? We had that pivot right here on Bitcoin, and we could see that price reacted after this big spike, reacted this level. It stopped here and then consolidated, created a flag, and then ripped to the upside. And what happened when it broke back above to the upside? Came back down, retested perfectly into this tiny little zone that was all based off this little area right here of resistance, and then it's now support when things were back above it. And then we look at what happened here, right? Based on that first initial area, right? If we take the low pivot here and grab the wicks, okay? Drag this all the way across, right? We can see it happening right here, right into that zone. Where did price halt out in the future again? Consolidated in this range again. And then as we go forward, where else did this actually have super relevant significance? Right here, again, after we spiked into this level. And then here again, spiking into this level again right here. Okay, so it's not perfect. We can see it trying to pump over to the upside of this level. But this range that I just drew right here is from like 2 years ago, all from right here, okay? And we can also look at these potential areas here, this pivot right here, and this pivot. We can even draw it as one and be like, okay, there's two pivots here that could potentially have relevance here. The closing price and also the top of this wick right here. We can even draw this over and see how that was relevant to the top here. right? Spiked barely into that level and then pulled back, and now we're just sitting here on Bitcoin. So that is how I draw support and resistance, and it's good to understand that it never repeats itself perfectly. And we can even see this perfectly again right here, right? Top, all based on this first initial area that we drew across here, spiked here, and then what happened when it actually topped out here? Came perfectly right into that zone, again right here. And then after it ripped to the upside right there, where'd it go? Perfectly right into the first initial one from 2 years ago. And we can also draw this new one, which is a little bit more relevant significantly from 6 months ago. Where did price top out in? Right in that level right here. All this happens and all of this works simply just due to self-fulfilling prophecy and people expecting these things to happen. And then it's our job to try to anticipate potentially these things happening and setting up a trade plan where we're only going to lose a small amount if we're wrong. But we have to understand we could definitely be wrong. We have no idea if Bitcoin is actually going to top out here. What if shit just goes crazy? What if there's some sort of big piece of news that comes out and all of a sudden Bitcoin just spikes to the upside and goes on a massive run? We have to be prepared for that. And that's why we have to have stops in place with proper risk management so that if that does happen, we don't lose too much money. But we can anticipate that this is a good shorting opportunity, potentially based off of supply and demand, support and resistance, and the understanding of how the self-fulfilling prophecy of psychoanalytics of the entire neural network actually reacts to price action. So that is support and resistance, guys, in a nutshell, and how I actually draw it. Similar situation here that I drew here on Link, right? The low pivot, the high pivot. As we draw that across into the future, we can see Link reacting similarly right into these levels, okay? Then it topped out right here, kind of in the midpoint, never made it up here. And then again, drag that across. We can see how that was significantly relevant as well. And then the low pivot continually goes into that level and then bounces, broke down briefly here, then rallied back up right again to what? Right into this previous area right here. Good to understand the general concepts and how I like to look at all this going forward and understand it. Okay, next we're going to talk about breakouts and breakdowns, and this is simply just when price breaks out or breaks down above the areas of support and resistance. If we look at support here, we can basically call it support after two areas have now been formed, right? So two low pivots, then on the third or beyond, a breakdown to that level. Now, typically, the first test of that support is going to be the strongest reaction to see a bounce, right? That would be the potential bounce trade. Usually, the first retest would be the highest probability of the bounce trade of it actually retesting. Same thing here on the resistance. We saw that first high pivot here. The second high pivot with the highest probability likely of a reversal off that level. Third and beyond, we're looking at, okay, maybe this is going to break out. Think about this as a wall, brick wall. Then we have like this freaking sledgehammer thing over here is a sledgehammer. And every time this resistance or support is tested, this sledgehammer is bashing on this fucking wall. Every test beyond the second one, it's just continually bashing, and we start seeing cracks in this wall, okay? Until eventually, this thing is gonna hit that breakout level or breakdown level. Either we call it breakdown when support is broken, we call it breakout when resistance is broken. Eventually, that wall is gonna be so compromised with cracks on however many tests it take to break out that it will break out to the upside or to the downside. And when we see that, that creates a big either short squeeze where a bunch of people who were short get stopped out, creates buying pressure, or people who are looking to buy breakouts are starting to buy in, and this just causes a chain reaction to the upside and simultaneously to the downside as well. And so we look at situations like that where we see that exact thing happen here on Bitcoin. Once it broke out this level, we saw a bunch of buyers to the upside, spiking this to the upside. But a lot of times, these breakouts don't happen, or the breakdown happens for a brief period of time, and it's a failure, and then it results in a big upside move, right? Same thing here, breakdown to the upside, failed move, chain reaction to the upside. You can't just take it as a breakdown or a breakout that is going to be, okay, I should buy this. I typically don't like to buy breakouts unless there is compression leading into it, which we'll talk about in the upcoming patterns. Just for an example, XRP, we bought into this breakout here. It broke out above this level. We actually anticipated buying in at 45 cents, anticipating and knowing that if that level is breaking, we're going to see a big reaction to the upside right into what? The next resistance level here at about $1. And that's exactly where it ripped into. Okay, so we'll talk about breakouts in the ascending triangle here shortly. But first, we need to go into bullish trends and bearish trends and exactly how do we draw those levels. We just looked at support and resistance levels from a horizontal plane. And now we need to look at support and resistance from a slope, either up or down, which we would call either a bullish trend for going up or a bearish trend for going down. In order to establish a bullish trend, typically, it could just be the incoming trend is bearish and we're finally seeing a reversal where we saw a new low pivot. And then we saw the first bounce and we made a high and we came back down. But rather than price coming back down and retesting this area, right, we could draw the actual support based on what we know about that level. Price never comes down there and it actually makes a higher low. And then rather than coming back down to this level again that we could draw and extend over to this level, price makes a higher high. And then the now makes a new higher low. And now we can draw an ascending trend. Okay. So the first thing that has to happen is it has to create a higher low. And now we can draw a line connecting those two lows. And now we could say, okay, potentially we could have a reversal in trend, or we have at the beginning of a new bullish trend. And this is the same thing to the downside of a bearish trend, right? It could be coming to the upside from a bull trend. We have a high pivot. We could even draw our resistance, be like, okay, if price comes back up here, it could potentially be an area of resistance where we then bounce off. But price never makes it up there. It goes down, makes the first pullback, makes a new lower high pivot, and then starts going down here and then creates a lower low below this first pullback. It's like, okay, now this looks like a potential new bearish trend. We can connect those lines and now anticipate that, okay, the third test of this could be a potential trade here, especially if we do see a nice bounce up. Like, okay, now this is officially a bearish trend because we got the first two. And now we could expect and anticipate that the next test of that level could be an area where price is going to pull back yet again and also break down to new lows below the structure. And that's the exact same thing here that happened on the bullish trend. Let's just take a look at Bitcoin, what we saw going on here. Okay, we can see Bitcoin actually forming up this trend right here. Okay, and now we can first see it just by, okay, we saw this first initial move. These points are connected, 1, 2. Okay, that's a new potential short-term trend. And then it's a little bit hard to anticipate this bounce right here, right? We don't know that, but it did work out perfectly by connecting these lows. But now that we have those lows, we can say, okay, this is now definitely an official potential bullish trend. We have the first low, new high pivot, new higher low. Like, okay, let's connect these trend lines and see what happens the next time we actually retest this level. Where did it go? Right exactly to the T of this level. Now, the other thing to factor in here is how do we combine the horizontal levels as well as the ascending or bullish levels to create what we call confluence. Confluence, the definition of it is when two rivers converge. And now this is a super powerful river. And in this sense, we're looking at when two levels of support or resistance converge. And now this is a super powerful or super support or super resistance. And we can see that when price actually retested that level based on what we can draw here from our resistance level that we have here from this pivot, that was the exact moment in time. Price action perfectly retested not only the ascending trend, but also the now support level right here. So that would be considered super support from both the bullish trend line level as well as the horizontal. And we can see price action made a huge reaction at that level. Again, the same thing that is happening here, the self-fulfilling prophecy based on technical analysis and how will traders react, right? We saw the move come right into this level. Boom. People are expecting that there's going to be a big shift from supply to demand at this level because we know that this is an area of potential big super support. What happened? The expectation led to the behavior of people buying here, which then led to the chain reaction and the behavior and result of a huge push to the upside. Where did it go? Right exactly into this high pivot right here based on the pressed high. Okay. Tried to break out and it failed and then came back down. Okay. Now we're still consolidating in this potentially triangle breakout formation. We don't know what's going to happen as of right now. So that is just basically a look at the ascending support. But we also need to understand that it usually takes time for these to form up, and we can easily get faked out by premature trend lines. Let's just take a look at this one right here. Okay, say we wanted to draw this pivot right here. What just happened? Like, okay, we have one, this level right here. Now we have the second, and we're like, okay, we could potentially anticipate looking at this. We're like, all right, maybe this is going to bounce right here. This is looking like a good bounce. And it kind of does, right? We don't know if it's going to bounce right here, but we could potentially draw this across here. But it's not quite. And it's thinking, okay, it could potentially bounce off this level. We have some horizontal support here that showed here, also showed some sort of area, some sort of significance here. And now we have the ascending trend coming in right here. It just failed and then broke down everything right here. And so that was a premature trend line that failed, but also the breakage of this trend line. What did that cause? It caused a chain reaction of a broken trend line to the downside also, which then led to some huge selling pressure. So we can look at these premature trend lines also like, okay, this failed. Maybe we should get out, or maybe we should even short this. And that's going to indicate that we're seeing a big drop right here. Or if we even sold short right here, we could say, hey, maybe we should cover some of our position for profits right here because there is this ascending support line. But maybe we'll keep a little bit open because we know if this breaks, we're going to see a potential more continuation downside selling. And that's exactly what happened here. You have to understand that it's easy to get faked out by premature trend lines thinking, oh, this is the trend line right here. I'm going balls deep long for this big bounce to come up to the upside right here. But no, it was a premature bullish trend line. Everything came all the way back down to this trend line right here, which then resulted in these two major bounces off that level. Similar thing with resistance, guys, of which we talked about here on the actual, this is Ethereum, but we can see price action making the first pivot here, right? This could even look like a fake one right here, okay? Where you're like, oh, let's draw a trend line right here, okay? So now when price comes and reacts to right here, this is going to turn into a shorting position and they're going to see a big drop. But no, that actually didn't happen. Price bounced through it, then created a new pivot right here, which is the actual pivot for the actual established trend line. So this was a premature trend line that you could have drawn right here. But the real one was right here. And then that pivot happened right here. But now that this pivot right here and this one happened right here, we can now draw this trend line for now the third test of it, which happened right here, resulted in a big washout to the downside, multiple big lows happening. So it's important to understand that a lot of times it takes longer for things to form up than you think. And there's always going to be premature potential trend lines that happen that can fool you before the actual formation forms up. There's not like a certain time frame that you have to wait that I have specifically calculated for you. It's just important to know that things typically take longer to form up than you're actually anticipating. And this is where FOMO can really get to you and fuck you up because you're thinking, oh, well, this might be the one right here. But no, the actual trend line that's waiting to be formed took another month to actually form up. And then another week or two before you actually got an area of opportunity to potentially short into this breakdown right here after that third test. It's important to note that you need to have a lot of patience waiting for these things to actually form up. All right, guys, next we're going to talk about some moving averages and how to use them and should you use them. First up, some of the more basic ones that are very well known are the 200 and the 50-day moving average. I actually do like the 50-day moving average quite a bit. It did help me predict the top for Bitcoin when we topped out near 50 to 60K multiple times. As that first run on Bitcoin ramped up here, we saw the 50-day moving average first get tested right here, which was actually that low pivot from the major support level that we saw. Came back down almost here, retested here, and once we broke down right here, that was like, okay, we just saw a monumental fucking run on Bitcoin break out over this high right here, fake everyone out, and that looked like, okay, maybe this is the actual top. Then the 50-day moving average broke down, retested the 50-day in this range right here, before seeing that massive move. So this, again, for me right here, was I was getting prepared to stop being aggressive on the long side and getting ready to potentially go short, of which I did short Ethereum at like $4,000 during this time when Ethereum was topping out at 4K. Similarly, we can look at the chart. Ethereum was topping out here at 4,000 at the same time. And I posted something on Instagram right around here, and I said, counting down the ticking time bomb on Ethereum. And then what happened within a week, it dropped 50 to 60% to the downside for Ethereum. And so it's important to note that, one, parabolic moves are always going to break down. But when we look at a long-term trend, I do like to look at the 50-day moving average, because if we've been trading above the 50-day moving average in a long bull trend for quite some time, a breakdown below that could potentially indicate a big reversal in the a little bit longer term trend. We might see a big pull down to the downside. We actually have something called gold in death here, which is basically just showing the 200-day moving average and 50-day moving average. We saw a bullish cross to the upside right here, which we call a golden cross, when the 50-day moving average crosses above the 200-day moving average. And then that led to a massive run on Bitcoin here. And then it finally crossed right here, right? We could see that happening, cross, finally broke down for the first time and actually sustaining closing prices below it, which is definitely a big red flag. And then it retested that level before finally dropping, significantly. So that's a 50-day moving average. Then we have the 200-day moving average, which is a little bit less significant to me. Some people like to use it. They call it the death cross, of which you can see right here. This is death cross when it crosses below. But that death cross didn't really result in much, right? The death cross actually happened, broke down right around here, right? And then price only made a low over here and then actually ripped to the upside. Okay, and we knew that was potentially going to rip to the upside based off of what? Our understanding of how supply and demand and resistance and support work based on the self-fulfilling prophecy, right? Came back down to that level, then ripped to the upside and saw a big bounce. But now, again, we can see prices retesting that level here based on our resistance. Yes, it broke out above it multiple times, but continually failed to hold that level. And as soon as it failed the second time, that was the actual top of the markets. And we saw an 80% pullback here in the markets. We also saw the 50-day moving average, right, cross back above here on the longer term chart, hold its ground here, right, brief period moment, and then break down here after that almost double top, which we'll talk about later on Bitcoin. And that breakdown here again triggered and signified the beginning of the big 50 to 60% drop. I look at the 50-day moving average as a long-term overall trend of the markets. It's not perfect. No trend indicator is. We can see that it broke down briefly here, then came back up. People are like, oh, well, it's back above the 50-day moving average. Should we be bullish again? I don't know, right? So we don't know. It's going to be all over the place. The volatility in crypto is insane. So there's going to be a lot of mixed signals, but what this means is there's like a kink in the armor, okay? There's a little crack in the armor, like, oh, well, now this trend is no longer as strong as we once thought it was, and right? So it kinked in the armor right there, had a little crack, and it cracked again, and that led to the big drawdown in the market. So I do look at the 50-day moving average. The 200-day is whatever. The bullish golden cross and the death cross can be significant, but it's not something I place my bets on, okay? So we saw another death cross here to the downside, and yeah, it did pump down the downside, but then all of a sudden made a new high, retested the 200-day before making a big move to the downside, and then a long-term move here. The 50-day moving average, what it do? It broke out right here and at about 20,000, and then price ripped another $10,000 from there. And then we saw the bullish golden cross right here at about 23, but what happened after that? Price dropped all the way back down to 19 from there before making another run. But is this the beginning, right? Look, we do have a bullish golden cross here, and price is in a bullish trend ever since then, right? It's above the 200-day. It's currently below the 50-day, so we don't really know how this is going to play out. But it's something to look at from a longer-term perspective. What is the overall macro trend? And that's something I do look at when I look at moving averages. Another one that I do love to use is what I call degenerate trend, which is available at degenerate.io. It's actually not even live yet. We're hopefully launching the site next week, but degenerate.io. I like to use what I call the degenerate trend, which is basically just a nice indicator for short-term trends. It doesn't work perfectly all the time. And as I stated in the book, sometimes you have to look what's working best for that asset and you can adjust it, right? If you want to look up an indicator, you just go to indicators. If you want to do a moving average, you just type in moving average. Moving average simple, moving average exponential. For short term, I use exponential. For longer term, I use simple. All you do is click that. Now you got an EMA on the chart and you go into settings and then you input what length you want that indicator to be for that actual one, right? If you want to do the 50-day moving average, you just type that in there, what color you want it to be, I want it to be this green. So that's how you put an EMA on the chart. But I like to use degenerate trend. It basically gives me an indication of what the short-term trend is. Should I be theoretically a little bit more bullish right now, or should I be theoretically a little bit more bearish right now? We're updating this indicator soon. It'll be a little bit better. It works relatively good in trending markets. Right now, Bitcoin has been scatterbrained in big fucking waves all over the place. But if we look at like the illustration XRP, we can see how a lot of times after a breakout to the upside on a chart, a pullback right into degenerate trend is a potential dip buying opportunity, especially the first retest. What happened here? We saw a big sell-off to the downside. Price came right back up into degenerate trend, then trended down. What happened here? We saw the shift of supply and demand. We saw the trend of degenerate trend break it to the upside. Would that indicate a potential reversal? That big spike to the upside? What happened? We saw a pullback right into degenerate trend, which could have been a buying opportunity before another big pump to the upside. Then we finally broke down here, similar situation, retesting, and then finally here, retesting, breaking down here, retest degenerate trend, then a big dump right here. So that's typically what happens with degenerate trend on short-term trending assets. Sometimes assets are going like this. Moving average trend like this isn't going to do shit for you. It's going to be going up and down through it like this. So the asset has to be behaving in a way that's reacting to it. You can't just say, okay, we're going to put this thing on here and we're going to trade based off of this. You have to look and see, is that asset in a trending market and is it reacting typically over the last 6 months to that indicator? That is when you should be using that indicator or degenerate trend. If it's not, if we're in a sideways choppy market, or if there's just a bunch of news or a bunch of fear in the air, you're going to see markets that are going like this. And you're going to see it going above and below and above and below and above and below that trend indicator, which means it's not a trending asset. So this only works during trending times when you're seeing moves up and moves down, a little bit more stable periods, kind of like what we saw here on XRP. But overall, it is a good indication. You can also use degenerate trend for weekly charts, especially on Bitcoin, almost like the 50-day moving average, to indicate whether you should be bullish or bearish in the markets. Look at this. If we look at what happened here on Bitcoin, breakouts to the upside of the weekly chart degenerate trend have typically always been the beginning of big bullish trends. Look at it retesting degenerate trend on the bullish chart here. Now, this is a very good indicator, right? Huge pump to the upside of weekly chart, retest degenerate trend, huge bounce. New high, retest degenerate trend, huge fucking bounce. Retest degenerate trend, huge fucking bounce to the upside until finally it broke down degenerate trend right here. Okay. And now we can be like, okay, maybe this is now a newly formed bearish trend. Okay. And that's exactly what happened. It wasn't perfect, right? Nothing is perfect. It did spike above it here, came down, spike above it, came down until we finally broke down big time. But what happened when a long-term bearish degenerate trend broke to the upside right here? That was a huge fucking move to the upside. And now it's an indication of, okay, maybe we should start shifting our mindset to be bullish on the markets and stop being so fearful, like you probably should have been here, where a bunch of people are probably trying to buy the dip and just lost everything. Now we have an official big, huge candle close above, sustaining prices above it for quite some time. Notice how it only lasted 1 week. Every time it spiked above, it lasted 1 week. This spike above lasted 1 week and instant drop. This one spiked above and then sustained prices. That gives you a much better indication of, okay, maybe this is the move that's actually going to stick to the upside. And we can see the exact same thing happen here, right? We had the actual degenerate trend break here to the downside. Okay, maybe we should be bearish, and that's what happened. But then it broke above here and then had multiple weeks of holding above that. Like, okay, maybe we're actually going to stick above this. What happened? Came down, retested degenerate trend. During the week, it broke below it. But then what happened? It actually closed and continued to hold that level. What happened after that? A massive move to the upside until finally breaking down here, right? Typically, if we see more than 1 week below the break, that means we're potentially getting ready to see a big push to the downside. And that's exactly what happened. We held below it after this breakdown right here, flagged, and then pushed to the downside. We broke above it right here, but then had 1 week where we kind of sustained. And then the following week, we went right back below it. And that led to the massive downside pressure here. And if we look at this breakout right here, we saw the first week breakout above degenerate trend. Rather than seeing 1 week, then failure, it held that week, held this week, held this week, held this week, held this week. It held for almost 2 months above degenerate trend before finally retesting it right here on that super volatile sell-off here, but actually closed the week back above it. And as soon as it closed that week back above the weekly chart on degenerate trend, look what happened. A massive fucking candle to the upside, which then led to a big spike here again to retest degenerate trend right here. And now we're retesting degenerate trend right here, which could be a potential upcoming buying opportunity. But if we have multiple weeks that close below this here, we could see the beginning of a new shift to the downside, and maybe we should stop being a little bit less bullish on this current trend that's happening here. So the weekly degenerate trend on Bitcoin is actually extremely significant to identify, should we be bullish or should we be bearish based on what price is doing. And also, again, reminder that a breakout to the upside isn't necessarily confirmed, or a breakout to the downside isn't necessarily confirmed until you have more than 1 week that actually closes below it, right? We saw multiple times where it did close and price going below it, but it instantly came back up. It broke out above here. Maybe people are thinking, looking at this, when we see this right here, like, ooh, we're actually breaking out above it. Maybe we should start being bullish again. But sometimes you get way too early in your anticipation of what the neural network of traders are doing, and look what happened. It did hold 1 week above, but still not necessarily confirmed. That next week was a massive dump to the downside, and that's what led to the next push to the downside here. Okay, so a lot of times you'll need multiple weeks of it holding above that level, and then the dip buying or shorting opportunity a lot of times is the retest of that level. So it takes a lot of patience to wait for these things to happen. But I just wanted to show you guys how significant degenerate trend can be, especially when you're looking on a weekly chart. Daily chart, based on how volatile crypto is, a lot of times it can be a little bit too volatile, chopping up and down below it. But when you look at Bitcoin on the weekly chart and you gauge that bullish or bearish, that can give you a lot better trading opportunities to then look at other altcoins, be like, okay, Bitcoin's bullish, I should be more bullish. Even if I'm not trading Bitcoin, I can be more bullish or more bearish, depending on degenerate trend on the weekly chart, with my altcoin trades that I'm actually making. That's just something you should be considering when you're actually looking at moving averages. And those are really the only things I use. I use degenerate trend, and I use a 50-day moving average, sometimes a 200-day. So again, if you want degenerate trend and also the indicators that I'm about to talk to next, they're available at degenerate.io. So let's just talk about the indicators, guys, because indicators are quite important. I will say they're not as important as price, because indicators move based on what price is doing. So they're always a little bit one step behind price. But what they do is offer confluence. Like, right, when we're looking at price action and we're like, is this overbought or oversold? We can look at charts and be like, okay, it's been up for quite some time or down for quite some time, but indicators give us a better idea of how overbought it is, or how oversold it is, or what I like to call how fearful people are, or how greedy people are, with my fear and greed indicator, right? Because the markets are controlled by emotions. And basically what we're trying to do is identify those areas of over heightened emotions where people are reacting based off of a heightened state of emotion, where we can then take advantage of them. We can take advantage of their hope. We can take advantage of their fear, and then capitalize on that to basically steal their money. So then one of the most, if not the most popular indicator out there is the RSI. And we can see the RSI basically over 70 or below 30. Over 70 is considered overbought, or things are too high. And then below 30, down here, things are oversold, right? People are scared and things are very low, thinking it could be a dip buying opportunity. So we can see here, RSI was over 70. It peaked out. Where it was that on Bitcoin, we saw this push to the upside here. Things came down, retested one more time to the upside before finally coming down. We saw below 30 here, and that was actually pretty close to where the bottom was. And then we didn't really see that again till right here, over 70. And Bitcoin, was high here, but then Bitcoin went much higher right after that. And then also, it barely hit below 30 right here and here. And it was pretty close to, there was a bottom here, but then things were sideways. And we did see a brief period of time where you might have been like, okay, maybe that was a good idea to buy the dip. But again, the RSI is used by way too many people. And when we're traders, we can't be looking at everything in the exact same way. Yes, everyone's looking at the same chart, but if you're looking at the same idea in the exact same way as everyone else, you have no edge. And if you have no edge, then you have no power over the rest of the people. You don't have no power over the rest of the traders out there. 98% of traders are failing, and only 2% of people that are trading are making money. And they're only making money because they're making the right decision when the masses are making the wrong decision. So we can't look at the same thing all the masses are using. And the masses are using the RSI because it's free, and it's just somehow became one of the most well-known indicators. So I don't recommend using the RSI whatsoever. What's more important than an actual indicator, guys, is a divergence. And a divergence is when a price, let's say this would be a bearish divergence, and we're looking for a top signal. We want to see price make a new high, and then price make another new high, but we want to see the indicator make a high, but on this secondary high, we want to see the indicator make a new low. And now we have what's called a divergence, basically a divergence of paths, where paths at one point were going like this parallel, but at some point they diverge and start going opposite of each other. And basically all this means is that this secondary move to the upside, while the retail trader might be thinking, oh man, we got a breakout here. We're breaking structure. Let's buy this fucker. We're going to new all-time highs. We're super pumped. We're all going to be rich. But we have this indicator here showing, well, it is making new highs, but this is actually much less powerful than this move right here. There's less volume typically. It just means that this move is running out of power. And if you don't have enough buyers to continually push price up, it's just running out of steam. Yeah, maybe the selling is a little bit light here, and there's a little bit more buyers than sellers here, but it's not enough, and it's losing power. And we can see that by a divergence on the chart. And then opposite of that is the bullish divergence, where we see a low happening and we see a low on the indicator. Then we see a new low breaking below this level right here, basically confirming this continued bearish trend here, retesting now this low, but we see a higher low on the actual indicator. And this is indicating that this new low, while yes, a lot of people here probably had their stops placed here, they're freaking out. All the bulls who were bought this dip right here, like, I fucking give up. This thing's never gonna stop going down. Fuck this market, fuck trading, this sucks. And the reality is this move is actually the actual real low, and this is not strong. This is not a strong move. And as soon as we start pushing back above this low right here, and we have this bullish divergence, price just rips to the upside, and everybody who sold on this breakdown freaks out. They give up. They say, this is fucking scam. I hate trading. This is bullshit. But they probably didn't understand the bullish divergence that was happening there. Bullish divergences and bearish divergences do happen all the time and actually don't work out. So you do need to understand that just because there's a bullish divergence or a bearish divergence, it doesn't mean that this is going to happen. It all boils down to probabilities and understanding that you could be wrong. Most traders lose because they don't want to be wrong and they don't accept that. But here's some examples off of another popular indicator called the MACD history. It's okay, but it's free. And when things are free, too many people are looking at it. That's the less people that are using it, the better it's going to work, because it's a singular, unique way for a small group of people to look at something that's different than the masses. And if you're looking at the chart at the same way the masses are going to use, you're not going to have as much as of an edge. It is going to be harder to make money. But we can look at just some examples of divergences here on Bitcoin, right? Where price makes a high, then a new high, but we can see the MACD make a high here with this high, but then a lower high. What happened next? We saw a price crash. We see price make a high here, then a new high here. That would be, again, a bearish divergence. We saw MACD high, but then on this high here, we have a MACD lower high. What happens next? Price crash. Then we have a bullish divergence where price makes a low here, MACD is a low, but then on this new low of price, after it broke down below here, MACD is now higher than this previous low. Now we have a bullish divergence. What happened next? Well, we had price coming down into this 25K support that we had drawn previously. And then there was also this ascending trend line here. On top of that, we had a bullish divergence. So we had three indications of a potential bounce right here. We had that big 25K support, now resistance level, or resistance now support level that we had previously drawn here. Then we have this ascending trend that we had drawn here, and we have a bullish divergence here. And then what happened next? Price blew up to the upside. So it's good to understand you can combine all these things together to find more confluence. But when you see divergence on the indicators, that can give you even more confidence that what you're looking at based off of support and resistance and supply and demand. When your indicator is also giving a strong divergence, that just like sprinkles on top of the cake, like the complete. The cake is now complete. Let's make this trade and set up a probability for making this happen. I wanted to go over why I like my indicators better than RSI. One is that it creates a lot more divergence signals for me where an RSI doesn't, right? Here we saw price making new highs on Bitcoin. On fear and greed, it was showing us a divergence. What happened next? Price dumped. Whereas on RSI, what everybody else is using, there was no divergence. It gave us no indication. And then if we look at the trend here, we saw one trend here, one trend here. What happened on the third test? Right here, price dumped. And we also had a bearish divergence that showed us right here. On the fear and greed, right here, we have a topping sell signal, right? No divergence, but that doesn't mean that it can't dump off that level. Fear and greed had a topping sell signal here, price dumped. RSI wasn't even close to 70, right? So RSI was no help for us there. Here we saw new highs, then new highs. On the actual fear and greed, we saw a divergence. We saw a high here, but new lows here, which means this rally right here is weak. It's running out of steam. What happened? Big price dump. Did RSI help us out with anything there? No, there was no divergence, not even in overbought territory. RSI was zero help, but we saw a divergence and in overbought territory on fear and greed. Again, here we see the high here and the high here. On fear and greed, we see a divergence. Bearish divergence. What happens next? Big price dump. What did RSI do for us? Nothing. It wasn't even in overbought territory and there was no divergence. So RSI sucks. Fear and greed is better. It's going to give you a lot more reliable signals for when things are getting too overbought or too oversold, running out of steam, so you can actually make a better decision. Whereas RSI really didn't do a whole lot for us. Now we can look at degener shift, which is my alternative to MACD, and then combine this also with fear and greed as well as the actual chart. Again, here we see a bullish divergence here on Bitcoin, the low here, then a new low here. What do we see here on fear and greed? We see a divergence. What happened next? Big pump to the upside. On degener shift, we didn't see a divergence, but we saw a deep buy signal in the green, right? If we look at MACD, we don't know when things are overbought or oversold. On degener shift, I created areas where we see significant either oversold areas in the green or significant overbought areas in the actual pink or purple. Whereas MACD, we don't really know. It's like, okay, well, it's up here, but we don't have like a range of, is this like really overbought or is this like really oversold down here? We don't have like a significant range to see. But on degener shift, I created it so that you actually see when things are super oversold or super overbought, and you also get potential buy signals. This is a buy signal here when the trends are actually shifting off the lows here. So if we look at what happened on Bitcoin here, one, we saw a buy signal here as the trend started shifting on degener shift. We also saw a bullish divergence here, and that created a low here, and then price rip to the upside. We see this top right here on Bitcoin, right? What do we have here? We saw price deep into the overbought territory or greed territory, indicated by this big money symbol. People are too greedy. They're buying up here for what fucking reason? I don't know. They're fucking crazy. They're trading on emotions. And so they're buying up here. They're being greedy. We also saw price come up here and get a reversal sell signal on degener shift. What happened next? That was the top. Price fucking dumped. Okay. We look here on this dip right here. We saw a low here, then a new low here, and we see a big divergence here, a bullish divergence on degener shift. We saw a low here and then a higher low here after this low. Okay. We didn't see a divergence on fear and greed, which is not a problem because we're now seeing a divergence here. So sometimes they work together. Sometimes you see a divergence on one and sometimes you don't see the divergence on the other, but the other might just be in that very overbought or oversold territory. But sometimes we see when both are showing divergences together, and that is an even more powerful signal that we'll see on the next example, which was actually the low of the bear market of 2022 and moving into 2023. So we can see again here, price right here, making a low here, price making new lows, while fear and greed is making a higher low. So now we have a bullish divergence here on fear and greed. Then we have, again, on degener shift, price making a low with the low here. Then we have the new low here on price and a higher low on degener shift. You know what that was? That was both fear and greed and degener shift, both creating bullish divergences. And that just so happened to be the very low of 16,000 or 15,900 or whatever it was of Bitcoin of the entire bull run. So when we saw both create bullish divergences, that actually created a powerful enough signal to create the low of the actual bear market. So that is just some examples of why I like to use these indicators that I created, because they give me better and more reliable signals than the indicators out there that everyone else is using. What they do is add confluence to everything else that I'm going to be teaching you guys based on support and resistance, psychoanalytics, and the self-fulfilling prophecies of technical analysis. Okay. So what these do is give you guys a better idea of what you should be thinking about in your trade philosophy, as well as your trade plans, by understanding that, okay, we're extremely overbought here. Okay. Yes. But price is making a new high. Yes, that doesn't mean that this is the top. Okay, yeah, price came back down a little bit, then ripped right into this level right here, and now we have a divergence. On what? Both of them. We have a divergence bearishly on both fear and greed, as well as a big one on degenerate shift. What happened next? Big price dump. They're not buy and sell signals, but they give you a good idea when things are running out of steam to one direction and looking for a potential big reversal in the opposite direction. And what that does for you is it gives you a good idea of when you should be selling at the top to make money or even get short, or be locking in profits from your short on the way down, or buying the dip when things are so oversold. Okay, so that's just basically how I use trading indicators. Again, degenerate.io. If you guys want to try those out for yourself and see how much they can help with your trading decisions going forward. All right, guys, next up, we need to talk about chart patterns, because yes, we have learned about support and resistance, divergences, ascending, descending trend lines. But within all that stuff are formed what we call chart patterns that we can actually better utilize to potentially make trade decisions and act on those trade decisions that can hopefully make us some money. And these are kind of just like the classic chart patterns that I'm going to go through. And what you need to understand about patterns is that most of the time, patterns are compression, AKA it's almost like just things squeezing, going like this, and then squeezing to the point where there's just so much pressure that price either goes to the upside or price goes to the downside. So that's really all patterns are just consolidation periods where things are going sideways until they eventually squeeze and compress into a level where then creates a chain reaction. And we see this reaction in either the upside or downside. And so that's kind of how price action works within patterns. And so the first one we're going to talk about is the ascending triangle, which is a bullish pattern. Now, with the ascending triangle, rather than having this price coming in to one side or the other, we actually see the top of it forming resistance here. But rather than just going straight line across here, right, we see a trend forming where we see a low and then a higher low. And then we see what? Compression leading into the nose of the candle, which then finally breaks out above this resistance and causes a chain reaction to the upside. And that's the ascending triangle. If we want to project a price target for the ascending triangle, we find where this began right here and here. And now we have that horizontal resistance. And then the first low pivot and measure the distance from here to here. And then if price breaks out above this level, we can project that level, that distance from here to here from the actual breakout. And this would be your theoretical extension of this move, right? It's just theoretical, but typically for me, yes, I can factor that in, but it's not something I really look at too much. For me, what I'm going to be looking at is, okay, if we had a breakout here, I'm going to be looking at where was that last high pivot, right? Say maybe price came in here, but there's a high pivot here, or maybe there was even another one right here before actually, within this trend. So now I'm going to be looking at this level. I'm going to be looking at this level as potential areas to lock in gains. And we can also look at this projected level here that we extended to the upside, right? These are all factors that we can look at for where could this thing top out, or where would be an ideal range to potentially be locking in profits for this game. So every chart pattern basically is 3 phases. For this one, it's typically a large rally, typically on high volume, indicated by this big move. Then that first pullback to the downside. And now within phase 2, we do 2 things. 1, we create the ascending trend. And 2, we create the horizontal resistance that now creates a triangle formation that we can draw. In phase 3, we reach the point of compression where price is either going to break to the upside or break to the downside, and we see that follow through. One of the bigger ones that I've traded multiple times on is XRP. We saw phase one, price rally. Phase two, we saw the first low here and then the second low here. And we saw price come back in and retest this area right around here. Okay. So now we have the horizontal resistance and also the ascending support down here. And then phase three, we see price kind of consolidating and then just basically compressing into the nose of this triangle before it finally broke out right here. And, you know, if we draw basically this distance right here to here and then extend that move, that would be probably somewhere right around here. Okay. For that move, but this just continued ripping to the upside. And we can look at XRP and actually have that looked at. And we can actually look at the most recent ascending triangle that broke out, right? We saw this level here, horizontal resistance, and this would be essentially phase one right here. Now we have essentially phase two here, and this is phase three, where here we created the low here, the second low. So now we have the ascending trend. We have the horizontal resistance, phase three, compression, breakout here. And then a big pump to the upside. Where did it go to? Right into the pivots here. Okay. So we can see there was a pivot here on XRP from these resistance levels. And there was also this pivot right here that didn't get to, but it could potentially get to because it's also right around $1. But it basically ripped right into these first pivots, right? Briefly spiked out over the top of it, but didn't actually close above it. It was just an intraday spike over that level, which then would easily be an area to be locking in gains on this trade. And now it's coming back all the way down to potentially a dip buy opportunity right back into this area of now support. Okay, so that's just a perfect example of an ascending triangle that just recently broke out on XRP and the actual one that happened all the way back here. Horizontal resistance, ascending trend, phase one, phase two, phase three, compression, breakout, spring loaded, boom, big push to the upside. That's basically just the free phase triangle breakout of the ascending triangle. There's also the descending triangle, which is a bearish move, which is basically same thing. Phase one, typically a big sell-off. Phase two, we can start forming the descending trend and also start connecting the horizontal resistance levels that now allows us to draw that actual descending triangle. All that means is that the neckline of the triangle here is on the lower side, and then we have a descending trend as well. And then in phase three here, we see compression followed by a breakdown that triggers just a massive chain reaction of either people who are long who get stopped out or short sellers who are continually shorting on this panic to the downside. This is basically just fear unraveling here and a big spike to the downside. And we can see this actually happening on Bitcoin back in the 2017, basically end of the bull market and just big collapse in the bear market. We see phase one, that big rally, that was the high, all-time high for Bitcoin, a low created. Now we see in phase two, now we can draw the horizontal support. Phase two, we see the low here, the low here. Now we can draw the triangle formation, retest it one last time here. We see the compression happening. And once this broke down, that was a 50% drop, negative 50% in just about a month here on Bitcoin for that to happen. So when we see these patterns form up, it doesn't mean it's going to happen. But what this allows us to do is find these patterns, be like, okay, let's get prepared for this potential scenario to happen. And we can anticipate it happening. And let's try to set up a trade plan so that we can capitalize on it. So I'm never trading this. I'm never shorting down here. Okay. I'm looking at phase one happening. Okay. There's nothing here yet. Phase two, I'm like, oh, well, this is actually forming up a descending triangle. This is something we should keep an eye on. Okay, now in phase three, I'm entering somewhere potentially. If I'm going to trade it, I'm entering in phase three prior to the move actually happening. So I'm anticipating that phase three could be coming into fruition, but I could be wrong. Okay, if this ascending or descending trend broke out to the upside, maybe that's it. Maybe this also broke down briefly, came back up, and then broke to the upside, and then this is going to just rip to the upside. Okay, that's not what happened, but I need to be prepared for that. I didn't trade this. I wasn't even trading crypto back in this time. I was still doing full-time stocks. But this descending triangle broke down and saw a big flash crash of negative 50% to the downside that we can actually see on the Bitcoin chart all the way back here, guys. All right, look at this thing. This is like a picture perfect descending triangle breakdown here. Boom, boom. Wham, bam, thank you, ma'am. Slap to the downside. And then that was just the catalyst for the low of Bitcoin, right? And also, again, if we look at XRP on both these ascending triangle breakouts here, was I buying up here? Fuck no. Okay. Where was I buying? I was buying down here. Okay. And then I added again right here. This was like right when I first started trading crypto. I was like, okay, let me just dabble in crypto. And I went from like 20K to 100K pretty quick just because of this trade. Because I identified this, got in down here in the 25 cents, and then I sold a lot of it above 65. And then I sold everything right here. And that was when people started hating on me on YouTube. Because I said, okay, time to sell. They're fucking getting sued, you idiots. Fucking sell, you dumb bucks. Look what happened. Boom. Similar situation, ascending triangle pattern on XRP. Going forward, right? I didn't buy, actually I did. I added $10,000, so I lied. Okay. But this is a longer term hold position. This happened at 1 a.m. I'm sitting in bed at fucking 1 a.m. like, wait, what? They won the fucking case? Fucking shit. Holy shit, they won the case. Okay, I'll add $10,000 right here. I alerted in the Telegram. But where was I actually buying? This wasn't a trade. This is for my longer term hold on XRP. I was buying here, 49 cents, months before this even broke out to the upside of this. Okay, so I was anticipating what was going on and pre-planning for this actual move that did come into fruition. And I said, don't bet any money on this trade that you're not willing to lose everything. Because if they lose the case, you're probably going to lose everything. Next pattern, guys, is the symmetrical triangle. Called this one the confused tourist because it's not, there's not like where this has a horizontal resistance or support. This one is condensing and compressing from both angles, right? It's got a descending resistance and an ascending resistance. Phase one can either be a incoming bearish trend, which is typically meaning that whatever the lead-in trend here is typically meaning that's going to continue in the next direction, because this is also a continuation pattern that we'll talk about later. But it could also potentially be coming from a bullish indication and then this compression here, 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 and then lead to the upside. For the actual projected target, again, you find the pivot here, pivot here, pivot here, pivot here, and you take the distance from the low pivot after the first pivot here, right here. Take that distance, measure it from the breakout, and you're typically going to break out over this high briefly and then to that pivot right here. Just for an example, XRP was a symmetrical triangle here pattern. This is back in 2021, but you can see, right, actually coming in, making a low here, then the high here, low here, drawing that, boom, boom. And then once it's compressed towards the nose, right, again, all patterns are compression and reaction. So the actual measured move was here to here. You can see, or actually I did measure it here. So that was the target here. And we can see that if we actually want to draw this, right, there's actually kind of this low pivot right here that we can draw across the board here. Ripped right into this level. The projected target was right around there. There's also this low pivot that was kind of now resistance, but price actually ripped right into this level all the way up. And where did it go? Where did it go? How do we draw support and resistance? We take the closing prices of the high pivot and the high wick and draw that to the right. Where did this go right into? Right into that area before dumping. All that triggered by this compression and reaction to the upside, right into a major resistance level before coming crashing all down. Okay, so extreme volatility on this one, but that's a perfect example of a symmetrical triangle pattern breaking out. The falling wedge is another one. It happens quite a bit in the crypto market. And all it is one, a descending trend line that's happening, but also a descending trend line support. So it's continually making new lows, but also making lower highs until finally it breaks out to the upside and actually changes structure and starts pushing to the upside. And this one can be tricky because in phase three, a lot of people get tricked by this because people think that the breakdown below this low is another breakdown, and we're going to see a continued push to the downside, of which is possible, and that's something you got to factor in. But usually this is the last fake out to the downside before closing back above that low here and then breaking out above this line right here. And that's what triggers compression caused by reaction. So that is the falling wedge pattern. We can see examples of this here on Bitcoin, right? Descending trend 1, 2, and we have a low, and then a lower low here, and then a lower low here. And that was actually that last low that faked everyone out. And we can see that happening, right? We see the lows here, and then this low here faked everyone out, and then started pushing the upside, and then just traded sideways and actually created a higher low here before finally breaking out above this level. And this was the low of the actual bear market that we also saw happen and was indicated by the bearish divergences on both fear and greed and degenerate shift helping us identify that this was a divergence here, a very big bullish divergence. And then the breakout occurred here and this spiked to the upside. And that was a big wedge pattern happen. We can also see this wedge pattern here, the pivots here, also pivot, pivot, pivot. This breakdown was the panic of that wedge pattern breakdown, faked everyone out, closed back above, and then ripped to the upside above this, saw that big reaction to the upside. That's just what we're looking at here. Typically, it can happen in any size, shape, or form, but that last breakdown below this low of the descending trendline support is usually the fake out that leads to the reaction that then breaks out above the descending trendline resistance. And once that resistance is broken, we see the big spike to the upside. Same thing that happens here. Pivot here, here, and here. Then we have the pivots here, here, and then one here. But look what happens. We break down below this pivot low. But what was also there? We had super support based on this, and then one last fake out below the wedge into that level, faked everyone out, spiked back up right into this level, broke out above the resistance, and then boom, big reaction to the upside, and this led to a magnificent move to the upside. So that is the falling wedge, which is bullish on the market, a quite common pattern that I've seen many times in the markets, and so this is something that can't be ignored. The other one is the rising wedge, guys, which is a bearish formation. The lead-in trend can be from either way. In volume, in phase two, again, all these are three-phase patterns, support, and we can also draw the ascending resistance, of which this is descending trend, I should say, ascending. Trend line is formed, and then we see one last spike to new highs over the previous high, retesting that actual ascending resistance, which turns into a fake out. As soon as that fakes out and closes back below, the ascending support breaks down, and then it causes the big chain reaction to the downside. And we can see this happening here on Bitcoin, the pivot here, here, breakdown. Now this one, yes, this pivot high was broken by this one, but then this one didn't actually fake everyone out over that. It created another low here before finally breaking down to the downside. Now this one actually did fake everyone out, right? It faked out people multiple times. So we see the pivots here, pivot here, and now pivot here. This potentially, to some people, could have looked like, okay, that was the actual pivot right here. We're coming back down, and then we're going to break down below this level right here. Okay, but there was actually one more, even another spike to the upside here above this high, and that was the actual fake out, right? Retesting this level before finally faking everyone out. Now we have this rising wedge pattern here, 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 and then this breakdown. What'd that do? Cause the consolidation, compression, and then the reaction to the downside. Okay, same thing that happened here, guys. Pivot here, here, here. We can draw the horizontal support or resistance there. One last fake out, which then retested the ascending resistance. We have the pivot here and here that we can draw the trend line now for support. And as soon as that broke down, big chain reaction. This was actually when FTX announced that they're basically insolvent and completely fucked, which then caused this. So that was basically, you know, bear trend here. And then in a bullish trend, after we flipped to the upside, which we saw on the weekly chart, right? We saw a degenerate trend coming in like this. And then degenerate trend from the weekly chart broke out right here. That was kind of an indication, okay, maybe things are switching to the bull side. Now we see more rising wedge pattern happens, but in a bullish trend. So the lead in was actually bullish. Pivot here, 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 kind of just sat sideways, but then this pivot and this pivot and then this pivot broke down to the downside. We see it happening here a little bit more like a channel, but also it is a wedge. We saw a high pivot here. One last fake out to the upside off of these pivots. We can see the ascending trend forming up. As soon as this broke down, we saw a downside selling. And it's also interesting to see that it came right back up and then retested that line again here, guys, before coming all the way back down. What was once resistance then becomes support. What was once support then becomes resistance. So it's always a chain reaction. When it flips to one side or the other, the opposite side takes over as support or resistance. So that is the rising wedge and the falling wedge pattern, both very significant in all assets, but I find it pretty significant in crypto, maybe more so than anything else. All right, guys, the next two patterns we're going to talk about are the head and shoulders and the inverse head and shoulders. Now, these patterns do have relevance and significance, but I wouldn't say there's something I I get all giddy about. Like, oh, we got a head and shoulders, guys. This is getting ready to make big moves for us. I can't wait to trade this. But they are existent and they're good to actually understand and know. So they basically are called a head and shoulders because it looks like the head and shoulders of a human being. We got a left shoulder, head, and a right shoulder. And so in phase one of this three-phase pattern, the first shoulder is formed that we can see here. And also the base support of the neckline. It's called a neckline because it's literally just the neckline of the shoulder of the pattern. Then in phase two, price pumps again to brand new highs and creates the head of the pattern. And either in phase two or phase three, we could then come back down, and then now we could draw the support line that can either be sloping like this to the upside, it can be sloping like this to the downside, or can be completely horizontal straight. It doesn't really matter. All that we know is that there needs to be a left shoulder, a head, and then two low pivots that we can draw and connect a point from here to then potentially anticipate what could be happening next, right? So we don't know what's going to be happening next because right from this standpoint, and all we see is this right here. We have left shoulder and head, and then the neckline that we could draw, but we don't know what's happening over here to the right yet. So is this going to be a head and shoulders pattern? We don't know yet, but we could potentially anticipate and be like, okay, let's just look at this and be like, this could be a head and shoulders, which is a bearish formation. And then as price pushing forward, if we do see a high pivot here, right? Price come up, create a high pivot, and then start reversing back down. Now we can even be more convinced that this could be a bearish head and shoulders pattern. And then if a breakdown of this level happens here in phase three, then we could be anticipating, okay, we could be seeing a sell-off here. And for me, if I was going to trade this, I wouldn't be entering down here. I would be entering somewhere in between here and here prior to this happening. The problem with trying to anticipate what happens here is we don't know if this is going to break down and turn into this. What if it just doesn't turn into anything and it bounces off this level and then hits new highs? If we look at a head and shoulders pattern, a breakout of price at all, it doesn't have to close up there, it doesn't have to confirm above there. Basically, this pattern is no longer a head and shoulders pattern if this doesn't create a shoulder, if this just starts spiking up and then gets above the head, because it's now no longer a head and shoulders, it's a left shoulder, a head, and then a new high, all right? So it's no longer a head and shoulder pattern. So if it does break down this level, we can then basically take the distance from the head to the neckline and extend that from the breakout, and that'll be the price target for a bearish move to the downside. We can see this happening here on the S&P 500. We can see the left shoulder here, the head happened right here, and then we have this low here, this low here. Now we can draw the neckline, which is now support, then the right shoulder here, and as soon as this broke down, this ascending or this actual projected target would be right here, and it actually basically bottomed out at the exact projected target, which just so happened to be also in line with these pivots of support to the downside as well. Before it did what? It came right back up into this now resistance level that was support, right? When it broke down here, that broke support. Now that it broke support, looking at it from the upside here, this is now resistance. So we can expect that price is going to have a hard time breaking through that. And that's exactly what happened. Price came back down into support, rallied into resistance, retesting the neckline, and then just dumped all the way back down here. Okay. So that would be a bearish head and shoulders playing out here. The opposite of that is the inverse head and shoulders, which is basically the upside down man. We have the left shoulder in phase one. In phase two, we start forming the neckline and the head. So we have the low here, a new low, and then a rally back up, which then we can connect the two lines here to create the neckline. Then we have one last dip to the downside, but it's a higher low. If it breaks down below the low of the head, it's no longer a head and shoulders pattern because there's no longer a shoulder. It'd be like two heads, right? That doesn't make sense. So you want to see the shoulder just be another low, a higher low pivot before breaking out above this level. And that's when you see the upside. The same thing for the projected target. You take the head, measure the distance all the way to the neckline, and then extend that to the upside, and that is your actual target. Just like this, we can look at Apple, which made a fucking monumental move. Let's just actually look at the chart here on Apple, because it's so crazy. They actually just crashed after announcing earnings. It's a big dip to the downside. Look at this big dump. But we can see this forming, and we can see that Apple just went on a monumental bender. And also, this is a good example of degenerate trend. Look at it just riding degenerate trend here. Boom, 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 for freaking all of 2023. massive move to the upside. So super trending asset. On Apple, left shoulder, head, right shoulder. Now we can draw the neckline from this point all the way to here. Left shoulder here and here. It's a little bit of a sloppy one. Okay, I'm not going to lie. This is why I don't trade them. It's not something I look at and be like, ooh, head and shoulders pattern. But we have a left shoulder here, head, right shoulder here on this pivot. As soon as that broke out of this side, that was the confirmation of a potential breakout to the upside. We saw a little push to the upside, retesting this level and right back into degenerate trend before pushing back up and just going on a monumental run on degenerate trend. And we can actually measure the distance that Apple actually topped out, not too far above that actual level here. So that would be the inverse bullish head and shoulders formation on Apple. Again, I don't trade head and shoulders, but they are formations that show up. And so it's good to understand what those are. The next one up here, guys, is the double top, which is simply that. It's basically two heads. We have that first reaction here. Usually, again, the first test of that first resistance level is going to be the biggest reaction and pullback off that level. And that's what we call a potential double top. We don't know if this is going to, come back down here and create a higher low. A double top initial reaction could turn into an ascending triangle. We don't know what's going to happen there. So that's why it's like, okay, we're going to short here. You might want to start locking in gains along the way because we don't know if it's just going to create a higher pivot here and then create an ascending triangle to break out to the upside. Okay. But if it does create a double top, it'll come all the way back down to test the support in phase 2. Then phase 3, create the second top here. And then in phase 3, we have that can basically compression and break down the support, and then it pushes down to the downside. Same thing for projection. Take the distance from here, the resistance to the support, extend that to the bottom, and boom, wham, bam, thank you, ma'am. Now, for me, this isn't a pattern I trade in the sense of I'm not going to be shorting here or here for a downside move. You can, but it's not something I would like to potentially do. I find a lot of times you're going to get faked out right here, and it's going to bounce, and you're going to get stuck in a situation. But that doesn't mean that it can't happen, right? We can see this spike to the upside on silver, push to the upside, right back down, phase 2, right? So this is phase 1. Phase 2, we now have the low here, right back up into resistance. Now we have the double top, and then right here, this broke down below this low. We can take that projected target from here to here, extend it, and look exactly where the target was hit on silver, right there. Came back down, then bounced. Where did it bounce right into? Right back into now resistance before making new lows. So that is the double top on silver. We can also look at this one here on, what is this? This is Nike, right? We saw that first push to the upside, all the way back down into support, which was actually here based on this previous was resistance, now became support, came back up here, retested this level, spiked out a few times, failed to break out, and then created the double top here. And then as we push back into the support level, we actually saw a symmetrical triangle, which is compression right there, and then a reaction that led to the actual overall larger double top play out. And we can actually measure the distance from the target, extend it down all the way down to here, which it almost got down to right here, came back up, but it eventually went to that target and even lower from that level. So that would be a pretty beautiful top. But this takes months to play out, right? This is what, 2 months? This is what, 2-3 months, and then this is another 2 months before it actually. So that's like almost all year long. But a longer term swing trade that could be had based on the double top. The opposite of that, guys, is the double bottom, which is a bullish pattern, which is the exact same pattern, a bottom formation. So in phase 1, we see the first low. Phase 2, we rally up and make the first high pivot. And then in phase 2 and phase 3, we make the second low that pivots right at that support level. And then we see a strong bounce right back into the resistance level, followed by a breakout to the upside. Again, the target is just taking the distance from the low to the high of the pattern and then extending that target. We can see here on gold, a double bottom that formed up right here. That first pivot down here, right back in, that second high pivot, retesting perfectly the lows here, rallying right back up into that resistance, followed by a first retest, followed by some little bit of compression. And as soon as that breakout here, came back up, came back down, retested support, and then rallied right back into the projected target for this pattern, and then flagged and consolidated, and then continued up from there. So that's the double top, which is bearish, and the double bottom, which is the flip side of that, which is a bullish pattern. We also have the triple top, guys. One last hurrah, where we have this, then another one, which could be a double top. And some people might get faked out right here, right? This is why anticipating and trying to short the breakdown here on a double top get you into trouble, because what if it is actually a triple top and actually bounces off this level, could even bounce slightly below it. We don't know, right? It's never perfect at these levels. It could be bounce right here. It could bounce right here. It could bounce anywhere in that range. We don't know what's going to happen. But this is basically what's going to happen in triple top is you're going to see 3 peaks before actually breaking down the downside. Now, is a triple top something I trade? No, it's not. Is it something I see often? No. Does it matter to learn this? I don't know. I guess it's good to learn in case you see it pop up, but it's not something I see pop up. And I'm pretty sure I said in the book that I don't have any good examples because I couldn't even fucking find one other than gold here right now, right? We have the first peak, second peak, now the third peak, right? And now we don't know what's going to happen. We can actually look at this. I can't remember when I actually took this screenshot. We can take a look at gold now, right? So it's still this consolidating in this pattern. It's actually starting to retest, maybe even break down this ascending trend right here, right? It actually broke this one. This is a failure, right? We had a pivot here, and it broke this one. So now that trend is no longer valid, right? That could have looked like a potential buying opportunity. When you look at it right here, like, okay, it's going to retest this. Now it's going to react. It didn't react. And so now this is almost looking like it's going to continue to roll over, but we don't know exactly what's going to happen on this quite yet. But again, right, we don't know if it's going to if this does turn into a triple top, which it could. This can come all the way back down here, and it's either going to, right? We have a pivot here, 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 and this could either be a really big buying opportunity for a move to the upside. But what if this creates a triple top formation? This could just completely crash to the downside. We don't know. It's a longer term pattern. My bet would be that this would be a buying opportunity down here. But if it breaks down, that is a triple top, and that's something that should be noted when you're trading. The triple bottom is a bullish indicator. A lot of people think, okay, this is a double bottom right here. This is looking like a double bottom. Let's buy this breakout. It's going to buy, and let's spike to the upside. Wrong. Nope. All the way back down to this support level right here. And so that's, again, the problem of trying to anticipate what's going to happen. We don't know what's going to happen. Is a triple bottom something I see often? Is it something I trade? It's not. Okay. I don't know, but we're just going to learn it just in case. Okay. And there's actually an example within that gold pattern of a triple bottom right here. We can actually zoom in. We talked about here. Okay. All right. We have 1, 2, 3 resistance. As soon as it broke out to the upside of this resistance, spiked up, came back down, retested before finally making that big follow through. Okay. So is a triple top and triple bottom something that I really care about? It's not. But it's good to understand that trading a double top or double bottom and you're thinking, oh, this is going to be the double top I've been waiting for. And then you try to trade the breakout or the breakdown of it, and then it goes right back up. It's like, well, fuck. Okay, it wasn't a double top or a double bottom. It's now potentially a triple top or triple bottom. So it's good to know that just because you see a double top doesn't mean it's going to happen in the way that you want it. Next one that we're going to talk about, guys, here is ascending channels, of which I do love ascending channels. And it's basically a channel that is bullish until it is no longer bullish and it is actually broken down and negated. And all it is phase one. We see the first pivot low and the first pivot high. Now, from this point, we don't know what's going to happen yet until phase two happens and we see a higher low and a higher high. Now we can draw ourselves an ascending support and an ascending resistance to now react to these levels, right? Because at this point, until we have these 2 points, we don't know because we can't draw anything yet until these pivots happen, until this shift from supply to, from the demand D to supply happens and it rolls over. We don't know what's going to happen up here, and we don't know what's going to happen up here until we can draw here to here, until we can draw from here to here. Now we can extend those points beyond that, and now it gives us an opportunity to react on the third time for either of these. And now if it breaks down to the downside of this, now it's like, okay, phase three could, even be happening for a long time up here. But if it does break down below this, it's just a trend break and it's a break of structure, and we have to be notified in ourselves to be like, okay, maybe this channel that we're trading is no longer valid. And we can see this happening on a long-term time frame with the NASDAQ, right? We saw the first peak high, low pivot here, low pivot here. Now we can draw the baseline of this support. And we didn't see a retest of this until basically a little bit right here, but then again right here. And so now we can draw this side up here, and we can even extend this side. And look what happened. As soon as it retested right at that level, bounced again. Came back up, bounced right at that level again. This one kept freaking going until right here. And then kept freaking going till here and here until it keeps extended, right? And this was a reactionary level based on everything that happened prior to this line right here, right? We have the first two pivots here, first two pivots here. Now we can draw that. And now we have a projection going into the future, not predicting. We have no idea how it's going to react there. But what we can do is anticipate, based on self-fulfilling prophecies, that there probably is going to be a shift from selling to buying right at this level, right? The expectations creates the behavior that creates the result. And what is the result? Spikes to the upside, okay? Almost gets up there, but not quite. Bounces off this level, bounces near this level, and then finally breaks down in phase 3, and then actually shifts the trend. So that's the ascending channel. Then there's the descending channel, which is the same exact thing from, but on the opposite side, where we have the pivot here, lower pivot here, the first high pivot followed by a second high pivot, and now we can draw a descending channel based on those. And now going forward, we can react here and we can react here, okay? Based on that, we can now finally draw this. And then if it breaks out to the upside of this, then it's time to be like, okay, maybe this channel is no longer playable for us. It's over. We have to wait for a new formation. Now we can look at this on the US 30, of which I did trade. High pivot here, low pivot here, low pivot here. We can see how volatile things got, right? It broke down below this low here, even below these levels, but then came back right into it and then retested 1, 2, 3 times in that range before ripping to the upside, retesting, briefly breaking out above it, but then failing and closing back within it, and then is completely dumping right back into these levels, right? It's not perfect, but it goes briefly below it and then rips right back to the upside to this level, consolidates, and instead of rolling all the way back here, it stops again, retests, breaks out, and then it comes back and retests again before finally kind of reversing and then trading sideways and going forward. Okay, so I actually shorted this right here, made about, 38,000 on this trade. But it's just an example of you have 1, 2, 1, 2. Now you can draw the lines here, okay? Now going forward from there, you can react to those levels, right? You can react here, of which got volatile. This was crazy. And then you could react here, which did go up over it briefly, but then came back in quickly and then ripped to the downside. So it's all about finding those first 2 pivots to then draw your channel, and then you can react going forward from those levels based off of those channels. Next up, guys, continuation patterns. We already know what all these patterns are. Some of these overall patterns that we just talked about might take, a month or more to form. A flag pattern is typically looked at as a smaller pattern that could maybe take between, 5 to 14 days to form. And typically they happen after the larger pattern and just indicate that there's a continuation going forward. And a lot of times these patterns retest degenerate trend before going back up and continuing on their way on the trajectory towards the target that the larger pattern actually formed up. So if we look at bull flags, these are continuation patterns. A bull flag could be either this, basically, what is this? This is a descending channel that we just talked about, or it could be an ascending triangle, or it could be a falling wedge. And what I mean by continuation is the breakout is already happening right here, right? This move is already happening. The move is already happening. And a flag is essentially just a small consolidation period within the move before it continues higher. That's why they're called continuation patterns going forward. Okay. But there's also bullish flag reversals where the incoming trend is happening here. Incoming trend is bearish, but then forms an ascending triangle here, descending channel, falling wedge to the upside, and then reverses. So it can happen in both directions, but they can be continued most likely. Whatever the lead-in trend after a breakout, if you see one of these patterns on the bull flag, it's likely to be moving to the upside. But after a move to the downside, if you do see a bullish formation, it could be a reversal also. So you need to understand that as well. Then we have bear flags, which are continuation patterns, say on things that are breaking down, such as a double top breakdown or a head and shoulders breakdown. After that breakdown occurs, you might see one of these patterns form up, right? So let's say this right here was a double top that just broke down right here. Now, after that double top breakdown, you might see a bear flag form up, which would just be an ascending channel that basically would probably fake a lot of people out right here and then rip to the downside and then break down. And then that pattern is just moving closer towards that projected target from here, which might be down here. And then prices going in there. And it's just a brief consolidation period of more compression before a reaction and a breakdown. Same thing with the bear flag, a descending triangle that happens or a rising wedge. And all of these things are, guys, right? This is maybe, I don't know, 4, maybe 5 to 14 days that these patterns form up over. Whereas the bigger patterns that we've talked about here, sometimes these take months to form up. So a flag is just a much smaller scale of these kind of overall patterns that we've looked at. There's also the bear flag reversal patterns where you might see, you know, maybe there was an ascending triangle breakout down here. Rip to the upside. It's hitting its target somewhere around here. But then it starts forming up this little mini ascending channel over the last 5-6 days. And so it could be like, okay, well, maybe we're coming to the end of this because we're now forming this bearish flag up here, right? We're in a ascending channel, which if this ascending channel negates itself and breaks down this support level, it's going to reverse. Okay. So we want to be able to looking at if we're even in a long position, is this forming up a bullish continuation pattern or is it forming up a bearish potential reversal pattern after that breakout? These are all things. We could see a descending triangle breakdown or a rising wedge after a breakout, then a reversal. Okay. These are all things that can happen. There's also what we call a bullish pennant. All it is a mini symmetrical triangle within the continuation of the pattern. There's also something we call a bull megaphone, which is where it's actually expanding almost opposite of what a symmetrical triangle is, where a symmetrical triangle is compressing towards the nose. This is broadening in the opposite direction of a symmetrical triangle. Okay. And this would be a bear megaphone pattern. I don't trade these too often. They're less significant, less seen, but you do see them. And then there's also a bear pennant. I don't know why they call them pennants or why don't they just classify them as flags also, I guess, but they're just symmetrical triangles as opposed to the flags that are either a channel, descending triangle, or rising wedge. They call them pennants, the symmetrical triangle flag continuations. So this is basically just looking at what's going on in Bitcoin. We can see a lot of this happening falling in play. In this overall move that's happening here, we have a bearish rising wedge flag pattern, breakdown, boom. What happened? We saw a symmetrical triangle bull pennant breakout reversal right here, right? Just a short move, but then came all the way back down here. And then another flag pattern here, a rising wedge, which is a bearish flag, right? But it's actually, in the short term, it's in a rising move. But if we look at the overall trend of things, we're actually moving down in a bearish trend right here, okay? So when that bear flag rising wedge broke down, it was just a continuation of this overall move. And we can see this compression here react with a big sell-off here. And then what happened next? We see a bearish flag, which is what? It's a rising channel, which is bearish. It's a continuation. Bearish ascending channel broke down here, followed by a bear pennant, which broke down here briefly before rising back up. Then what do we see here? We see a rising wedge flag pattern, which is a bearish indication, right? It's a rising wedge. And as soon as it broke down, boom. Then we see a bullish falling wedge pattern, right? Breakout to the upside, boom. Here we see a megaphone, bullish megaphone, big move to the upside, consolidation in a megaphone pattern before breaking out to the upside and then forming up an ascending channel, which is bearish, which broke down right here. Boom. Brief period of time, right? So flags are much shorter signals within the overall grand scheme of things of the patterns that you could be trading. Okay, so then we saw support, boom. This one was actually a bullish flag right here that actually failed, right? This is actually an ascending triangle, bull flag, fail, right? It could look like, okay, well, this is a big move here to the upside. We're now, like, right, if we look back at Bitcoin, we saw the weekly degenerate trend breaking out right here. That was the weekly degenerate trend breakout. So we could technically be shifting our mode over towards bullish here on Bitcoin. We see a dip to the downside, a big push to the upside. And now this could look like maybe it's just a bullish flag continuation. We're actually going to consolidate here and break out to the upside, but that's not the case, right? All these patterns can actually fail and break down to the downside. And that's what we saw here, an ascending triangle, mini flag pattern, break down to the downside, followed by, what is this? All right, we can see a bearish flag form up in here, followed by a breakdown here and a big boom breakdown here, which then created actually the first pivot of that big ascending trend that happened right here. So we can see this happening over and over again on a shorter term time frame, over and over again. So it's important to understand the minuscule moves within the overall moves. And really all they are, guys, is just smaller mini patterns, right? We know what the descending channel is. We know what the ascending triangle is. We know what the falling wedge is. We learned about the overall larger move of those and all these other patterns. And when they are called flags, they happen between like 4 to 5 to 14 days. And those are the formations that are actually forming up for that. But anyways, guys, that was kind of just the co-pilot to the book because I kind of went over all this stuff in the book. But I imagine me explaining it to you on video probably gave you a much better idea. And it's important that you can't read something once and memorize everything. So it's good that you went through this again to kind of further establish your understanding and comprehension of how chart patterns work, how to look at them, how to react to them, and understand that none of them are going to work out the way you want all the time. Okay? You have to enter every trade expecting that there is definitely the probability that you're going to be wrong. That's it for this section, and I'm looking forward to continuing teaching you guys more and more about trading. What's up, wolves? Right now, we're going to get into the Tradingview platform mastery. This is probably the #1 used charting platform out there for a good reason, because it is simply the best and the easiest to use. The purpose of this short training video that I'm going to do for you right now is to show you guys exactly how I personally use this platform, right? If you're going to be learning from me, it's best to know exactly how I use the platform to trade the way that I'm going to be teaching you how to trade. First and foremost, let's just take a look at the platform right here. Obviously, this is a bit of a custom layout. So if you haven't already got the actual link to this trading layout so you can actually copy it and create a template for yourself. And also you can see that we have the fear and greed and degenerate shift, as well as the degenerate trend indicators already on the chart here. So if you want to follow along in the sense of using those, you either need to go to degenerate.io to sign up, or if you already have the 30-day free access, you should be able to use that for 30 days to kind of go and see if it's something that you want to implement into your trading strategy as well. Right now, guys, let's just talk about a few different things. One, we're going to talk about the sidebar, what all the tools here are. You're going to see what my favorites are that I use most often. Then we're going to talk about building your watch list and getting that laid out, as well as how to add indicators, as well as how to go back and do a replay, as well as alerts for when prices reach certain levels, right? A lot of times you can't be watching all the time. So you can look at levels on a chart and be like, okay, if Bitcoin gets to X price, I want to be alerted about it and get it alerted either on the actual software on your desktop or be alerted to your phone. So you'd be like, oh, okay, we are now in an area that I want to be trading this. Let me open up my app on my phone or my computer so I can take action. So first and foremost, guys, let's just talk about the toolbar. Obviously, the crosshair is the most basic tool. All it does is just gives you an easy way to navigate the platform, as well as give you a horizontal and vertical bar. So rather than always having to draw trend lines, sometimes you can just drag it where you want to be and get, okay, this is looking like an area here, here, here. And you can see actually the horizontal and vertical planes, what that actually is. Right now, I already have annotations on this chart. And one important thing that is good to know about Tradingview is how the hell do I get rid of all these annotations after I made a mess on the chart and I want to clean things up? Well, simply you just go right click and then say remove drawing. So now we have a fresh chart here that we can see. Now, if we wanted to remove any of the indicators that we have on here, you can either scroll over these and you can see the X button here, and that's going to actually remove it, of which you might not want to do that as well. But if you want to just blank it out so you're not going to see it, you just hit the I button on and off. As well, a lot of times, sometimes degenerate trend kind of makes things a little bit messy for me, so I want to see just price action, and I'll just hide it. simply as that, and I can actually look at what's going on here. I also have a couple other ones here like Degenerate Juice, which is something I'm working on. I don't know if I'm going to release it or not. It's basically just something to do with the average true range, kind of makes the charts look a little bit cooler, as well as the Golden Death, which is just the 50-day and 200-day moving average, and it also shows you the golden crosses and death crosses, as well as we had a golden cross here, potentially coming up on a death cross as Bitcoin is getting ready to potentially roll over. First and foremost, let's get rid of these. We can just use the Degenerate Trend is here. You might see on here that on your app, it might be white in this area. And you're wondering, how do I do that? Well, there's either a light mode or a dark mode in Tradingview. All you do is go up to your username icon up in the top left and select dark mode or light mode over here. And that is how you're going to get the full actual framework of the chart to actually match the dark color that the only chart, because right now it's probably all light color here on the right for you. Let's just go over my favorite tools that I use. One is the highlighter. Sometimes I just like to make little simple bullet points here, okay, just to note things on the actual chart. And if I want to get rid of those real quick, I can click Command or Control Z, depending on your Mac or on a PC. And all these are listed under this drawing section, right? And so I do have my favorites bar. And if you want to add anything to your favorites bar from the tool list, all you do is click the star button on the right once you open this up, and that'll allow you to go and make the favorites bar. So you can take a screenshot of just what I have under this. I have the brush, the highlighter, the arrow, I have the rectangle, which allows me to draw horizontal planes of support and resistance. I have the path and the circle, and all those are now up here in my actual favorites bar. You can also see from this one, I have a long position, short position, forecast, price range, date range, and date and price range. So you can screenshot that and add those to your favorites list as well. And from this column here, all I have here is the Fibonacci retracement, of which we'll also go over how to use the Fibonacci as well. And I believe that's basically about what I have mostly here. I do have the text and anchor note, price label, and a tweet if I want to add those to my charts. If you want to remove this favorites bar, because sometimes the favorites bar gets in my way. I'm like, can this thing get the fuck out of my way? You just simply click this left star arrow down in the bottom corner, and that's going to remove it, clean up the chart a little bit, and allow you to have a little bit more viewability when you're actually using it. So highlight tool, drawing tool, simple, easy to understand. Now the trend line tool is obviously very important. All you got to do is click, hold and drag where you want to actually draw the actual trend line, then let go, okay? So simple as that. Now, if you want to use the trend line to draw a very straight horizontal line of resistance, one, you can either just opt for the horizontal ray, of which you can see here, I have trend line, horizontal ray, vertical line, and parallel channel. All very important things that we're going to want to add to our favorites list here. So I can either do a horizontal ray, which is going to automatically draw everything as far over to the right as possible just by a simple click. But what if I don't want that to actually draw all the way over to the right? We can simply just go back to this, select delete to get rid of that. We can use the trend line tool, hold shift, and that's going to keep that line perfectly horizontal, right? So now we can either draw a vertical trend line, but if we click shift, it's going to actually snap it into place based on all those either horizontal or sloping lanes, right? So, and that allows you to just draw a short horizontal trend line without having it to be a drag across your entire screen. The next thing that I like to use is, yes, the horizontal plane that we just talked about is the price range tool. All this does is shows you how much an asset is moved based on percentage and actual points on the chart. Now, I do like to use this because sometimes I like to know, we were just looking at the NASDAQ recently. If we look at the NQ mini futures, I wanted to know what the average pullback in general was, right, for a bull trend. And that gives you an idea of what kind of to expect in the future. So I just used this price tool. It's like, okay, this pullback was 15%. This pullback was 9%. This pullback was 12%. This pullback was 8%. And so that gave me an idea, just based on looking at the past history, what kind of average pullback was. And the average pullback was between about 7 to 12%. And then we just saw this pullback off the top here at about 9%. So it just gives you a clear view of looking for patterns of how much is an asset moving up or down on an average basis in a simple way. Now, the alternative to that, which is not only looking at the percentage, you can use this tool, which is the date and price range that I definitely like to use a lot of times. It's going to give you how many trading days, as well as percentage, as well as how many actual days it actually took to make a move. So for instance, let's say we want to see what this percentage move was from here up to the top. And we also want to see how many trading days did it happen in, but also how many total days did it take, right? Because a lot of assets only trade 5 days a week, whereas Bitcoin might trade 7 days a week. So it's a little bit different. Right now we're looking at NASDAQ futures. So we can see drag up from here all the way up to here. And we can see it moved 24% over the course of 60 days, but it was actually 40 bars, meaning trading days, right? Because there's weekends where this asset is not trading. So that way we can see how long did it take to make that percentage move if we're trying to gauge based on, okay, how long does a typical bear market last, right? We can say, however, from here to here, that was X amount of days. The past bear market, how many days did that last? The past bear market, how many days did that last? Now, if we're expecting a bear market in the future, let's give us an idea of how many days on average did it last until we can expect potentially the upcoming end of that bear run. And that gives us an idea, to kind of gauge where our sentiment should lie and how long is it going to take. So I definitely like to use that tool in the aspect of that. The next tool here, guys, is the parallel channel that I love to use. Love to use the parallel channel. For instance, let's just take a look if we have any parallels here. So drawing this parallel here to here, boom, boom. Right now, look how beautiful this channel played out. Now we can use, this annotation of highlights. We had the low here, we had the low here, perfectly retested the low here. And also that channel tested here, here, and then a third time up here. Okay, so the parallel channel is definitely a great tool to be using. It's always on my favorite list because channels are one of my favorite things to be analyzing things in for entries and exits off the top and bottom. Now, if you want to change the design or the look of any of these tools, simply just click your crosshair. Now we have this channel of which we can now grab the middle to move this thing up or down. And then if we want to change the slope, we just move things up and down here as well. And then within that, okay, you can change the color of the lines, the external lines here, or the background color, and also the opacity of it, okay? So a lot of different things. You can also change the thickness of the line tool width, the style. And then in settings, there's a little bit more things if you want to extend it all the way to the left, extend it all the way to the right, and of course, change the background. And if you want to have any text annotations on this as well. So let's actually get this background back down to a lower level so we can actually see the price, okay? And then if you want to undo any of the things or annotations, you just click Control or Command Z, depending on what your platform is. And then let's just clean up this chart, remove drawings. The next one obviously is the rectangle, of which I love drawing my horizontal levels of rectangles. Let's just take a look at Bitcoin going on here, right? We had this perfect pivot high here from the closing price up to the top of the candle, drag it across, and look where Bitcoin is coming back into this level now. Again, if you want to change the color, the status, you can change any of the colors here to whatever you want, the fill price, change the opacity, easy peasy, lemon squeezy. For the horizontal line, right, if you want to do that, you grab it by the left. If you want to make it vertically higher or lower, you just grab it by the center and drag it up and down. Again, for the text, very easy. Just select text. Hi there, guys. Change the color, bold, italic, whatever you want to do with that. This is the price forecast tool. I use it sometimes. It's more so just for a visualization of what we're looking at. So say if I wanted to make it a notation on the chart for you guys or for Twitter, if I'm trying to share this or something to give you guys an idea, this is where I think price is going to go. The forecast tool, simply, you would just drag it from, click where the current price is and say, what I think right now is that we're going to bounce off this level, retest a general trend or here, and then come back down to potentially 20. So I could say we're going to go from here, and then eventually, within how many days, it's going to be actually calculating days. See, it's saying 22 days, 25 days, 30 days. Boom, we're going to be, within maybe 40 days, we're going to be coming back down there. Okay, and now it's going to give you a forecast, and actually in 40 days, if price actually reaches this level or not, it'll either say success or failure on this actual tool if you don't change it, and it'll allow you to actually show if you were right or wrong. So sometimes it's more so just for a visualization if you're trying to share this chart with anybody. It's not really for personal analysis, I would say. The next tool I do like to use, guys, is the path tool, which just gives me, again, an idea of sharing what I think is going to happen with you guys. So right now, what I think is going to happen is Bitcoin is maybe going to bounce up into somewhere around degenerate trend, maybe even possibly 28.6, come back down, retest 25K, consolidate somewhere, fuck around with a bunch of people's emotions in this level, and then eventually come back down to about 20K, right? And then you just double click the last bar here to get rid of that, and that's going to allow you to show where you think price is going to go. Again, it's mostly just for visual storytelling if you're trying to share the chart, as opposed to actual analysis, which is basically mostly done with just these trend lines and horizontal bars. The other ones, guys, is just a circle. If you want to, highlight a circular area, very plain and simple. Another one for visual storytelling that I think is really cool is tweeting, right? So say if you wanted to go into my account here, which I haven't been tweeting, it's been my birthday month and all I've been doing is filming videos for this, right? Okay, so right here I said on July 29th, Bitcoin short, $1 million short, risk 2,000, reward 25,000. Okay, I wish I did fucking stop out of this trade. God fucking damn it. I did lock in a little profit, but this would have been a really good short because I was $1 million short at the price of 29,299. But there was one last spike that fucked me over. So let's just take a look at, we can copy this link here and let's just add this tweet and see what happened to price after this. Okay. So you can see, damn it, motherfuckers. So I had $1 million short right here on Bitcoin, of which I'd be up massively right now. Unfortunately, this one last spike right here stopped me out because we were in profits. I was up like 30K or something right here. And I put my stop basically to break even. Had one last spike up to stop me out. And then we had a big drop down to 25K. But this is a cool way to show, if you're trying to show visual storytelling, hey guys, this is exactly where I tweeted. It's going to attach it to the date that you set it. And then you can actually have a little bit better visual storytelling and show proof of what you were analyzing at that time. And you have proof from the tweet. So I love doing that, especially for me. You can also do that with price labels and anchored text to a certain date as well. Date range is not going to show you percentage up or down. It's basically just measuring, okay, how long did it take for this pattern to play out? And it's going to actually just show you how many bars and how many days it actually took. Let's actually talk about the Fibonacci retracement, which I do use in my analysis sometimes. It's not something I live by, but I'll show you how it can be useful right now because it can be useful and it's interesting to see how it can be accurate a lot of the time, but it's not something that I use to make all my trading decisions based off. Basically, the Fibonacci retracement is a pattern that happens in biology all over the place, and it also translates into how price reacts a lot of times in just nature of human psychology and surprisingly on the charts as well. And so what we're typically looking for on a Fibonacci move is what happens a lot is it is pulled back into a level of 38 to 61% levels before a reversal then occurs. So let's just take an example. Let's measure from this move to this move right here, right? So we're going to measure, let's say from this peak right here, okay? And then we're going to measure it down to this low here. And okay, so say we're watching it go from here to here. And then we start seeing this massive bounce. And then we want to know, okay, where is this bounce probably going to stop before it then makes a downturn to the continuation, the other level? Okay, right? We saw it bounce up here and then make a downturn. Basically, it is now potentially looking like a downward trend. So the Fibonacci can help you by giving you a range between 38% and 61% in that range of giving you an area of where it's a higher probability of that reversal happening. So let's just take a look. Draw the Fibonacci from here down to the low of here. And where did Fibonacci retrace? Right? It sped right up into 38%, started slowing down, and then peaked out at 61.8%. It's 61.8% before making a continuation to the downside. Okay. So that's typically how you would actually measure the Fibonacci retracement. That's just an example. Now let's look at this one, right? So there is a move from here up to here. And let's measure this reversal right here, okay, before it made a big spike to the upside. Okay, so we can draw the Fibonacci. We can take the low of here up to the high of here. Where did it stop out? Just below or just above 38%, right? So it's typically in this range. Is it perfect every time? No, it's not. Okay, but now let's take a look at this pullback right here. Okay, so we can even measure this move from the low here to the high here. Where did it actually stop out? 61.8% before making a big move to the upside, right? So the overall move here happened at 61.8%. If we're looking at this timeline here, it didn't quite get into that range. It was actually just above it. So again, it's not perfect. It's not something that I use time and time again. But when you're looking for these big, these massive moves to the upside, and you want to know, okay, where is the pullback going to stop before potentially making another move to the upside? A lot of times it's between 38.2% and 0.618%. And you can actually even make more labels here. If you go to these settings, you can see these are all the Fibonacci levels here. I typically just only use the 38 to 61%, sometimes even the 70, but it's mostly between 38 and 61. You can also change the colors if you want to make it a different color. Extend lines left, extend lines right. You can do both those things. But for me, it's mostly just the 38 to 61, and it's a good way to find out, okay, where is the actual potential area of, the highest probability where the reversal will happen after a big move. That is what I look for when I'm looking at the Fibonacci retracement, and that's a strategy you can use. I only use it potentially as an area of confluence, right? We had talked about confluence already before. So if it's an area of support already on a horizontal or ascending trend line, and the Fibonacci is giving you even more ammo to back that theory up, that's a good thing, and that's how you should be using Fibonacci. But never trade solely off Fibonacci. Look for areas of confluence where there's multiple factors telling you the same thing, and that improves the probability that your theory is potentially going to work out. But again, we're all just trading probabilities. There is also the probability of it being wrong, and that's why you have to prepare for that and use stop losses. Which brings me to the next tool, guys, which is the long and short position tool. If we look at the long position tool, okay, say we're looking at Bitcoin as a potential long, and we want to set up a 2-to-1 minimum risk reward ratio, and we're looking for it to come back up into degenerate trend or even retest this high here. So current price is right here. So we just click the long button, of which is my favorites from this area over here. Boom. It's now showing us a loss and a profit area. Now, if we say we wanted to stop out if price got below, this level right here, not at this low, but slightly below it. We want to have a little bit of breathing room here. And then we wanted to have it, come all the way up here. And you can see the risk reward ratio 2-to-1, right? Now we would have a 2-to-1 risk reward ratio. We can see that the target is 15.89%. The loss would be 7.8%. And however many points that would be, 4,100 points target and a 2,000 point target loss. Okay. And then from here, you can go inside of this and just drag it in the way you want. You can change the color of the profit. Maybe you want the profit to be yellow, but we like to keep it green, or the loss to be red or a different color or whatnot. Okay, so this is just a way to, again, visually storytell and help you set up a trading plan for where you want your stop to be and where you want your profit target to be. I talk a lot more about this in the further trainings, especially how to use grid trading and the degenerate MT5 trading app that does all this for you and executes all the orders for you in a very efficient and quite awesome manner. And I can't trade without it anymore these days, but that's how you would do it on a long position. Say you wanted to set up an upcoming short plan, right? Say we're looking at Bitcoin here. And again, we can use this tool, right? Say we're saying we want Bitcoin to come up to this price, retest that pivot here, and then come back down, retest, and then come back to 20K. So now I have a visualization of where I want this to be based on the fact that we have this pivot here. We have these pivot low highs over there from this low here and this high. And I want price to come back up in this range, potentially even retest the ascending trend line here, which is now resistance, right? Could come anywhere in this range. We don't know how high it's going to bounce. It could even just be at degenerate trend before bouncing. But the higher probability would be somewhere in this box right here. So setting up a short plan, short position, say my short's going to be right around here for entry. I'm going to have my stop, above this level. And then my profit target is not only at 25K, I'm thinking it's going to come way back down here, down to these pivot levels here on BTC. So now we have a little bit more visualization. We use the horizontal lines tool, the horizontal box tool, the arrow tool to give us a visualization of what we might think and anticipate is going to happen. Also using the shorting toolbox to show us that we have a huge risk reward ratio of 7.76, a decent a tight stop above the resistance level, and a good profit target down at about 20K. Again, I would be locking in gains, every step of the way. I'm not going to get short here and just wait patiently for it to all the way come down here. That'd be like trying to predict the future. I don't fucking know. It's going to come anywhere down in this level. That's a big range. So I'm going to lock in gains every step of the way as I'm making money. So that's what I use for the long position, short position. And we kind of went over basically everything in my favorites toolbar here. Another thing that we can go over, guys, is the indicators, which is very easy to use. You just go to indicators and say you want to go to technicals. And this is going to be all the built-in strategies that are built in for you to use. This is like the most common strategies that you can use. Like if you just want to use a moving average, add a moving average here. Moving average, simple, okay? Boom. Now that SMA is now added to the chart over here, we can go to inputs. Now we select what do we want to do. Let's say we wanted a 50-day moving average here, okay? Style, we want it to be bright yellow, okay? And we want it, you can even do different steps here. What do you want it to be? An area, which is going to be a whole area, which we don't really want, but mostly you're just going to do a line. Here, and then you can also change the thickness if you want to be a little thicker to show, okay, this is a very important line. And also, if you don't like these labels on the actual chart here, you can get rid of that here, okay? And if you don't want the labels in the status line, you can select over here because it'll usually show the label and the status over here, but we'll leave those. So that would be how you add a moving average or any sort of indicator to your chart. There's also the community scripts. These are all made by a bunch of people. They're all free if you want to go see what other people have released for free. Then if you want to go over into the invite only scripts, those will be where the degenerate scripts are that you are invited to, but they're all locked unless you are on the free trial to get access or the free 30 days. So that's how you would do this. We can go over to technicals. Let's say we wanted to add the RSI. Boom. So now the RSI is on the chart. Now, if you wanted to adjust this and move the position, you simply would go here and see this up arrow. It's now going to move it into whatever section you want it to actually go. Okay, and if you want to get it down, you would select the down arrow. If you want to actually change the colors of any of these lines in here, you can go into scroll over here. And now you can change any of the lines colors that you want to do, just if you want to actually change the RSI strength length, if you know what you're doing. Just a very easy way to simplify the customization of the actual indicator that you want to do. So we'll get rid of that because we're not using it, but just showing you guys how to actually search for, add indicators into your actual platform. But again, for me, I don't use those indicators. I use my custom indicators, Fear and Greed and Degenerate Shift, because they work the best for me. And that's why I created them, because the other ones weren't working the best for me because they're being used by millions of people. And what we're trying to do as traders is find an edge and look at things in a different way that the majority is not looking at it, right? And that gives us an edge and gives us a different way of actually making money and stealing money from all the people who are looking at the same thing. And if we want to make money trading, we have to have a contrarian view from the masses, right? We're trying to be the wolves, the 2% who make money. If the 98% are all looking at the same thing, they're all going to lose money. And only the people who are looking at it in a contrarian way, in a different way, are going to be ones who steal money from all them because they're all trying to do the same thing. That's not how trading works. This is not a fair game. The majority of people have to lose in order for a small amount of people to win. And these tools help me do that because it's a different way to actually look at things. And only a very small amount of people are actually using this, myself included. The only one right now, because they actually aren't released yet, but hopefully by the time you're watching this, degenerate.io is live and you have access in the free 30-day trial. That's basically it for the indicators, guys. Another very important tool that I like to use is the alert thing. You can either go in here and create an alert based on a condition crossing up or down 4 different ever levels. But for me, I actually never use that. What I do is just draw simple trend lines and then actually draw an alert on that. So let's just clean up this chart again. Here on Bitcoin, let's say I wanted to know if Bitcoin was going to drop below this low right here, just to get me prepared for whatever reason. Maybe I'm getting ready to potentially stop out of a long if it broke down this level, but not quite yet, but I want to be alerted if that happens, right? I'm not long Bitcoin. I don't have any position on Bitcoin right now, but let's just say hypothetically, if it broke down below this low, I want to know about it, okay? So I could draw a horizontal line and then I click this. And then as soon as I click this and highlight this, you can see there's an alert button here, okay? I can say add alert, and now it's gonna let me know when it is crossing this trend line, okay? You can say either once per minute, only once, right? Maybe you wanna make sure that this fucking tells you about it. You can say once per minute, it's gonna be like, yo, hello, 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 we're fucking crossing, we're crossed below, all right? So only once, whatever you wanna say, like, oh shit, I'm about to get stopped out, fuck my life. Right? I like to draw a little funny annotations because this literally pops up in my phone and like, fuck, shit. right? So it could either be for a good thing or a bad thing. But then you just click create alert. And now if Bitcoin drops below that price level, you're going to be alerted about it on your phone if you have the app on your phone, as well as a pop-up and a noise on your actual computer as well. So this is an extremely important tool that I use on a regular basis, is drawing trendline alerts that allows me to not have to be monitoring my computer at all times, but I get a notification on my phone or the actual application if this price gets crossed and alerts me to be, okay, Cam, time to be fucking prepared. Shit is happening. Time to go down, get to your computer or your phone ASAP and start taking action. So that is a very important tool that I like to use on a regular basis. Maybe the most important tool that I use actually on Tradingview. The other tool that we can use here is called the replay button. And this is more so just for practice, or if you're trying to visually storytell something. Like, for instance, we just got long on the NASDAQ futures, right? We bought in here, and down here. Let's say we want to look at the 1 hour chart, which we'll go into intraday changes here. And we want to see, okay, Cam bought in. Going forward, we can either click it frame by frame on the 1 hour chart. Like, okay, I got in right about there. Now we can just press play, and I bought in again here. And I almost got stopped out, but I added again one last time right down here. And now we're pumping back up to the upside. And now that's currently where we are. So it just allows you to either practice, if you want to practice trading, like, right? Like, okay, let's just say we wanted to practice this channel right here, just to base it off of, okay, what we're going to do if a scenario played out. So we could replay all the way back here. And now we have a blank slate. Even though we saw what happened in the future, we can try to analyze and look it over and be like, okay, let's see why these things happen, and try to use the things that we know about trading, technical analysis, psychoanalytics, all the tools that we use, so we can try to make better decisions. And so that's just an easy way to then practice by looking at the past. Obviously, that's what we do with technical analysis, look at the past to try to anticipate and understand how the mob is going to react in the future. Okay. Do I use it a lot? Not really. It's more so just for illustration purposes for me to show you guys if I did something or I made a good trade. Next up, let's talk about the time frames. Now, obviously you see the time frames up here, but you might be looking different than how you use it. All you got to do to add your favorite time frames to your chart. Again, I believe you probably have the same as me if you copied the actual template, but if you want to add more, you can click this drop-down box and either star or unstar the ones that you actually want to use the most. You can also create your own by selecting time, minutes, hours, days, weeks, months, range, and then add that, and it'll be a custom range to your list. But for me, 5 minute, 15, 45, 1 hour, 2 hour, 4 hour, 8 hour, day, 3 day, weekly, monthly are the ones that I use. Obviously, my most used time frame is just the daily chart, since I'm swing trading on a daily time frame. I no longer day trade, whereas I day traded the stock market for fucking 16 years, trading only the first 90 minutes. And when I was doing that, I was using between like the 1 minute, 2 minute, 5 minute, sometimes 3 minute, and an hourly chart and the daily chart. Those were kind of my time frames. It was a very short-term time frame trading. Now I'm swing trading, so I'm mostly using the daily chart, weekly chart, and then the higher, a little bit more higher time frame charts, intraday, like 4 hour to 1 hour. But so that's how you would do the intraday charts. Next up, guys, we got to look at the watch list and how you actually navigate the watch list and create watch lists, and also watch list sections. As you can see, I have like stocks for stocks. I have stable coins section for my stable coins, centralized exchange coins, commodity prices all here. Then I have just my indexes such as Bitcoin, Ethereum, US dollar index, gold, silver, US 30 index, German 30 index, my futures trading charts, the UK 100, Japan 225, Euro Stocks 50, Hong Kong 50, the VIX, and whatnot. Then I also have my other blue chip altcoins that are basically just ones that are high impact. Crypto coins essentially will show you how to actually add a coin and then create little sections. So to add anything to your watch list, you just click add symbol. And you can either go for all to see what kind of asset you want to add, whether it be stocks, funds, futures, forex, crypto. And let's say you wanted to do a forex, but you're trading with a certain source. Like our old partner, we actually just switched away from 8cap for our Hydrafunding partner. But if you want to look at, a chart that's going to be mimicking the actual chart that you're going to be looking at, let's say an MT5, 8cap is probably the most relative to what you're going to be viewing at Osprey. So you want to look at what they have at 8cap. Okay. So you could do sources from all forex, like say you wanted to do USD JPY. You can see there's all these different sources which is going to come from, which means the price of it's going to be different on all these exchanges. As weird as that is, prices of assets are never the same unless they're trading on the same broker or the same basically liquidity provider. So for instance, the NDQ 100 current price, this is basically on 8cap, of which is going to be the most closely related price. Current price is for the NASDAQ mini futures 14,964. But if we look at the NQ1 NASDAQ mini futures based off of the CME, it's 15,000, right? So 15,000 versus 14,968, 15,016 versus 14,968. So the price is quite different. So if you're looking at your MT5 app to trade the NASDAQ 100, right? But you're using the NQ NASDAQ E-mini futures, of which they're both the E-mini NASDAQ, it's going to show a different price. So your stop level is going to be different. Your entry is going to look different. So it's important that you're looking at the source that is most closely related to your asset. Let's say, for example, we're wanting to look at, we're trading on Bybit. So for stocks or for crypto, right? You can either, if we're looking at Bitcoin, you can see all these, you can look at the Binance, Bitstamp, Coinbase, Binance, Bybit. But if we're trading Bitcoin futures on Bybit, you're probably going to want to use the Bybit chart here to actually use that. And that's going to give you the most closely related price, because Bitcoin's price on Binance is going to be a different price than the price on Bybit. As weird as that is, they're all different exchanges that are trading with different volumes, different buyers, different sellers, but somehow the market efficiency works and it's very similarly related. But it's important that you're actually using the correct source when you're looking at your actual asset, right? They're all going to be relatively close. But if you're looking for, precise stop levels, like, okay, my stop is going to be here, or I'm not going to enter until 15,000, there might be a 100-point difference based on what you're looking at on the source here versus what your actual broker is, of which a lot of times we execute on our broker, but we're charting on Tradingview. So it's important that you're looking at the actual right source when it comes to that, so you can look at the actual same correct analysis. So that's how you would do it. You would click crypto. If you want to add crypto, then you want to sort by sources. You want to search what source you're actually trading from, or find one that's the most closely related in price. Now that we know how to add the asset and the source, maybe you want to then sort things like right here. I have the index. I also have the blue chip. I also have live. I also have the meta gaming crypto coins. All you would have to do is click this button up here and say add section. Okay. And now you have a section that you can drag anywhere in between. And then you would simply just grab and hold and say you want to add this over here to this section, drag and drop over there. And then you just click this, rename, new section, whatever you want to add it to. Okay, so that's basically how I organize my watch list here, but we're going to get rid of that because we don't need it. But anyways, guys, I believe that's about it for what I do here on Tradingview. Again, if you want to actually change to a different layout, I'll share this one as well as with you. I just call it whiteout, which is just basically sometimes I just want to look like I use this for the book, just because I wanted a clean chart, no indicators, no price bullshit, or nothing but price, and just have a clean look, because that's all we're really trying to do is understand price action. Everything else is kind of just noise, but it is confluence in different areas. But the most important thing we can understand at all times is price. The chart is the truth. The price is the truth. Everything else can add some, level of analysis, but the most important thing, as always, is price. So I'll give you this one as well. And then if you want to make this all white on the sides, again, all you would have to do is turn off dark mode, and then the entire chart's gonna be white. But I believe that's about it, guys. I think there might have been one last thing, of which I don't do, but you can. Let's go back to degenerate layout here. If you want to look at multiple charts at the same time, of which you can select this up here. And these are all different layouts. Say you want to look at 4 different charts at the same time. Back in my day trading days, this was useful for me, but now I'm looking at one chart at a time. I like to simplify things. I'm only swing trading things, so I don't need to be rapidly reacting to 4 different assets at the same time in a very small amount of time. So I don't use this at all. If this is something that's useful to you, great. But for me, I don't use it. And that's about it. But anyways, guys, that is the platform mastery. Well, it took about 40 minutes for Tradingview, but that's exactly how I use this platform to make money every day in the markets. All right, what's up, guys? Today in this video, we're going to talk about 3 different topics. And the first topic that we're going to talk about is basically what is a spot account versus a spot margin versus a futures account and kind of compare all those and what you should be trading and how you should be trading all those. Then we're going to talk about the order book, understanding the market depth when you're looking at all the open orders on the market right now and how to actually understand what any of this stuff means. It's very important that we understand all that because we want to know what low liquidity is, what high liquidity is, and understand how that can impact us in our trading. After we understand that, it's important that we go into the different kind of order types and understand when we should use different order types, such as a limit order, market order, stop limit order, and what have you. So let's get right into it right now, guys, and start talking about what is a spot account versus a spot margin account. A spot account, guys, is basically you're in full control of this account. You're not on a bank loan or anything. You deposit this money on whatever broker it could be. This could be a stock broker, forex broker, crypto broker. Spot just basically means you're trading cash for this asset. That's it. Right. And so basically, for an example, let's say you deposit $10,000 on your account, you can only trade with $10,000. There's no leverage involved, and you can only go long, which means you're buying low and selling high. Whereas a lot of people who are active traders also go short, meaning they make money when things go down. With a spot account, it's only for going long, and you can only use the whatever amount you used, whatever you deposited, which is in this example, $10,000. This is best for people who are wanting to hodl and hold for a long term because they're not looking to actively trade. If you're looking to actively trade, the next step after a spot account is just to apply for a spot margin, which is basically mean you're applying for margin on your spot account. And typically at any sort of broker, they'll give you anywhere from 2 to 10x leverage on your spot margin account or on your spot account. Say for a broker that gave you 3x leverage on your spot deposit of $10,000, you would now be able to go long and short $30,000 worth of assets because you just got 3x, 3-to-1 leverage on your deposit of $10,000. But now that you're trading with $30,000, you can still only lose $10,000. So the pro of this is that if you're right on the right side of the trade, you're now using $30,000 of capital, so you can make a lot more money, right? A 10% profit on a $10,000 account is $1,000, but a 10% profit on a $30,000 account is $3,000. But if you actually lose 10% on your $30,000 account, right, that would be a $3,000 loss, which actually is a $3,000 loss on your $10,000 deposit. So you actually lost quite a bit bigger. That's about 30% loss on your actual money because you can only lose as much as you actually deposit. So it's extremely important to know that if you're using leverage, yes, you can make more, but you can blow your account up that much faster because your loss is going to be that much bigger because you're trading with extra size. So that is a spot account versus a spot margin account. And a spot margin is basically the broker is giving you a bank loan at the actual broker. Now let's talk about a spot margin versus a derivatives or futures account. Okay, so one of the biggest differences between these two is that a spot margin account has a time limit on it, whereas a derivatives and futures market has no time limit, but there is a funding rate, and whoever is funding the short or long at the time, I don't really understand how it works. It doesn't really matter, but you might be getting charged a very small fee to be holding that position open. It's not really that significant. Yes, it's going to charge you a little bit, but I've never found it to be a significant amount. How it works, I don't fucking know. I don't care. The amount is very small, so it doesn't matter. But the difference also here is that, one, a spot margin account is you're getting a loan from your broker. Now, the derivatives and future contract is actually, the derivatives and future trade is you're actually making a deposit on a contract that you're agreeing to pay back at a future price. Whatever that means, I don't really know. I don't care. All I know is that you can keep in position open for almost as long as you want, as far as I know, and you're going to be paying a very, very small fee to keep that position open. Usually people who are trading futures and derivatives are short-term active traders. Sometimes the longest I've held a futures contract open is maybe a month and a half. That's usually about how long it takes for any sort of big market movement to make a swing, and then you're going to be wanting to get in and get out. So anybody on spot margin and in futures contracts typically aren't holding long term. That's what a spot account is for. We're here to make money actively and take advantage of short-term swings up and down, whether that be for 50 seconds or that's 50 days, right? That's kind of like the time window that we're looking for the active trades that we're doing. So for me, I mostly trade derivatives and futures markets. Now, there is also the spot margin account here. Difference is that time limit, and that's a big deal because when I first deposited money on Kraken back in 2020 to first start trading after I took a 2-year break from trading. I thought I was retired from trading after 16 years in stocks. I retired for basically 2 years, came back and was like, let me just fuck around with crypto, see what's going on. A bunch of people are talking about it. COVID just happened, so everybody's looking for shit to do. I stumbled back into trading in crypto. But what I didn't know is that I had a shitload of positions open and I was using leverage in my spot margin account. But all of a sudden, 30 days later, all those positions closed for like 150 to 200% gain because we were in the middle of the bull market, but they automatically closed because they were in a spot margin account, and there is a time limit. At Kraken at that time, this was back in 2020 or 2021, it was 30 days for that position, right? So that was a bit of an issue. If you're using leverage, you can only hold it for 30 days, and then they automatically close the positions. I woke up, all my trades were closed, and I was like, what the fuck just happened? So that's something that's very important to know. Also, spot margin accounts, the going short process is very, very complicated, and it's difficult, and it's very confusing about how to pay back the loan that you took on the short position that you're trying to make. So if you want to short the market, I don't recommend using a spot margin account. You should be using a derivatives or a futures market account, because all you have to do is click buy or short. That's all you have to do. It's easy. There's no weird loan payback process that happens in the spot margin account. It's very dumb. I don't even know why anybody would try to do it. I did it and I was like, why? This is dumb. And so then I just opened up a futures account. And a lot of times it's just as simple as on your broker, just transferring money. You go to assets, then you go to funding account, which we'll talk about later on the futures market mastery, and just transfer money from your spot account into your futures derivatives account, and boom, you're ready to trade, and you just click apply. So if you look at like here, spot trading on Bybit, you would go here, or you go to derivatives USDT. So they have base pair USDT, or they have USDC pair, which is going to be less liquidity and less volume actually, because most people use USDT. So spot, you can see that says 10x here. Okay, that means they're allowing spot margin. But the coins that have no liquidity and the volume is too low, they will not allow you to trade any sort of leverage, any sort of margin, because it's too risky and the volume there is too low. And we'll talk about liquidity in the next section and why they do that as well. But you can see only the 10x ones are available for actually using spot margin. So this would be the spot account. There's also the derivatives account here, which is much more active. It's more liquidity. And this is where everybody is actively trading the most to get in short or go long. As you can see, all you got to do is click open long or open short, open a trade or close a trade. Derivatives and futures are definitely by far the easiest way to go long and go short in your actual accounts. So I definitely recommend using the derivatives market. Now, the thing that people get in trouble the most with the derivatives futures market is the leverage is 10 upwards of 150x. Like at ZoomX, they offer, I believe, they don't do spot trading at ZoomX, but the best thing about them is that they do USDT perpetual futures with no KYC, so you can sign up for it and actually start trading, which there another video is explaining how to deposit on Coinbase or Kraken, buy some USDT and just transfer it to this broker, no KYC. You can start trading derivatives futures because you can't trade derivatives futures on the US brokers like KuCoin or Kraken, but they don't allow spot trading. The problem is you can leverage up to a ridiculous amount. Anybody using 100x leverage is fucking stupid, okay? I'm always at like 3, 5, or 1 because it's just crazy to try to use that much leverage. If you see someone posting screenshots using 50 to 100x leverage, they're getting ready to blow up their account, and that's dumb, okay? So that's the problem with futures, is it has this underlying incentive for people to make really dumb over leverage positions. That's basically the differences between all those different types of accounts. I trade with derivatives futures markets. Sometimes I would trade on a spot account if a chart is in a very good setup and it's not trading on spot margin or futures. As I said here, it's best for HODL or highly speculative coins that don't have enough liquidity to trade on margin or futures. So sometimes there's just the most perfect setup that are set up in the Krypton patterns that I talk about in my more advanced courses that I made a shitload of money on in the 2020 bull market because they were just there. And I was buying in with like $100,000 positions. And you'll see when we talk about the liquidity section in a second, it's very difficult for me to buy in and very difficult for me to get out. But they're in such a perfect chart pattern that if they go, they make huge, huge gains. The problem is it's hard for me to get in and hard for me to get out because there's no liquidity. And that's what we're going to talk about shortly, is understanding liquidity. And to understand liquidity, you have to understand how to read the order book. And we're going to talk about understanding the bid versus ask
an order book here as we go now. So if we look at the order book of any broker that we're looking at here, for instance, this is just an example order book. We have the buy side of orders down here, which is called the bid. And then we have the sell side of orders, which is called the ask, which is over here. And when we're looking at this, these are actual orders. This is liquidity that we're seeing in the market that are open orders that are pending to be filled, right? So these are all open orders in the order book. And this is the last price that was actually traded. And so what you have to understand is that these are just the open orders. A lot of times I don't have orders open, but I have a shitload of money on the sidelines getting ready. And there's fuckloads of people with money on the sidelines getting ready to place orders at any given time. Maybe news comes out, maybe they're just waiting for a certain price trigger, but you don't see everyone's plans based on this order book. This is just what's actually out there right now with people's orders actually open on the market pending to either buy. These are all people pending to buy or people pending to sell. So you have to understand that the order book is not the entire view of the market. There's a lot of people with money on the sidelines waiting for certain things to happen to then throw money into the market. That is the order book. If you can look here, basically at the futures, this is the futures order book. These are all the bid. This is the ask. These are all people bidding, saying, hey, I will pay $27,472 right now. And for them to buy that right there, somebody has to sell it to them. Okay. That's the current situation on the order book. Now, if I wanted to buy Bitcoin right now, I couldn't buy it at any of these prices. You have to pay the current lowest ask price, which is this price right here. So if I wanted to buy Bitcoin right now, I would have to buy it at $27,465.60. Okay. That is the current ask. That's what someone who already owns Bitcoin is offering basically to sell it for. And so I would have to buy it right here, right? Now, if I wanted to buy it at a lower price, I would have to put it somewhere below, right? What if I wanted to buy it down here at 27,000, okay? 406 down here, okay? I would have to put an order in there for it, and then it would show up here on here, potentially, if it was within the range that's showing up on the order book. And you can actually change the order book. Right now, it's changed by, sorted by 10 cents, but you can go all the way up to $10 per coin, okay? And that changes things quite a bit because now the increments shown are now $10 increments on the actual order book futures. So these are all the people who are willing to buy, but they haven't bought yet. And these are all people who actually own Bitcoin and they're offering to sell their Bitcoin at these certain prices, right? These people don't own Bitcoin, but they want to buy Bitcoin at these prices. And this is the amount that they want to buy in the quantity section. So there's also what's called the spread here, guys. The spread is the difference between the asking price and the bid price. So for example, the current ask price is $34.0962 and the current bid price is $34.0946. So the spread here is 16 cents. That means if I bought it right now at the ask for $34.0962, if I wanted to sell it, I would already be down 16 cents. I would have to sell it for $34.09.46 because that's the current highest bid. Someone's only willing, that's the highest price someone is willing to buy it for right now. But I could buy it from the highest seller right here. And then that the spread is important to know. If you're on a very low liquid coin or even some forex pairs, there's a high spread, such as USDX, right? This is a pair that I trade sometimes. You can see the bid and the spread, the bid and the ask is quite high. Right? Look at this spread. This is the bid, the green line. This is the ask here at 103. So the current bid is at 103.61, right? That's the highest someone is willing to pay to buy right now, 103.61. But the current highest ask is 103.82. So whoever is holding this right now, whoever holds USDX, they want to sell it at 103.82. That is the highest price. So if I wanted to buy it right now, I have to go to the people who own it, which is the people who are on the ask side. So if I bought it right now, I'd have to pay $103.82. And then if I turn around and wanted to sell it immediately, I would have to sell it to the highest bidder, which is 103.61. So that's what? 103.60 to 103.80. That's 20 cents. I would automatically be down 20 cents as soon as I bought into this thing. Okay. So it's important to know that sometimes the spread is a bit high on some of these pairs, such as USDX. Not always. The higher liquidity you go, the lower the spread. Usually it just kind of depends. Like if you look at here at Bitcoin's price, you can't even see the difference here because it's so low, right? But it's important to know that sometimes
there could be a spread that could affect your profitability instantaneously as soon as you get in to that. So that is the spread, basically just the difference between the bid and the ask on the order books. Now we're going to talk about the quantity here. Okay. So when you're looking at order book, on the left panel here is the price that they're willing to pay. And the quantity section, that is how much of that asset they want to sell. So at the current ask of 25,943, there are 40.56 Bitcoin listed for sale. These are the people who own Bitcoin and want to sell it, right? So you can see this price right here, which is the current ask, and that's how many Bitcoins are actually for sale at that price. People own this Bitcoin, and that's how many they want to sell it for, right? Then on the bid, right, the current bid price of 25,942, there are 40.511 Bitcoin offers to buy it, right? These people don't own Bitcoin, but they want to buy it. Someone is sitting on the sidelines here and they have 40 Bitcoin worth of US dollars and they were willing to pay this price for it. They're just waiting for somebody to sell it to it, right? So if somebody, say if you owned Bitcoin right now and you own 40 Bitcoin right now, you wanted to sell it, you could sell it right now to this guy. Whoever this is, whether this is one individual or a group of people who have added up into 40 Bitcoin, you could sell your 40 Bitcoin right now at the price of 25,942, because if you look at the bid, there's 40 Bitcoin for sale, or there's 40 Bitcoin that people are willing to buy right now, right? So if you want to sell it, that's who you go to right now. But if you don't want to sell it at that price, you could sell it somewhere up here. Like say you wanted to sell it at, this price right here, 25,948. And there is people there that are waiting for a price to get up there before they sell it at 12,845, right? So that is the current ask, current bid, and how to read the order book. Now the total section here is the other column. And this is basically just shows you what's called market depth. How much depth is there on this actual order book right now? So how this works is right now you can see the current ask, there's 40.56 Bitcoin for sale. So that total here right now is 40.561. But then we go up $1 from 943 to 944. At this price, there's 20 Bitcoin for sale, okay? So now the total market depth at this price is 61. That means for price to get to $25,944, 61 Bitcoin would have to be bought right here, okay? Because there's 40 here and 20. So all we're doing is adding 20 plus 4 plus 40 equals 61. That's where this number comes, by adding these two numbers up. And then if we add this price here, the total here of quantity now is 63, because all we're doing is adding 2.32 to this price right here, right? All we're doing is stacking up this number and then adding it to the number here, right? So this number plus this number equals this. This number plus this number equals this. This number plus this number equals this, right? And so it's just showing you for price to get to $25,948 right now, 103 Bitcoin would have to be purchased to go through this entire order book, because that's what's on the table right here. And it works the exact same way on the bid side, right? The total amount of Bitcoin for sale at 25,942 is 40.51. But then at 25,941, there's a very small amount here, right? Just 0.745. So all we're doing to get this total amount right here is taking this number right here, adding it to here, and that's what this number is, right? Then this number is this, or this number right here, 59 at 25,940. All it is this 41 plus 18 equals 59.43. Okay, so for price to, let's say, get all the way down to 25,937, someone would have to come in and sell 120 Bitcoin right now at the current price. And all that would do would wipe out all of this. All these orders that are sit here, all these people who want to buy, they would get to buy their Bitcoin, because that person, if they did a market order, which we'll talk about, would have gone through and sold to all these people. They sold 120 Bitcoin worth, and then price would get down to here. That's basically just the market depth, understanding how much volume is on each side. And it also gives you a bit of sentiment of where is the strength, right? Are there more orders stacked on this side or more orders stacked on this side, right? Gives you a little bit of ability to see where is the support. Are people in favor of the bid, which would be a bullish thing, right? If there was a shitload of orders, if these numbers were huge here on the bid side, that would be bullish. That would mean people are stacked up, ready to buy if price goes down, which would typically continue to lead price going up. And those orders would probably never even be filled because there's so many of them that people would be losing sentiment to the sell side. Be like, shit, there's so many buyers here. Price is probably looking to go up. But if these numbers start stacking up heavy, that's going to be bearish because it would take so much money to go through here for price to get sold that price would probably continue to fall down, right? So many people would have to buy to get through that wall that would be a bearish signal. And that means price would probably be moving down and the sentiment would be bearish. So let's talk about low liquidity versus high liquidity. So low liquidity here, guys, is the overall trade volume is extremely low. The market depth liquidity on the bid and ask is extremely low. Large orders will significantly impact price, and it's very difficult to buy in or sell out of large positions. Okay, so this is typically going to be your low cap or penny stocks on your stock exchanges. It's going to be your shit coins trading mainly only on decentralized exchanges like your fucking dumb cum rockets and meme coins and all that bullshit. All these idiots fantasize about making money where all the rug pulls are and everybody loses all their money. These are extremely low liquidity, or small cap coins trading on major exchanges, but spot only. Okay, and I'll show you examples of that shortly. Then there's where the big money is traded, and this is where high liquidity market depth is, right? The overall trade volume is very high. The market depth and liquidity on the bid and ask is extremely high. Large orders will not significantly impact price, and it's easy to buy in and sell out of large positions for most people. This is typically going to be your forex market. Futures indexes such as the US 30, SPX 500, NASDAQ 100, large cap stocks, then also Bitcoin and Ethereum futures as well. Okay, so let's take a look at a low liquidity shitcoin example. This is where people are fantasizing about earning 100x on their investment because they're fucking dumb and a bunch of dumb sheep cunts is basically what I'm saying here. Okay, so let's just take a look at an example here. This is a very cheap coin that was listed on the spot exchange of Bybit. Let's just take a look at how much money it would take to push this thing either up 10% or down 10%. Okay. So if we look at the order book right now, the current ask is 29 cents for a quantity of 683 coins. This is a token called DFI. Okay. So right now, to buy in at 29 cents, which is the current price, if you wanted to buy in at 29 cents, there's only $198 worth that you could buy, right? That's all you could buy because that's the only amount that's for sale, right? As soon as you tried to buy in more than that, it would just suck that up and then you'd have to pay 30 cents for it because there's at 29 cents, the current price, the only amount that's available to buy right now, the only amount that's actually for sale is 683 coins, which is only $198 worth of this coin, okay? So this is what I mean by low liquidity. It's very difficult to buy in and actually very difficult to sell out once you're actually in because the liquidity is so low. There's just not money there on the order book to fill your order because it's just a low liquid piece of shit coin at the end of the day. Now, where the people find the fantasy of the 100x on these coins is that it doesn't take a lot of money for this thing to pump 100%, right? That's where the fantasy comes in on these coins and why they can move so quickly because anybody that has, or if a group of people take $100,000 and start buying into this coin, this thing's going to fucking skyrocket. Problem is if they try to take the $100,000 and sell, it's going to completely dump the whole thing because the order book is so thin and they can't get in and they can't get out. So let's just take a look at an example of how much money would it take to push this thing 10%, right? So if we look at the order book, getting to 32 cents would be 10% move, okay? If we look at the order book and actually multiply the price times the actual quantity there that's for sale, price times quantity up to 32 cents. I've added it up here already. It would only take $3,906 of buy orders to push this coin 10% up to 32 cents. So only $3,900 could push this thing 10% because that's how thin and low liquid the order book here in the market depth of this actual coin is. All right, so this is a very speculative and dangerous coin to be trading. As you can see, what happened here, easily just pumped very quickly in a big move because the order book is so thin and it didn't take a lot of money to actually do this, only $3,900. But this is only with the money that's currently on the order book. There could be a lot of people on the sidelines that see if this thing spiked up all of a sudden, that all of a sudden could come and start placing orders and this order book could change in real time. Okay, so that's also something to factor. Now, how much money would it take for this thing to sell off to 10 cents, sell off 10% down to 26 cents? It will only take $5,700, $787, and sell orders would completely clear out this market depth on the order book here and push us all the way back down to 26 cents, which would be about negative 10%. So you can see how speculative these things can become. But also, if you're trading with any significant size, you couldn't even take a $10,000 position on this thing. Now, in 2020, I was taking like $100,000 positions on coins, not this illiquid, but quite illiquid. I would have to go buy in like 10 different times with $10,000. I couldn't buy in a full $100,000 at one time because the order book was so thin and liquidity was so low, I couldn't get in. And it also fucked me over a bunch of times because on the trades that did not work out, they didn't spike up and didn't hit my profit targets for me to sell into. If all of a sudden I was reaching my stop loss level, right? Say if my stop loss level was at 26 cents and I have $100,000 worth of this thing, I'm like, fuck, it's already bearish momentum, right? And then I'm trying to sell at $100,000 right here. I'm going to fucking tank this thing even more. Okay. So it's a dangerous and sticky game to put yourself in on these low liquid stocks or coins or whatever it is. If you're trading with size, if you're trading with a $200, whatever. A lot of these are traded with people who have a very, very small account and they're trying to turn $100 into $100,000 in a very short amount of time by trying to hit that 10, 100,000x coin, which is, it's dumb. It's not going to fucking happen. That's the problem with most traders is they might get lucky on one trade, but that trade taught them nothing about money management and how to actually keep money and grow it. So all we're trying to do at the end of the day is how do we make money and then how do we actually learn how to keep it? And then how do we learn how to grow it and manage it? Okay. So if we look at the depth sentiment based on what we know here, it's actually bullish right now, right? Because there's more buyers than sellers supporting price currently. We're going to see just by looking at this, right? If we look at the current bid of 28 cents, 16,000 coins on the bid right here, and then 3,000 right below it. But if we look at the offer, it's only 683 at the next offer on the ask. And then we look at the next one here, it's only 8,700. So we can see a significant amount more of buyers supporting the most recent bids on this side, right around here. Okay, right in this range. So the numbers down here, if they're bigger on the bid, that is a bullish sign. But if the most recent numbers are bigger on the ask, it is a bearish sign, okay, when you're looking at the order book. But you have to know that all this can change in real time. It's just what's currently looking at this point in time right now. So right now, the depth sentiment based on the market depth is still bullish. So if you wanted to sell out right now at the 28 cent price, you can only sell $4,500 worth. But if you wanted to buy in at the next price for the next ask, you can only buy $200 worth, right? So price is being supported by stronger bids, which makes it more bullish in the near term as of the order book right now. So let's just take a look at the example of a high liquidity example here on Bitcoin. And this is where big money participates. Why? Because this is their only choice, okay? Big money can't participate in something that's gonna move 10% with only $3,900, okay? So where do they go? They go to where the liquidity is because they can move big money around. Institutions, hedge fund managers, retail traders that are trading hundreds of millions of dollars or even just millions of dollars, they have to trade a liquid asset because that's their only choice because you need liquidity. Otherwise, you can't get in and get out at the prices you want because you're going to have too much slippage, meaning that you're trying to buy this coin at 29 cents, but you can't buy it at 29 cents. If you want to buy your full position, you're going to end up paying all the way up to 50 cents for it because you're going to go through all these orders because there's nobody to fucking sell to on the order book. But if we look at Bitcoin futures on Bybit, for example, okay, let's just take a look at how much more liquidity here is here, right? And we're looking at, I did it by 10 here on the actual order book. So if we look at it, it's 26,080 on the current ask, and it's 26,070 on the current bid. So to get through the next $10 of 26,080 on Bitcoin, there's 123 Bitcoin of quantity at that price, right? Which is $3.2 million. So to get through that price and get pushed up to the next price of 26,090, someone would have to buy $3.2 million worth of Bitcoin right now. Okay. And if we look at just basically on the chart, how much would you have to buy of Bitcoin on the futures just to go up 0.15%, right? We're not talking about 10% moves. We're talking about 0.15%. And if we add up all the way to 26,110, which is 0.15% move, and add up basically the price plus the quantity, it would take $22.6 million of buy orders just to push Bitcoin 0.15%. Okay, so that's just showing you how much more liquidity and how much more money it takes to actually drive price action up of a high liquidity asset. And this is why big money trades this stuff, because they need to have that liquidity. If they're managing a $100 million account, and they're taking a 10% position on Bitcoin, now they can buy in $10 million of Bitcoin relatively good. They could buy, $3 million worth at 26,080 and then $7 million worth at 26,090. Yeah, they would have slippage of about $10 there on Bitcoin, but overall, they can actually buy in $10 million worth of Bitcoin without pushing price too much. They would push it up like 0.06%. That's what's important to know about high liquidity versus low liquidity. I prefer high liquidity because even high liquidity these days can actually make decent moves. And the reason why you want to trade high liquidity, especially if you're on a funded account like Hydrafunding trading, hydrafunding.io, you're using a bigger position and you don't need to make a 10% move. If you're using a higher dollar size position, a 1% move can be significant if your position size is high. Okay, so that's what's important to know, that if you're using a larger account, which is why Hydrafunding is so important, you don't need to find a fucking dumb, degenerate, low liquid coin that you can't even get in and get out of. That's extremely hard to predict, extremely high risk. You can use a bigger account size to trade a higher liquid asset and make a smaller percentage return, but that smaller percentage return is translated into a bigger dollar return based on you trading a larger account size. Okay. And then to move this thing down 0.15% would take $27 million worth of sell orders, right? So as you can see, what is the depth sentiment as of right now based on, this is just the 5-minute chart of Bitcoin. The depth sentiment is a little bit bullish because it would take more money to move this thing 0.15% than it would to push it up 0.15%, right? It would take $22 million to push it up 0.15%, and it would take almost $30 million to push it down 0.15%. So the current short-term sentiment based on the 5-minute chart right now is a little bit bullish, but Bitcoin with the high liquidity, it changes much more rapidly. If we can look at the actual chart here, this is the 5-minute chart. You can see this is just similar. This is the order book, and you can see the stacking of the market depth, right? See the total is going up, the total is going down. So it's important to understand how that actually works in understanding the market depth. So that's high liquidity versus low liquidity. Now let's talk about order types. One, we have the limit order, stop order, and the market order. Now, first and foremost, in case you've been stuck under a rock, going long means you're buying low and selling high. Going short is going short or selling high and then buying or buying to cover at a profit to make money when things actually go down, okay? So first up, let's talk about the limit order. Limit order is basically you're setting a limit on what price you are willing to buy or sell at. So let's just take a look for an example right here. Say current price is right here, right now. Okay, this is the Dow Jones Industrial Average. And let's say you want to buy in right now, but for some reason you're trading with $1 billion and you don't want to push price up and you want to buy, but you want to put a limit on how much you're willing to pay. So if you put a limit right now at the current price is $34,858, but you don't want to pay more than $34,915, you could put a limit order in for this price with the current price right here, and you would be filled all the way up based on the order book size, right? The order book maybe wasn't big enough for you to fill that $1 billion trade. So you would fill all these prices, but if price started to drive up over here, your buy limit orders would stop because you put a limit on how much you're willing to pay. So that would be a buy limit based on the current price right now. But let's say price is currently right here, but you wanted to buy in the dip, right? But you didn't, and so you wanted to buy maybe if price came down to this little support level and you wanted to buy down there, but you didn't want price to fill until it got down there. So you would put a buy limit at that price down here, which is 34,612 right here. Then price, if it came down, it wouldn't fill that order until it triggered right there. And all of a sudden, if price is below 34,612, it would then fill that order right here, anywhere in this range right here, but it would not pay more than 34,612, right? Because there's a limit on what you're willing to pay for that price. So that's how a buy limit works. Now there's also the sell limit, right? let's just take a look at scenario one. Let's just say you're currently long and want to sell here. Okay, so say if you were long in Bitcoin, or this would be Ethereum, say if you bought down here, right? And your price target was somewhere up here, okay? Your TP, AKA, is what we call it. You would put a limit order in to sell at this price of 17.74, okay? And so price would basically just be doing nothing. Your order wouldn't do anything until it actually hit that price because you put a limit. You won't sell below here because you put a limit order on this at 17.74. So unless price is above that, it won't actually sell. So you can actually put a sell limit order, and as soon as price gets up there, your order will be filled to sell, but it won't sell it for anything less than that price because your limit is 17.74. Now, let's say price is here. You don't have any position, but you want to actually short this position, okay? So you could put a limit sell order short at 17.94, right? And so nothing would happen unless price went up to that level, 17.94. And as soon as it gets to 17.94, however much quantity you actually put into short, it would fill that order right here as best as it could, but it would not pay or short anything below 17.94. And then hopefully price would come back down and you would be in a profit. That would be a short limit order. Now, let's just say you want to sell it now, but not any lower than this price, right? Say you longed right here, okay? And you're like, shit, I'm about to go into a loss right here. And so price is currently right here, okay? At this price of about 17.23. And you don't want to sell it for anything less than 17.15, which is this price. You would put a limit order for 17.15. And at this price right here, you would be filled all the way up until this price hit. And as soon as it got below that level, since your limit is right here at 17.15, you wouldn't get filled for anything below here. So if price all of a sudden went here like in a microsecond and you didn't get filled in that range, you would have to either recalibrate what you want to do with that position because none of your sell orders would go through because it's now below your limit price here. So it's probably not that going to be a big deal if you're trading a high liquid asset. But if you're trading something like this piece of shit, say you put a sell limit order at 26 cents, say if price is right here, right? At the current price of 29 cents. And you're like, okay, I want to get rid of my $10,000 worth of this coin. And I'm going to put a sell limit at 26 cents here. Okay. You probably want to be able to fill the entire position because the liquidity is so low. And so you would only get filled as much as you can based on how much volume and quantity is in the order book. But as soon as it got below 26 cents, your sell limit would want to be able to fill unless price came back above that 26 cent limit price, then it would fill. But if not, if you had like $4,000 of this position left and price kept going down, you wouldn't be able to get out of it because your limit order was at 26 cents. You would have to cancel that order and then try to reevaluate the situation and try to get out at a lower price. So that's how a sell limit order works. Next up, let's talk about the market order here, guys. In a market order, I have it just the guy flying free because it basically just means I will buy or sell now at whatever price I can get in the fastest way possible. Now, if you're trading a high liquid asset like Bitcoin, Ethereum, US 30, any sort of forex pair, you're probably fine because there's so much liquidity in it and your position sizes are probably small enough that it doesn't matter, right? So market orders for me, for a lot of times I'm trading futures, it's not that big of a deal, but it's important to understand and be able to read the order book based on the asset you're trading because you might be trading a low liquid asset such as this one up here, okay, on the low liquidity. And it would be a very bad idea to enter a market order on this coin. Okay, let's say if you had $50,000, right, 50K, and you're trying to buy 50K worth of this coin, but you can see up to 32 cents, there's only $3,900 worth of assets of this coin to buy, up to 32K. So you would only be able to buy 46,000, or you would still have $46,000 left after you cleared out this entire order book here up to 32 cents, right? Now, if you had a market order open, it would just keep eating through all of this and probably push this thing up 40%. Okay, so you wouldn't only be paying 29 cents here at the base price. You'd probably be up here continually filling your orders up to like 75 cents, however deep this order book ran. And all of a sudden, next thing you know, price is at 29 cents. You just cleared out the entire order book with your $50,000 worth. And then now you're fucked because you're probably averaged in at like 60 cents when you tried to buy in at 29 cents. That's the danger of a market order when it comes to trying to do anything with low liquidity pieces of shit like this. So with a coin like this, if you're trying to buy in 50K, you would want to put maybe like a limit order at like 31 cents. Okay. Let it sit at 31. Okay. And as soon as price went over 31 cents, okay, your order would then show up here on the bid because price is now above it. And now your order would be showing up here and it would show your $50,000 order sitting on the bid, which would actually be a bullish sign to support price because it would take $50,000 to push price down below it. Okay. You definitely don't want to use market orders on a low liquid asset. It doesn't really matter that much on a high liquid asset. I use market orders all the time. Let's talk about using a stop loss with market order. So stop orders can sometimes be called trigger orders or conditional orders. But just for an example, let's just say you had an idea to buy into Ethereum at this price here of about 1720, right? And now you wanted to make sure you didn't lose more than a certain percentage on this position. So you would place a stop order down here at, let's say, 1695. Now, if price goes down to this level, at that level, it's also going to be what's called a trigger or a stop level right there at 1695. As soon as the current last sale went through at that price, it's just going to open a market order here, right? And actually sell that asset at a market order. So this would basically be called a stop market order. It's going to, as soon as that trigger is hit, it's going to open up a market order to sell that asset. Now you can use stop market orders on high liquid assets, but again, on low liquid assets, it's also very dangerous to use a stop order with a market order, because if it is a shit coin like the one that we've been looking at and you have a big position, it could just clear through the order book on the bid side and just drop price dramatically. And you're going to sell it for a very low price and get out of a shit price. So that would be what you'd want to do with a potential stop limit order. Okay. And that allows you to not only protect yourself from a bad situation of getting caught in a bad market order, but it'll also reduce the amount of damage you're going to do to the asset, right? So say if you bought here on this coin and you wanted to put a stop here if it broke down below 1933, that would be the trigger price. So as soon as price went here, it would open up your limit order. Say if you put a limit order at 1931. So now that would give you some breathing room here to allow your order to be filled within the order book between those two levels, right? So that would be a stop limit order, meaning that you hit the trigger, your order is open, then the limit is set, and now you have a little bit of a breathing room to sell out. But if price all of a sudden dropped below here, your order would no longer be filled below that limit, which would also in turn probably stop the bleeding from your large sell order, if you had a large sell order, right, on a low liquid asset. So stop limit orders, I don't really use this unless I'm using it on a very low liquid asset and it's highly speculative and I have a larger position than most people that would be trading that asset. I haven't done that in a while. We haven't seen those kind of active moves that are actually worthy since about 2020, 2021. In the next bull market, that could definitely be something that I could get back involved with once we see just everything flying and we see a bunch of really good kryptonite and krypton patterns set up on low liquid spot only assets. I could definitely transfer some money back into spot and do that again because I made a shitload of money on it in the 2020, 2021 bull market. But as of right now, I don't see it, but it's something that you should be prepared for when that time comes. So that's what we do with a stop loss and a limit order. Now, a buy stop trigger order would be like, okay, we're looking at this asset right here, which is gold. Let's say we wanted to wait for this thing to break out above this resistance line, okay, before we buy. So you could use a buy stop order, right? And that would mean, okay, we want to buy if gold gets over 1938. Okay, so we could do a buy stop order, however many quantity we want. And now if price reaches up here, as soon as it breaks out over that line, it's going to open up a market order for us to fill at 1938, however much quantity we want. Gold is a very liquid asset, so you could probably use a market order, no problem. Okay, so that would be a buy stop or a buy trigger, depending on what your broker is. I don't even know what Bybit calls them. Conditional, right? So it'd be Bybit, you calls them conditional, but this just basically means stop. Trigger price, order price on that. So you could do also, this is going to be a trigger with a order price of a limit. So this would be a buy stop limit, or you can do a buy market. You can see then the order price won't matter because all it is, it's a trigger price and the order quantity. Okay. So it's important to know what you're doing, whether you're doing a stop market or a stop limit order. Next would be using a short stop trigger order. Let's say price is currently up here. This is gold, right, up here, but you wanted to wait and then say if gold dropped below this little last low tick bar here, you wanted to open up a short position. So you could enter a short trigger, right, or short stop order, right, at that price of 1932. And now if price came back down to that level, as soon as it broke down there, it would then open up your short stop trigger order and a market order, and you would enter right here, and then hopefully price will go down and actually enter your order, right? Or you could do, if you want to do a short stop limit, you could say the trigger price is here at 1932, but maybe it's a low liquid asset and I want to get short at 1930 maximum. So you could put a limit order here. The trigger price would be here. As soon as that triggered, it would fill you as best as you can up until that price. If price dropped below that, it would stop filling your order. But anyways, guys, that's basically understanding everything we just went through, understanding spot versus futures versus spot margin, the order book, market liquidity, understanding the market depth, and then all the different types of orders and how all of that comes together into fruition. But hopefully you guys learned something. Anyways, that's it for today's training. What's up, wolves? Welcome to this very important training. And I want to go ahead and say right now that the things that we're going to be learning in this training are going to be the most important lessons that will determine your success and failure as a trader. What you're going to learn in today's videos that I'm going through in this whole little program, only this will determine will everything you've learned already from me be successful. And even in my most advanced training courses, none of that will matter if you don't understand and grasp the concepts that we're going to be teaching in this course right here. This is the crystal ball you didn't know that you've been dreaming of. This is nothing more than understanding risk management. And every big trade completely fucked up was not determined by me making the wrong trade setup decisions. My theories have always been mostly correct. The reason that I take big losses, and I have taken big losses in the past, have nothing more than to do with my risk management. If I failed to follow my rules of risk management, meaning I bet too big or I get FOMO and bet too big too early, by the time my stop losses hit, my loss is so big because I didn't properly manage the risk, I take a massive loss, or I get too emotional in the trade because my loss is so big because I didn't properly manage the risk. And 98% of traders fail out there, not because their trading strategy sucks, it's because they're not properly managing risk. And all that boils down to is setting limits on how much you can lose per trade, finding risk-reward ratios that are in favor of being able to have a losing trading ratio and still profit. And what I mean by that is you can have a losing rate of 70%. That means you're losing on 60 to 70% of your trades and still be profitable if you're using proper risk management. What I'm going to talk about today, is the determining factor for your success and failure for any training out there that you're going to take or any strategy that you're going to use. Let's get right into what we're going to talk about. Do you have this little companion here that I think you should read maybe even before you watch all these videos so you get a little bit more grasp, or you can follow along. I'm going to go through most of this stuff, but I'm going to skip through a lot of stuff that's in the text because I'm going to be using different examples for the actual video. Now, there's a section here that I call choosing to lose, and this is what makes you a loser. Because every time you enter a trade, you could be entering at a good time or you could be entering at a bad time. It doesn't really matter. But after that trade is live and opened, you now have the choice to get out for break even immediately, right? You can get out right now, right after you bought. You might take a small loss and whatever, just pay for your commission. But as far as your profit or loss goes on the actual trade, you could get out for basically break even right now. The only way that you can lose money on this trade is by choosing to lose. Even if it just goes slightly into a loss, you can sell right here for a loss before it gets too big, okay? Or it goes even bigger than a loss, bigger than a small loss. Now, you just chose to make that happen. You chose to let that loss get even bigger. So you cannot blame anyone else for losing other than yourself. And it's important that you understand that. And it's important that you understand that losing is going to be a very, very normal thing. My win to loss ratio is probably about 50%, meaning I'm wrong half the time. So how the hell am I making money if I'm wrong half the time? It's because I'm using proper risk management over the long run that enables me to have a 50% winning ratio or even less than that, losing 60%, and I can still profit if I'm properly managing the risk. And this is where all traders fuck up. And it all boils down to, again, them trying to get rich quick, which doesn't fucking work. No lottery ticket trade or swing for the fence trade is ever going to make you successful in this game, because exactly that tactic that you just used to make that big trade that you might hit every once in a while, and sure, it feels fucking great. You want to post about it, you want to talk about it, you want to tell your friends about it, but that same exact strategy that you use to do that, to make that happen, is going to end up in your failure. And here's the boring part about risk management, and it's going to be a little bit disappointing and probably rain on your parade a little bit, but using proper risk management almost ensures that you will never make a lottery ticket home run life-changing trade. And as sad as that is, that's just the fucking reality of trading. So grow the fuck up and get this idea of you getting rich quick out of your head. It's going to take time. It's going to take effort, discipline, grit, fucking hustle, and pure focus and pure control of your emotional state. Because the moment you break risk management rules is the moment you're out of this fucking game. And I know this because it's happened to me many, many times over my 20-year career. And I've seen it thousands and thousands of times happen to my students or just anybody else that I see trading, because everyone wants that life-changing moment to finally break free of whatever bullshit situation they're in. Say they got a small $5,000 account, like this fucking $5,000. What am I gonna do with 5,000? This needs to be 100. So I need to make this 100,000. So they swing for the fence. And I'll show you in a little bit once we get into this that you can make huge fucking gains even with these risk management rules in place. The bigger gain that you're going for, if you're still using proper risk management, the smaller window of a stop loss you have to have, which increases the odds of you getting stopped out in that position. And I'll show you exactly how that works. But I want you to know that there is still the opportunity to make fucking massive gains. But the bigger the gain you're going to be going for, the tighter your stop has to be, which then has the con of you more likely to get stomped out for a loss before that actually turns into a big gain. What I want to talk about next, guys, is the 2% rule. And really all this is it's a system that allows you to never lose more than 2% on your account for any given trade. This ensures that no fucking trade is going to be life-changing for you, mostly to the downside. And like I said before, the most important and crucial aspect of trading is not trying to focus on making money. Everybody wants to focus on making money. How do I make money, Cam? I want to make some fucking money. You need to stop thinking that way. As big of an oxymoron or ironic as this sounds, all you need to focus on is survival. Because as long as you survive through the bad times, which about half the year or more is going to be bad times or not the safe and most opportune market environments, the only thing that matters is for when those really good setups come, we have a lot of capital in our mindset and emotional state is in a proper, confident state of mind so that we can execute with our capital to make really, really big gains. But if you're continually going through wins and losses, and you're going through this emotional roller coaster, and also if you're not using proper risk management, you're losing a bunch of money, rather than staying flat and forward to the upside, you're fucking making a bunch of losses. And then finally, when the market comes up with a good environment and good trading setups, you're not making any money. You're trying to make up for losses, which is shit, because then by the time you get back to break even, or if you even just blew up your account maybe, but even if you did get back to break even, now the market's in a cycle where it's boring again. And then you give it all fucking back. And then you turn back into the cycle of when markets get goods again, you're now just trying to make up for losses for all the dumb decisions that you made before. Okay, so what we need to focus on is never losing more than 2% of our account, our total portfolio on any given trade. And so I have an example here of what that would look like. If we had a $100,000 account, of which I'll show you, I just opened up a $100,000 account at our new partner broker to start working with this model as well. A 2% loss maximum on this account would mean that we can never lose more than $2,000 on this account. I only recommend betting a 2% loss on any trade when things are fucking hot and you're confident, you're on a roll, the market's got all these perfect setups and you're ready to fire. I would typically recommend to start piecing into positions with a 0.25 to 0.5% on that account, which means that if you had a $100,000 account, based on whatever your entry is, if your stop loss is hit on this trade and you were only betting 0.25, you would be able to lose a maximum of $250. And if you were using a 2%, if markets were good, you were confident in your trading strategy, if your stop loss would hit, you would lose $2,000 on that $100,000 account. So there's different ways of calculating how this can happen, but I'm going to show you multiple ways. One, I go through the calculation of how exactly to do that here, but I even built a spreadsheet for you here in the Iconic FX risk management. So basically all you would have to do is go in here. Okay. account size. Well, this is probably, you're going to probably have to go to file and then make a copy and then add it to your Google Drive. You enter whatever your account size, you enter whatever your risk loss is going to be. And you can also do a 6% rule per month. So if you ever lose more than 6% of your account in that single month, you have to stop trading for that month and then take a break, because that's one of the biggest mistakes we also have is revenge trading. If we go through a string of losses, sometimes you might be like, well, fuck, I just lost $6,000, but I can only still risk 2%. Maybe I'll bump this up to 5% because I'll have bigger wins. Okay. But that's never a good idea. I never suggest going over 2%. At that point, you're trying to get rich quick and you're going to get too emotional. When the trading losses get too big on a dollar amount, you're not going to be able to handle that. So let's just say, for example, on a long trade, right? We want to risk 2% and our entry price was at 55. Just an example on a chart. And we decided that our stop loss was going to be 48 cents. Okay. And our target was 0.72. First of all, we'll talk about this in a little bit, but every trade that you make, the loss has to be at least half of the reward, meaning that the reward per coin has to be double than the risk. And we can see that here, that the reward per coin is 17 cents based on the entry price to the target. And the risk per coin is 7 cents based on the stop price per entry. And so what this does is now calculates, okay, based on a $100,000 account and based on our entry and based on our stop loss, then we could risk a maximum of $15,700 on this trade. And it'll tell you exactly how many coins or forex pair contracts or whatever stock shares you're wanting to buy. So now we know that with our entry price is 55 cents, we can only lose $2,000 or 2% on this trade, which is here. We can only buy 28,571 coins or shares or whatever we're trying to buy on this trade, which means our profit, if our target is hit, is $4,800. Our max stop loss is going to be $2,000. And our risk reward ratio is 2.42, meaning that our reward is 242% larger than our potential loss, right? That's 2.42x, 2.42 times the amount of our loss. So that would be the long entry, okay? You can also do it for a short entry if you're looking for a short. So really, the only thing that matters in this risk management rule is, one, is what is your account balance? What is your max loss? 2%. And then also, the only thing that ever matters than that is the stop loss. So your stop loss level that you determine from your entry, that is what calculates how many coins or shares or futures contracts, whatever you're doing, you can buy of this asset, and also tell you exactly how much. Now, there's another way to do that based on Tradingview. And I have another way as well that we'll talk about as well. This is the Tradingview example that I'm going to show you here. And you can see actually that this was the Dow Jones, just theoretical setup that I was showing you right here. And you can see that the Dow Jones actually did break out of that pattern here, right here. So let's just say, for example, you wanted to enter a short position here on the Dow Jones. You would go to where the short position here. I have it all on the my favorites here, but you could go to short position, enter where the current price is where you're wanting to get in. Let's say you wanted a stop loss if it breaks out over this high, but you want to kind of lock in a gain if it comes back up and retests this ascending trend line. So what you would do is go to settings, inputs. Let's say your account is $100,000. You want to risk, let's say, only 1% on this trade. Okay. Now it'll show you right now that based on $100,000 and your entry of the current price right now and your stop loss here and your target here, your risk reward ratio is 2.1, meaning your reward to the risk, your reward is 2.7 times larger than the risk. And you can enter two contracts basically to get short on the Dow Jones right here. So basically you could buy 2 shares at $35,314. And if you got stopped out here, you would only lose $1,000 because you're risking 1% of your account. Okay, so this is extremely important that we understand this logic and understand that it doesn't matter. Everyone's always like, I see people betting like, oh, I'm going to bet 1% of my account here. I'm going to bet 20% of my account here. But what the fuck does that even mean? What about how much are you going to lose of your account if your stop loss is triggered? That is the only thing that matters, is how much are you going to lose if your stop loss is triggered. Okay, and that's where the 2% rule comes in. It ensures that no single trade is ever going to do so much damage to your account that that'll end in your demise. Okay, because if you lose 2%, yeah, that fucking sucks. But whatever, it's 2%. It's not 20%, which is very easy to lose 20% if you're not using these rules. If you say you have $100,000 in your account and you're like betting $30,000 position, but if you take a loss on that position, you're losing 10,000 bucks or something like that, something stupid. Okay, so all that matters is where's your entry and where's your stop and how much are you gonna lose when your stop loss is triggered. This is why, again, I say you need to stop focus on winning and making money and focusing on what's going to happen if this trade goes south. What's going to happen if this trade doesn't work out? Because that's all that matters, is learning how to survive in this game. All right, guys, we're about to answer some of the most important questions when it comes to trading. And it's a question that I get from fucking strangers all the time. If you have to ask anybody these questions, you don't belong in trading. And the questions that I'm talking about are, where do I buy and where do I sell and where do I put my stop loss? Until you can answer those questions yourself, hey Cam, is it still a good fucking buy here? Should I still buy here? God fucking damn it. Why are you asking me that? Okay. If you don't know how to answer those questions, you have no business trading, and I promise you're going to lose money. So that's what we're going to talk about right now, is how do you actually answer those questions so you don't have to ask me and you can become a self-independent trader. And let's get right into it right now. So again, there's a few examples that I have in the text version of this training that you can walk through. But we're going to kind of just go over a brief example of some other things as well, but kind of follow along this as well. So first and foremost is, where do we put our stop loss? And typically you want to put it below the most recent major support level that would break down and essentially break the pattern that we're trading, right? If this recent low pivot broke down and started trading down below and also broke both these and also broke the ascending trend of the ascending triangle, guess what? That means that this is no longer an ascending triangle and that pattern is now broke. And so maybe we shouldn't be looking at this in the perspective of what we were looking at, and that pattern is broke. So we should stop out of that trade. Okay. So we need to be looking at the most recent low pivot that would break the structure of the pattern that we're trying to trade. And that's where we need to put our stop loss. Not exactly at this level, because this is where stops get hunted. And a lot of times there's usually one last, what we call a liquidity grab. It's where the market makers or whatever who's manipulating the market push price down, take everyone's stops out, and then finally the move goes in the direction that you want. And I hate to say it, but there's going to be plenty of times where you get stopped out at the fucking bottom with your stop loss, and then price is going to go back up in the direction that you wanted to go. It still happens to me today, 20 years in the game. There's no perfect way to set your stop losses, and the markets are increasingly getting more and more volatile, which means just crazy moves happen where there's a bunch of big swings intraday in either direction, stopping a bunch of people out before the final move goes into fruition and moves in the way you want. But the only thing that we can do is never put our stop loss at the support level. We need to put our stop loss below that support level in some sort of range that gives us a lot of breathing room, but still using that 2% rule so that we don't get stopped out before the actual move that we are looking for takes place. All right. Then we have the target, and the target is the even easier for us to actually go for, because one, we can just use your pattern projected target, which gives you a theoretical, extended move from the pattern. Or we just look at where are the next high pivot levels that we can actually look at from a resistance standpoint. So for this one, we're just looking for the next high pivots, which would be right around here. And of course, from there, we need to calculate 2-to-1 minimum risk to reward ratio, where our reward is at least 2 times the size of our risk. In this example, right? Okay, 1-to-1, obviously, no, we're not taking this trade. But in this example, the pattern projected target, as well as the next major resistance levels, are over a 2-to-1, upwards of a 3-to-1 risk to reward ratio. Okay, so this is a good looking trade. We can enter this trade and go live. So that's kind of just how we answer those questions. Where do you put your stop? One, it has to be no more than a 2% loss in your total portfolio. And it has to be not at the most recent support level. It has to be below there, because there is going to be liquidity grabs where people get stopped out at that level. And we don't want to be part of that dummy section where they get stopped out before it goes back up, but it's going to happen. And then again, profit targets are just where the next major resistance pivot levels, and as well as where's the next major pattern projected target. So we can take a look at a trade that I did on Wild here, and this is the actual trade that actually panned out. My entry was right around here prior to the actual breakout. My stop loss was going to be below the most recent low pivot right here, as well as that would have broken down the potential structure of this ascending triangle that was forming up here. Okay, and I also anticipated this happening after it tested once, twice, and then right before the third time, I got in, And then the first target that triggered before it kind of stopped in price was right at that recent high pivot. Then the second stop that happened for the target here, where price basically stopped out before actually pulling back, was right at that high pivot here, the closing prices of the high pivot candles, and then the extended wick there as well. And the target 2 was hit there. And I ended up locking in about $47,000 on that trade based on the simple pattern. You can see what happens when you don't lock in gains in many situations, which is why the Degenerate MT5 app is so good, that you're locking in a grid. As price goes in your favor, look what happens when you don't lock in profits. It goes all the way back down, potentially hits your stop loss or break even. I could have given back $47,000 in profit if I didn't take any along the way. Okay, and I didn't sell at the top. I sold here, I sold here, I sold here, I sold here, and I sold here. Okay, in a grid along the way up, and it averaged out to be about $47,000 in profit. So let's just take a look at the setting up a trade plan process summary. We can look at just a theoretical example of XRP in a similar setup that we just looked at to this. We're going to look at basically this exact setup based on the chart of XRP, and how would we set up a trade plan based on the step-by-step process of how we can do that. So first thing we need to do is identify major horizontal support and resistance levels as the foundation of your trade. So we can look at XRP here, and we can see, let's look at the high pivot levels where we can draw some resistance. We have this, the closing price of this candle and the high wick here. And we also have this one right here, the closing price and the high wick here. But we can basically look at it like this. We have the high wick here. We'll take the closing price here to the high wick of this. So we'll basically draw this across on XRP. The closing prices of the highest pivot as well as the highest wick right there. We can see how price came back down after that, rallied right in that level. It never closed above it, right? It was only the intraday wick that went above it, and it didn't confirm above that level, and then came back down, retested that area again, and then came back down, and now it's back in this level here again. So that's kind of where we're looking at on the horizontal plane for support and resistance. The support level here on a horizontal plane would be all the way back down here, okay, at about 30 cents. Now we can look at step 2, which is identify trendline support and resistance levels and look for areas of confluence that could be creating super support or super resistance. So we can look here. We do have ascending support going on right here, right? Essentially tapping here once, twice, now 3 times, and now we have ascending support. And basically, what is this? This is an ascending triangle formation pattern that's breaking out here. Do we have any descending significant levels here on resistance? We could say, I mean, this one's not going to work here because that already broke out to that side, okay? But we could look at this, potentially like here, okay? Even like this, right? So that would also be potentially kind of a significant level, right? We can even draw it from there. We can draw from this point here. We can see that it tapped here. Now we can tap it here. Also tapped here. And now tapping it for a 3rd time here, okay? So you can see kind of the longer term descending trend forming out. And what is that also? That's kind of like a symmetrical triangle breakout. So now that would kind of be like a longer term potential breakout signal right here before it actually broke out above the horizontal level at about 54 to 55 cents. Step 3, use trading indicators like RSI and MACD, which are noob level, or degener shift and fear and greed pro level to find areas of confluence between support and resistance in overbought and oversold territories. Now, I will say when we're trading breakouts, guys, it doesn't really matter what degener shift or fear and greed are doing. I typically only use degener shift and fear and greed, or if you're using the free versions like RSI and MACD, not necessarily for looking at if things are going to break out. It doesn't really matter where they are when things break out. Things just fucking fly. It's mostly only for looking for potential areas of reversal to be locking in gains at the top or shorting at the top, or be locking in gains at the bottom, or be buying the dip. So I only use fear and greed and degener shift for looking for extreme areas to be looking for a top reversal or a bottom reversal. But to find a condensed breakout after compression, right? Breakouts are typically compression followed by a reaction. It doesn't matter where the RSI, MACD, degener shift, or fear and greed are at within a compression period before the breakout happens. Once the breakout triggers, all those kind of indicators don't really mean anything. So in this case, we're not trading reversal, we're trading a breakout, so we don't really need to use that. Number 4, using moving averages like degenerate trend to gauge short-term trend sentiment. Right now, we can see that the degenerate trend is in fact bullish, and we're trying to buy a breakout here. So that's good to see that we are now bullish on the short term. Step 5, identify flag patterns that could trigger short-term movements within the overall larger pattern. So XRP, we can see, did in fact come back down if we're watching this prior to this happening. And we're noticing that there's a potential ascending triangle breakout formation here, as well as the longer-term symmetrical triangle breakout that would trigger right around here. Okay, so now at this point, what we should be doing is not be waiting for a breakout to happen at 55 cents. We should be anticipating getting prepared for a potential entry before it actually breaks out here. So in this case, we can see it bounced right here near support. Also, we're back above degenerate trend, and we can also see an intraday bullish flag that actually, not an intraday, but a shorter term bullish flag that actually broke out here, right? So now we came back up above degenerate trend, came and retested degenerate trend in a bullish flag, then broke out right here. So this could potentially be a signal for now a new move to the upside, which would also be another bullish buy signal if we broke out above this descending trend line right here to start pushing to the upside and finding more momentum, okay? Step 6, use the 2% rule in our knowledge of support and resistance levels to set up your entry, stop level, and find out how much of this asset you could buy or short. So for the next example, let's say we need to set up a long trade. So a long position, let's say we wanted to enter at this price right now prior to it actually breaking out, but we're anticipating based on the pattern that's happening right now that we're looking for a long setup, okay? So we enter right here. We want to put our stop below this level, right? Not at this level. We want to put it below this level, okay? So that if there is some sort of like intraday breakdown, if we came back down here, now we're at this level, we don't want to stop out if it breaks down below this right here, okay? We want to potentially have our stop below this. So if there is some sort of intraday wick happened, one of these curveballs like this, right, that happens here, we don't want to get stopped out on that. We want to be able to survive the game for if this does kind of break out, and if it's just an intraday thing, of which there's always these crazy intraday wicks that look like they're breaking the pattern and then reverse back, okay? But you do need to have a stop in place, because if you don't, if that doesn't turn into an intraday wick reversal and just keeps going, and all of a sudden you're down here at a fucking massive loss, that's where you get yourself into trouble. So there's going to be periods of times where you do get stopped out, unfortunately, on an intraday wick. But in the long term, you're going to regret not having a stop in place, because sometimes it's not going to be that intraday wick that reverses. It's going to be the fucking real move. And you're going to end up down here, and you're not going to be following your 2% rule. Next thing you know, you're going to be down fucking 20%, and you're not recovering from that. Okay? You're not recovering from a 20% loss. You're going to fucking revenge trade it, try to make it all back, and it's going to snowball. And you're going to blow up your whole fucking account. So you have to have a stop loss in place. I've been through this many times. Even recently, that fucked me up. I lost $100,000 on Bitcoin by not having a stop in place overnight, thinking it was an intraday wick. And I was like, you know what? It's fucking, I was in South Africa. I was like, okay, I'm fucking tired. It's like in the middle of the night, almost getting ready to go to sleep. It's like, okay, this isn't going to fucking break out. This is too crazy. It's not going to do it. I just had confidence that it wasn't going to be the fucking actual move. What happened? It turned into a fucking, the real move, the real fucking breakdown or breakout. And next thing you know, down 50K, then 80K, I wake up, I'm down like 100K loss. I'm like, fucking shit. And that's why you have to have a stop loss in place. I did make that 100K back relatively quickly right afterwards, but now I got to make up 100K. I shouldn't be down 100K in the first place. So you'll find out quickly enough if you find yourself in this position and you don't set a stop, how easily you can turn into a losing position that you're going to regret not having a stop. So we want to put our stop loss somewhere below that level to give us breathing room if this ascending trend breaks down right here and this support breaks down right here. We want to be able to handle an intraday wick that breaks down, fakes everyone out before the actual moves happen. Okay. And also we go here, 100,000. Let's say we want to risk 2%. Now we know we can buy 5,646 tokens of XRP at the current price with a 2% max loss at about 37 cents from our entry at about 46. Step 7, identify the next major support and resistance levels plus pattern projection target to see if the next potential area where price could push into is at least a 2-to-1 risk-reward ratio. Now that we're buying in, anticipating this ascending triangle breakout, the next major resistance levels here are these high pivots back up here, of which we can now draw right around here, right? That would be the high pivot about 91 cents. There's also this pivot here. Let's zoom in. We can actually get rid of the indicators since we're trading a breakout, so those aren't as relevant right now. The high pivot here from the closing price, $1 per coin. And we also have, if we look at the kind of intraday lows of this right here, we also kind of have this little pivot area here. And this one almost, does this drag all the way across? Yeah, look at that. Look at this. This is the area drags right perfectly across to this low here. Okay, so look how perfectly that kind of works out from horizontal planes. So now we have these levels, okay? And now let's take the pattern projected target. We can take the range tool. We have the high of the pattern here, the low of the pattern here. Actually, it would probably be this because we have the high here. This is the beginning, so this would be the secondary low. So we can bring here, drag that across up here if this broke out above this level. All right. Now we'd bring our top target to that, and that would give us a risk-reward ratio of 3.14. So our reward would be 3 times higher than our potential risk and stop out level here. But the next major resistance levels aren't up until here, okay, which would give us a huge risk reward ratio of 4.98. Okay, so this, as of right now, is still very early in this pattern. It still hasn't even broken out of this ascending triangle, but there's indications that it might be, right? We're breaking out of a bullish flag. We're above the degenerate trend. If this breaks out above this ascending or descending trend line here from this longer term pattern, that could initiate the potential ascending triangle pattern that we're looking at right here. So let's just take a look now that we've kind of gone through the whole process of setting up a trading plan on this 7-step process. Let's just take a look at exactly what happens with XRP. Okay, there it goes. Retesting the ascending trend, horizontal support. Retested the triangle trend right here. Boom, right? Or the retested the ascending trend right here. Never went down and broke down this level right here, but there was one last pullback here that happened right after this spike right into this level. Look at this. Looked like it was breaking out again, faked everyone out, came back down, retested our potential entry area here, never broke our stop, but look where this actually went, right into that next major resistance level here, guys. And now it's back down. It did break down the degenerate trend. So right now it's actually short-term bearish on this trade, but overall, that was a quick, big money opportunity, right? This was the news. This was XRP winning the case. So it was a one-day spike that broke out, but this all was triggered initially by this setup. And you can see this exact same pattern happening before, also back here, right? Same exact pattern, okay? We have the tops here. Can even drag this here all the way back to here, here, and here. Ascending trend going on right here. Followed by the breakout, of which this was my entry into the crypto market. I started buying XRP in about 25 cents, anticipating this happening. But you can see, look at what happened right here, right? It looked like it was potentially breaking down of this, but that was just a liquidity grab. It didn't break down below this low, but it was attempting to break this ascending trend. And then that was finally the move right here that pushed to the upside, okay? But this was a huge trade for me on XRP, this triangle breakout to the upside. And I also participated in this one as well. I actually did buy about $100,000 at 50 cents. And then I added at about 59, I think it was. Right here, $10,000 is like fucking 1 in the morning. I woke up and I saw XRP won the case. I added $10,000 and I added again right here at about 71. Now, this isn't a trade for me. I think XRP has a longer term potential in the next bull market, especially now that they have won the case. So this was a longer term hold and I wasn't planning on selling. But if I had woken up or been awake and it wasn't 1 in the fucking morning and the XRP case had won and it was sitting here at 59 cents and I wasn't half asleep, I would have taken an open trade and I would have locked in right at this profit target right around here. Okay, so that's just basically an example, the 7-step process of answering those questions. Where should I buy? Where should I sell? Where should I set my stop loss? And how the fuck do I get out of this trade? And how do I understand all those questions? And if you can answer those questions yourself, that's what creates a self-sustaining trader and the person with the capability of becoming profitable in this game. Hopefully, now that after watching this brief training here, you have a better idea of answering those questions yourself. That's it for this training, guys, and I'll see you in the next one. All right, next up, guys, we want to talk about finding your edge in the marketplace and what exactly does that mean? And we're also going to further elaborate on those questions that I get. Is it still a good time to buy? And where the hell do I buy or sell? And kind of how we anticipate the logic of those questions in the first place. We're also going to talk about another concept of that based on the fact that people ask me,
hey, what is the good things to buy this week? That's a stupid question to be asking. There's actually 3 questions that you should be asking, and it's all based on if-then statements. And we'll further elaborate on that in this video as well. But first and foremost, we're going to talk about an edge. And so what is an edge? An edge is simply having some sort of knowledge or deep understanding of what might be coming and anticipating before that actually happens, right? Most of the time when you see some sort of stock or crypto move and it's up 100%, only then are people talking about it, right? Only then is it trending on Twitter. Only then are you talking about Bitcoin with your aunt and uncle and grandpa and grandma at the dinner table after it's already up 300%. The key to having an edge, and the only way to make money in the market is to have an edge, is to identify, anticipate before that happens, so that by the time people are at normies, normal people, and sheep are talking about potentially buying after it's up 300%, you're already getting prepared to sell, or you have already sold because you had an edge over them and you had a deep understanding of price action and how this neural network of traders and lack of knowledge participants think. And so we want to take advantage of everyone else's stupidity, and we want to get in early enough so that by the time everyone's talking about it, by the time CNBC is talking about it, by the time it's trending on Twitter, that's just all pushing price action up to the upside, giving us liquidity to sell into. And it's also giving liquidity for all the big wolves out there, the hedge funds, the institutions to sell into, right? Because if all these institutions and hedge funds have these, hundreds of $1 million position, they can only sell if there's liquidity. And by liquidity, I mean a bunch of fucking idiots that are stupid enough and emotional enough to buy after it's already up 300%, right? Because if they try to sell when everyone else is trying to sell at the same time, it's just going to collapse the market. It's going to collapse whatever asset that is. So what they need is liquidity. They need a bunch of fucking idiots out there, a bunch of sheep to continually buying, giving them liquidity, people to sell to, essentially, right? And so that's all an edge is having a deep understanding of how this mob works so that you can get in early, and then you have dumb enough people to buy at prices where you can now be selling for profit. And so we're going to take a look at this on a deeper level. And the question, is it still a good time to buy? I don't want to miss it. Should I buy now? Someone please help. These are common questions that I get asked all the time. And I'm sure you have experienced yourself asking those same questions as well. When Bitcoin's at 60,000, is this still a good time to buy? You probably asked yourself that question, or sat at a dinner table or in Telegram groups or with other people in your network. Is it still a good time to buy Bitcoin at 60,000? Even though it had just ran from like 10,000 to 60,000 in a few months, right? So you are now a sheep. Now that it's in the headlines and everybody's talking about it, it's too late. The risk reward for that trade is over, okay? And so what we're gonna look at here is kind of this risk of investment timeline of how every trade plays out based on this fact, and based on the fact of having an edge versus not having an edge. So when we look over on basically the price of a chart, we can see that the risk of investment on this timeline is low. But at this point, maybe only one wolf or a few wolves know about it, and price is down relatively low. And as price accelerates to the upside, a few more wolves start getting wind of what's going on here, and they're starting to anticipate what is coming. And so more wolves are finding about it, right? I have the diamond here because it's basically a diamond in the rough. A lot of people don't know about it yet. And then as price continually goes up, the risk of this investment is increasing to now a medium risk investment. Beyond a medium to high risk investment, wolves are no longer participating in the buying of this asset, unless potentially they're manipulating asset to continually to drive up the price and push price higher. This is also a potential possibility. It's not something I'm capable of because I don't have the capital to do that, but I don't doubt that there's institutions out there that support the bid, which is the buy offers that can continually drive price action up, whereas all the sheep are continually buying at the ask, which is the above price that we can talk about in a much deeper later training, talking about like level 2 in order books, but they can support the rise of the price action, okay? But they're not necessarily buying. It's the sheep that are buying. And by the time everyone is in this mob of chaos and talking about it, the price is now skyrocketed. It's up 200, 300%. It's in the headlines. Everyone's talking about Bitcoin at all-time highs. Should you buy now? And at this time, the risk of this investment is extremely high, and it is stupid to be buying up here. And you're a fucking super sheep, and things are getting ready to come crashing down. The question here is, when does it come crashing down, right? Things can typically go higher than you expect, which is why shorting these
parabolic moves can be extremely risky, but also extremely rewarding at the same time if you're on the right side. But things can continually go much higher than typically you would expect. But at some point, it comes crashing down. And that's when all the sheep who were dumb enough and emotional enough to buy on the risk of investment timeline in a high period, because everyone's talking about it. The wolves aren't talking about it. The wolves are talking about, look at all these fucking idiots out here buying up here when we're getting ready to sell because we anticipated what was coming, because we had an edge over the other people by having a deep understanding of price action. All right, guys, so I just want to further elaborate and look at some of those examples. Again, a great example of this kind of wolf versus sheep mentality, again, was that XRP trade, as well as the trade on Wild, right? Getting in down here when the risk of investment was still low. And then by the time it's up here and here, people are talking about like, oh, Wild is back. The metaverse is back. Everyone's super bullish. And then what happens? Boom, comes crashing down. Same thing when we look at XRP here, right? Boom to the upside. Everyone's talking about it now. XRP is going to the fucking moon. Boom, all the way back down here. And I even made several videos on it saying, is XRP still a good time to buy up here? And I said, XRP is going to be a good time to buy between 71 all the way back down to 55 cents, because I do believe that we're going to see a dip buy opportunity down there. And that's exactly what we're doing right now, going back into that level where it's now becoming a better buying opportunity, as opposed to buying up here at those previous resistance levels that we had talked about up in this level, because the risk of investment on this timeline is extremely risky now. Now, the other question is, and I'm going to show you an example of my trade on Bitcoin, is if things have already gone up to a certain point and it's already high, is there still shorter time frame opportunities to still make money as things go up? And the answer to that is yes. So we're going to take a look at Bitcoin. We're going to actually rewind the clock here a little bit. Back to here. When we're looking at this on Bitcoin, we have used this example many times for this support. That was support here at about the 30K level at these low pivots here that we can draw across that have been significant over the past since 2020 when this first all began. And now that was good support. And now it's extremely strong resistance. And we know that price is probably going to be drawn into this level. And we saw a massive move from 16K all the way up near 30. And when we're that close to this level, especially like an even number at 30,000, it's likely that we're going to be drawn towards that. And I'm going to talk more about reversals later in my more advanced trainings. But typically, when you see a reversal and a strong reversal off a resistance area, you're going to see something that looks like this, a spike into that level, and then a quick reversal back. That means prices were rejected off that level, and that could be a good shorting opportunity to get in on the first spike. But the problem is, what happens if that isn't a quick reversal off the top? What if things start spiking to that level and then trading sideways and building compression? What is that? That's actually a bullish flag formation, okay? And that means that it's becoming a higher probability that that compression is going to lead to a reaction to the upside. And that's exactly what we saw here on Bitcoin. Even though this made this huge spike and rip to the upside, rather than seeing an instantaneous pullback off of this level, which is a significant resistance level, it never reached 30K. And rather than spiking to the downside and staying down, it started to trade sideways. And we can also see that looking at this, it never broke down degenerate trend either. So you can see as soon as it spiked up to the upside, came down into degenerate trend, spiked back up, brought back down in the degenerate trend, and is still ranging in here. And when we look at what's going on here, especially if we look at the intraday chart of this pattern, this is the exact pattern that I sent out to my Wolf Alerts group that we can see here. What is this? This is an ascending triangle breakout pattern looking at the 2-hour intraday chart, right? Every time frame that you look at, guys, this is the daily chart. Within every one of these candles is 24 hours of trading action that can be looked at and told on a different time scale, a different story that can be shown. So when we look at the 2-hour time frame of this, right, what do we have here? We have an ascending triangle breakout, pre-breakout, right? And so the overall idea that we have to do here is anticipate how the market is going to react. We also have to factor in that there's probably a bunch of people who started shorting into this range here. Huge spike up. Look at this, huge spike to the downside. A lot of people started shorting, probably like, oh, this is the actual dip. It's going to roll off this level. I was even potentially looking as a potential short here, but I didn't. And then we came back up and still trading sideways. But during this time, a lot of people started probably accumulating short. It broke out to the upside briefly here, faked out. a lot of people probably started adding short. And the fact that we continually traded sideways, one, people who are not in yet are now looking at this as a potential buying opportunity. Oh, we're bull flagging here, right? What do we know about self-fulfilling prophecies? That they usually come into fruition because a bunch of people are looking at that similar thing. The problem is a lot of people are too scared to buy pre-breakout and they wait for things to get up to 30K. And then they're like, okay, if we get over 30K, everyone was talking about Twitter. If we get over 30K, the bulls are back. We're going into full bull mode and we're finally back into a bull market. That's what everybody was talking about on Twitter. If we look at what's going on here, we have made a huge run to the upside. We are bull flagging. This is an ascending triangle breakout pattern, bullish flag that's forming, which would indicate a higher probability that we're going to make a run up to the next level, which is basically 30,000. Even number, that's what everybody was talking about. When everybody's talking about something, that's kind of a self-fulfilling prophecy, which leads a lot of people to believe that we're going to 30K, which led me to believe that this bullish flag was likely to break out up into that level. I was also simultaneously getting ready to short this position if that did happen. So based on the fact that we're getting ready to go into 30K and we had those previous pivots up here, right? I was anticipating one last squeeze to the upside. And if we broke out above this level, what was going to happen? One, all the people that had shorted in this level right here probably placed their stops somewhere right above here. And then people who are FOMOing in, all the noobs and the sheep who are like thinking like, oh, well, if we get over 30K, then I'll buy. Then I know that the bulls are officially back and it's time to start buying in here. So there's going to be two chain reactions. One, shorts are going to get stopped out here. And two, a bunch of sheep are going to start buying into this, thinking 30K is that magic number where we finally come into the bullish market. But the fact is, this is still extremely strong resistance all the way up to 30,400. And we also have these two pivots here between 31,000 and about 32.46. So for me, I was getting ready to short this basically in a box in between about 29.5 all the way up to this level in my stop up here. Okay. Just like we talked about the Degenerate Trend MT5 app, you can use that to enter on a grid here and then put your stop above here and still only lose 2% if that happens. Okay. So that's what I was looking at. I was looking to get short in this peak range if we spiked one last time into these levels, while everyone else, all the sheep out there probably thought, ooh, 30K, we break out here. The bulls are back. We're going on a fucking monumental run and we're going to get rich finally. We're all going to be sitting around the dinner table talking about Bitcoin at all-time highs of the year. That's the sheep mentality, okay? The risk investment of this timeline right here is one, we still have a bullish flag here, which leads me to believe we still have one more push. And basically from about 28,000 to 30,000, that's 2,000 points on Bitcoin. You can make a lot of money on 2,000 points. But everyone else, if we look at the risk of investment timeline, this is extremely risky at this point to be buying, okay? We just went on an epic monumental run for Bitcoin off the lows of almost 100% in a short amount of time. Is it still a good time to buy? Yeah, if you're planning on selling at 30,000, but not if you're thinking this is the beginning of the bull run and we're gonna go on a fucking monumental run. Okay, so let's just take a look at what happened here on Bitcoin. Bullish flag. I was anticipating a spike into 30K and I would short in this range simultaneously all the way up to about 31.85. Boom. Okay, that's exactly what happened right here. I made money on the way up. I got partial my position short up here, right? We barely peaked out. A shooting star basically candle right there before coming back down all the way back down to 27,000, right? So that was like a 4,000 point drop right after that one last 2,000 point move that we could take advantage of. You can see here, this is my alert that I sent out in Telegram. Trade idea long, Bitcoin, account risk on stop out. I was willing to risk 1.5%. Entry is 27,914 with a target level of 29.5 to 31,000. So, roughly over 2,000 point potential profit. And this is the exact chart I sent in my chat room. I said, hey guys, we're buying on the dip here, essentially near the ascending resistance of this ascending triangle bullish flag short-term pattern breakout. My stop level was just below the recent high pivot here, and as well as below the actual ascending trend. So just giving me a little bit of breathing room with my target up near 31K. But I wasn't just going to sell instantly at 31K. I was going to be locking in gains the entire time on the way up. And we can see exactly what happened there. And then the sheep FOMOing in, right? And then everything crashed down and came all the way back down to 25K. While you can see the screenshot, I had already locked in 25,000 on this long position, and there was still an unrealized profit of 14,900. And at that time, it was at 29,852. So I was taking profits along the way up. So it's important to note how these things actually work out and come into fruition, that yes, even though this was up high after a big move, again, it wasn't a spike up and a spike down, which that kind of opportunity is a good shorting opportunity. Like if I would have shorted right here and it didn't have a big pullback and it was just ranging up here, that would be a little bit more worrisome, especially if it continually ride the degenerate trend. That would be more worrisome. Okay, maybe I need to stop out of this position now before we see one last spike, and then potential that's the right opportunity to short. Because you can see, right, it spiked in that level and then it instantly came back down. That's what we want to see on a shorting position. But if it spikes up and trades sideways, that's a bullish consolidation for a continuation pattern and a move forward. So when you're thinking about these situations like this, is it still a good time to buy even though we're already up high? If you are buying, you need to be looking at it at a very short time frame, that you're going to be buying here and then selling instantly here. Not thinking, okay, we're going to be ramping up here and this is the beginning of the bull run, which is stupid. It's just like when Bitcoin was at 60K and everyone's thinking this is all-time highs, we're getting ready to go to 100K. Whereas for me, as soon as we broke out here and then failed to hold right here, that was me saying, you guys, this is the top. That's a trend reversal on Bitcoin and Ethereum. Get ready for the bear market. And that's exactly what happened. It depends on where we are, right, in the markets. And if you're trying to buy after, like, right, if you're buying when the risk of investment timeline is super high, you better be looking to take your profits very, very soon and potentially simultaneously short at the same time like I did on this trade. That's basically just what I wanted to talk about in this scenario, guys, is understanding the risk investments of timelines. If everyone's talking about something, it's too fucking late and you're a bunch of sheep idiots fucking jerking each other off in a circle. And that is not the crowd that you want to be hanging out with, because you're all going to eventually fail. All right. You need to be shifting your mindset to the sheep versus wolf mentality. And this is how every trade works every fucking time. And so it's important that this is ingrained in your head. You must be anticipating these moves before they happen. And the only way you can anticipate these moves is by having a deep understanding of how the neural network of traders actually works. And that's basically what I've been trying to explain to you in all of these trainings. All right, guys, the next concept I want to cover here is understanding the power of if-then statements, understanding why they are so important. And it all comes back again to people asking me, Cameron, what's a good buy this week? Or what should I be doing this week? Or Cameron, is Bitcoin a good buy right now? And right, these aren't the questions that you have to be asking someone, because it's so just one narrow-minded, and it doesn't give you any sort of sense of planning for the scenarios that could be potentially happening, right? And when we're looking at trades, all we're trying to do is look for a good probability, where the probability of us winning looks and appears to be higher than the probability of us losing. On that side of that concept, there still is the probability of us losing. And so that is really the most important thing that we should be asking. If you're asking someone, is Bitcoin still a good buy? The question is, hey, if we did buy it here, if it's even in a buy setup, where should I get out if things don't work out, right? That's the most important question you should be asking right there. So there's 3 questions that you have to be asking. And what I mean by an if-then statement is, it simply means this. Now that you ask me one of those stupid questions, it's, well, if it does this, I will do this. And if it does that, I will react this way, right? So if price goes up, I'll lock in a profit. If price goes down, though, I have a stop loss in place so I don't lose too much. That's what I'm talking about in if-then statements. And so many people come into the market with so much just FOMO and fantasy. They don't want to talk about the then. They want to talk about, if I buy Bitcoin, how much money am I going to make? Fuck how much money you're going to make. What about if it actually breaks down and doesn't go the way you want? What if it drops 50%? Then what? Right? That's what you need to be more so focusing on. So there's actually 3 questions that you need to be asking when it comes to basically a stranger coming up to me and asking, Cam, is Bitcoin a good buy today? That's not the question. It should be, Cam, is Bitcoin a long or short setup right now? Okay? Because we want to be able to play both sides of the coin. If Bitcoin's at 60,000, I don't think that was a good buy. I think it's a good short. I think Bitcoin's going to be dropping at least 30%. It ended up dropping like 80 to 90%. So that's the first question. is it a long or short setup? The second question is, if it was a long trade, let's say, if we bought now, where should we put our stop so we're only losing maximum 2% of our entire portfolio? That is really the first question, and the most important thing that we need to find out is where are we going to put our stop so that if it drops below that level, we're only losing 2%. The next question is, where are the next major resistance levels or projected target from the pattern that it currently is in? Are those levels giving us at least a 2-to-1 risk to reward ratio based on where our stop is? Are we at least going to make double than the potential loss on this trade? All right, that's the next question. So those are the three questions that you have to be asking yourself. Okay, 1, is it a long or short setup? 2, where do I need to put my 2% stop loss? And 3, are the next profit targets giving us at least a 2-to-1 risk reward ratio? There's actually potentially a fourth question, or a question within the first question, which is, Cam, is this a long or a short setup? There could be a no setup, which means you sit on your fucking hands and you do nothing for however many months it takes for Bitcoin to set up in a pattern that gives us a high probability. A lot of people don't have the ability to sit on their hands when probably half the year or so, probably 6 months out of the year, I'm sitting on my hands. And then the rest of the time, I'm either looking for a trade or in the middle of a trade, sitting on my hands, waiting for the pattern I'm going for to come into fruition. And that's one of the hardest things that traders face, is having the ability to do nothing. Because most often, a lot of people get addicted and they think that because they're doing nothing, they have to do something. Or they go through a loss and they want to make that loss back instantly right now. So they revenge trade. Even when the setup isn't good, that it's like, fuck. But if this did do this, I could potentially make my money back today. And that is the wrong mentality that you have to have. You have to be patient and disciplined enough only to wait for the highest probability setups to give you the best odds at potentially winning in this game. So it's important to understand everything about if-then statements, and that you need to be asking all those questions. And also the question within the question that's so important is it not even a setup that we should be involved in at all? There's also something called market risk exposure. The more time you spend in front of your computer, the more time you expose yourself to the market, the more chances you're giving yourself to fuck up. A lot of times when I used to be an active day trader and I would only trade the first hour and a half of the market open when I lived in the USA, that was my only window with the highest volatility where I would make the most money and find the most predictability. Sometimes I would make $1,000, sometimes I would make $5,000, sometimes I'd make $15,000 in that first 90 minutes. People would often ask me, Cam, you already made $15,000 in the first 90 minutes. There's still like another 5.5 or 5 hours left in the market session. Why don't you just keep going and try to make $100,000? That is not how the market works. High probability setups that I found with my strategy were only formed within that 90 minutes in the first market open. Anything beyond that, I am exposing myself to more risk, more opportunities to fuck up, trying to make something out of nothing, right? So you can't make something out of nothing. You have to find a strategy that works consistently over the long run and only trade that strategy. And when that strategy is not working, sometimes the market environment shifts and whatever strategy you're using is no longer going to work. Okay, that's why I have two different strategies. I have my long strategy called Krypton, and I have my short strategy called Decrypton. Based on what kind of market we're in determines which strategy I should be using. Maybe neither is working at this time. There's just no setups, so I need to sit on my hands. All right, I need to have the patience and discipline to do nothing. And a lot of people don't like that, especially if they're in the monthly Wolf Alerts group, and they're like, dude, I was supposed to get 0 to 10 alerts this week, and I haven't had an alert for 2 weeks, right? Obviously, they don't like that. But the reason I'm doing that is because I'm focusing on capital preservation, and there's literally no setups that I find to be a high probability that gives me a good probability of winning and minimizing my risk to the market and minimizing my risk to my account. Because every loss that you take in your account, that is not only damage to your account, but it's also damage to your mindset. Even a 1% loss still doesn't feel good. It doesn't hurt you that much. But what if you take a string of 10 1% losses? That's now 10% drawdown in your account. And what if that 10% loss could have been avoided simply by sitting on your hands because you were trading out of addiction and out of boredom, as opposed to trading out of a bunch of good setups that just didn't work out for you? Okay, so it's important to understand all these aspects of trading, and it's so important to understand you have to be patient and wait for only the best setups that you are super familiar with and super confident in. And eventually you will get good enough at trading to know that when you see the setup, you don't have to ask yourself, you don't have to second guess yourself. Should I be buying here? You don't have to ask yourself that because it's there right in front of your fucking face. It's painted like the fucking Matrix with Neo. And all of a sudden he sees the Matrix. He's like, I can see. That's what it's like when you see the right opportunity in front of you, right? If you don't feel that, if you don't see it like, oh, that's like the perfect setup that I've been learning and wanting to trade. Even if you lose on it, it doesn't matter. The setup was there and you felt it and you saw it. If you don't feel it and you don't see it and you're second guessing yourself and you're questioning yourself, don't take the trade. Be patient, sit on your hands, wait for the best opportunities only. And that's how you're going to ensure a higher win rate, higher probability trading, and more happiness and more capital in your account. Let's be real, guys. How many times have you been absolutely destroyed in crypto where Ethereum and Bitcoin all of a sudden drop 30 to 40% in the matter of minutes and you're wondering what the hell just happened? Well, in today's video, I'm going to tell you exactly what just happened and how you can avoid it every single time in the future. This is the anti-wrecked rulebook. And when you understand this system and have this knowledge, you will never get wrecked in crypto again. In fact, it's very simple to learn. I'll show you exactly how it works. All right, guys, pretty simple framework. Let's just take a look at my tweet from January 8th. I said, and just like that, the bull market is over, at least according to past history. Break and retest, then heavy selling back through the 50-day moving average after a big run has like a 90% plus hit rate for calling the top. Also already down 40 to 60%, really disappointing start to 2025. Now, is it that simple? Is it that simple that if price is on the flip side and underside of the 50-day moving average, all we have to do is exit our longs and we'll never be part of a liquidation event again? Now, the opposite side of that is you can actually be short now and capture that move to the downside. We'll take a look at Bitcoin and compare it over the course of the last several years and how accurate is this signal and how accurately could it avoid us from ever being part of liquidation events when we're balls deep long on high leverage, okay? We're also gonna take a look at the framework of why crypto crashes so hard and why so many people lose money. Now, it's just funny to read these tweets. Now, price was up at 100K, price is back at 103K now. So while Bitcoin didn't have that big of a dip, it dropped maybe like 30, 40%. A lot of altcoins, everyone was balls deep in. What did they do? They dropped freaking 80 to 90%, okay? So this signal, while Bitcoin has been held up a little bit more recently in the past couple of years due to institutional funding, but 50-day moving average breakdown, Bitcoin dropped 32%, altcoins dropped 70 to 90%. 50-day moving average breakdown, Bitcoin dropped 32%, altcoins dropped 70 to 90%. And if you're like me, you're not really trading Bitcoin, you're trading altcoins. You're looking for that degenerate 10 to 20x gains, okay? That's what we're here to do, but we also need to be able to protect ourselves and know when is price gonna drop 70 to 90%. And just like these fuckboys over here, is this a joke? We're just getting started. Why are you ruining everybody's dreams? That's actually my buddy, Kunal. And I said not just everyone's dreams, mine too, because that ended my bull run as well, okay? We've heard a million times, charting is not reliable, so much that it's just a big guessing game. Stick to fundamentals, 2025 is bullish. Okay, well, he is right that 2025 is back to being bullish, but for the majority of all altcoins, what are they? They're not bullish. Yes, this is creating a new cycle down here to take advantage of, but this is DOT, a major coin, negative 70%. Do you want to hold negative 70% when the majority of retail traders are all buying up here? Retail traders don't like to hodl. They are forced to hodl because they buy like a bunch of dummies fucking up here. Now, there is new buying opportunities down here, of which we captured, right? Look where we just bought Solana. Boom, around $100, okay? We didn't buy up here like a bunch of fuckboys. We bought down here, all right? ADA, where did we buy? We bought down here. See these little arrows? Those are my buy signals. ADA, ETH, where do we buy? We bought down here, not up here. Okay, so you have to understand what are the market cycles and how do I avoid this big, massive fuck you like we saw in Ethereum. This was the biggest liquidation event in history of Ethereum. Look at that fucking selling candle. And also this one back here. How do we avoid that? We don't want to be part of that. This is massive stops being taken out across the board, across all exchanges. Crypto exchanges probably lost 50% of their customer base. Why is everyone so quiet on this big run that just happened right now? Because most people lost all of their money because they were on the wrong side of the market during massive liquidation events. So let's just take a look at why this happens, okay? First of all, there's Faves 1. Diamonds in the rough, whales are buying spot cash positions, retail traders have lost everything and given up. That's exactly where we're at right now. Retail traders have lost everything, they've given up, while whales and smart money are starting to accumulate down here, okay? What happens? Retail traders start coming back into play, buying spot margin and leverage futures, okay? And that's kind of where we're starting to get into now. Everyone's starting to get a little bit more excited. After this big run, a bunch of retards are probably buying right up here, okay? Instead of waiting for a potential pullback, which I'm hoping for so that we can then continually add to these positions as opposed to buying into this momentum, okay? That's where we are kind of right now, phase 2. Now, phase 3, this is when we see news, hysteria, new highs, crazy price targets, extreme FOMOs, and influencers shilling WAGMI. We're all gonna make it, guys. Everything's gonna go up. We're all gonna get rich. And fucking the reality is nobody's getting rich except for a small crowd, the wolves, which is like 2% of market participants. Because what's going to happen to most people is they're not going to follow this framework and they're going to ride everything down 70 to 90% again, get liquidated on all their positions. So what actually happens? As price goes up, people start getting 10x long, 20x long, 50x long, 100x long. And there's so much open interest in long leverage that's built up over time as price gets higher. And basically how that would look is that, think of it like a bridge and a bunch of weight on the bridge. The higher we go, the faster we go, there's more and more weight, AKA leverage, long positions open on borrowed money. Not money that people have, not on spot positions. This is on futures trading where you can trade upwards of 100x leverage. And the more weight that gets up here and prices continue to go higher, all it takes is one little whale fart, just one little, that's it, is all it takes. And there's so much weight up here. One big whale selling and dropping one big massive load right on the top of all this weight here, and boom, the bridge breaks. And how do you identify when that bridge is broken? Well, it's quite simple. When the 50-day moving average breaks on the daily chart, that means there was a big fucking whale turd dropped on all this leverage, and that's when you see the first liquidation event. At that point, you do not want to be long in the markets. That basically means that market structure has shifted bearish and we start seeing lows taken out and continuations. Okay, we'll explain this a little bit more, but let's just take a look at the chart and compare this, okay? Let's take a look at Bitcoin over here. And when do liquidation events happen? Do they happen when price is above 50-day moving average? Maybe. Or do they happen when price is below the 50-day moving average? Okay, let's take a look at this run back here. Price is rallying, massive pump above the 50-day moving average until it finally breaks after a massive run. What happens? Boom, whale fart. Look at that massive fucking dump. Massive dump. And new lows are taken out. Okay? Lows taken out, lows taken out, lows taken out. Until we finally have one big rally. And then what happens again? Lows taken out, massive dump. Dump. Right? Until the 50-day moving average is reclaimed on a sustainable path, right? And this here is back when price is back in this phase, where whales are buying in diamonds in the rough. Retail has all stopped out because they were loaded up on leverage, okay? So that's what we're trying to identify. When do we not want to be on the long side of the market, okay? And it's quite simple. When the 50-day moving average breaks down on Bitcoin after a major run, even though Bitcoin's only dropping 30%, what's happening to altcoins? Well, Ethereum dropped 48%. Let's take a look at like Beam, which is another major altcoin that a lot of people are trying to trade. Beam dropped 77%. So if you're one to be trading meme coins or altcoins and the 50-day moving average breaks on Bitcoin, you can bet that if you're continuing to stay long, the only time these liquidation events happen is after the 50-day moving average breaks. That means a whale just took a big fat dump on all the leverage, and now price has shifted into a bearish market structure. And if you're gonna stay long, be prepared to continually get dumped on until price finally bottoms out. It probably has some sort of demand zone in the past, and then the 50-day moving average is reclaimed. So this is a very, very simple framework that just is on repeat time and time again. So if you don't want to get wrecked, if we flip the 50-day moving average, which I've talked about for fucking years and nobody wants to believe me, especially January 8th, everyone thought this was the beginning, which I was hoping for too. I was hoping that we were going to bounce off the 50-day moving average and see a pump up to 120 to 150. And then I cash out because I was loaded up. I was fucking loaded up on crypto. But once that happened, I was like, all right, I don't want to be part of the fucking liquidations that I know are coming. So what is kind of the rule book? And what happens after that first big whale turd? Well, the bridge is broken and it can't be reclaimed until it's rebuilt somewhere down below. So the rule book is never buy the dip unless a new low is being taken out, right? If you want to buy the dip down here, that low is taken out, sure, you can maybe buy this, but then you want to sell it up here somewhere, back at a supply zone. And what that looks like is, okay, stops are cleared, whatever retail idiots are left, like, it's just a dip, guys, it's just a dip, let's go long, then long, price starts rallying back up till again, people are starting to get 100x long, chasing momentum. Retail is chasing, okay? When smart money bought down here after the low was taken out. Then all of a sudden, like, it looks like just the tip of the iceberg that the bull market is back. But what people don't see is all this leverage that was just rebuilt again. What happens after that? This whale comes in, goes, ha ha, right on their face again. Liquidation event, lows are cleared again, okay? The bridge breaks again. People start rebuilding it, bridge broken. Same thing happens again. Lows are cleared, stops. Everyone's like, it's just a dip, it's just a dip. We start loading up on leverage again. Whales come in right on top of their faces again because they don't see that under this tip of the iceberg is all this leverage that is rebuilt again until it breaks down again, until finally, retail traders, their dreams are crushed. They've lost so much money that they have nothing left. And that's the final capitulation until finally, the 50-day moving average is reclaimed. Boom, price breaks back above it. We probably have some sort of consolidation breakout to the upside. Probably some sort of demand zone back here where price finally halted out at a long-term scale. Okay, and then we reclaim, and then we can start buying because we're back in this diamond in a rough phase one area where retail traders have lost everything and whales start accumulating again. As you can see, that's exactly what we did, buying into all these spot positions. SUI as well was another one that we got into. XRP, Beam. Boom. Look at us picking up SUI down here for the nice big juicy gains, right? So this is just kind of a simple framework, guys. If price is back under the 50-day moving average on a mega run, you can expect that there's going to be lows that are continually taken out because there's going to be a bunch of retail traders that underneath these lows, they place all their stops. That's liquidity. That's where pro traders want to grab their money. Stop them out, buy in, ride the rally up, short here at supply, then boom, liquidation event again. And we can just see this happening on the chart. It's like clear as day. 50-day moving average broken, as I called this here on January 8th. What happened next? If we look at like Ethereum, ETH, okay, right? Just dip, guys. Wrong, lows cleared out. People bought in there, smart money got in, rode the bounce, retail traders got stopped out. Boom, what happened? Lows cleared, boom, whale fart, huge dump, biggest dump in history. Pro traders accumulating down here, locking in gains. Iceberg, what happens again? Liquidation. Price is still deep under the 50-day moving average, right? At this point here, price is under the 50-day moving average the whole time on Bitcoin. The whole time is on Bitcoin until price broke above the 50-day moving average right here on this big spike on Bitcoin, reclaimed, bull flagged, and then after the races, absolute shred, right? Where did price halt out? On Ethereum at this weekly supply zone. We're looking for another continuation to the downside. Now we have potential dip buys coming in for Ethereum, okay? This is the anti-rect rule book. if you want to avoid all this, which happens every fucking time, lows continually get taken out, it's as simple as looking at the 50-day moving average on Bitcoin, which sounds crazy, right? That sounds crazy to think it's that simple, but it really is. And that is something that has protected me for many, many years, being involved in the crypto market, being able to lock in 7-figure gains on the way up and then not be part of this, because this fucking hurts. This fucking hurts if you don't understand this. And I know it's hard to shift mindsets when you're so hyped up about Trump becoming president and we're going on the Trump run, okay? But nobody wanted this. Nobody wanted that, but that's what you got. And the sign was right here. I said it on January 8th. Okay. I also said this in the 2021 bull market. Nobody wanted to believe me. Prices dumped 90% after that. So that is the anti-rect rulebook, guys. This is just a little taste of what's in my new mentor program. Okay. What I didn't tell you is how to trade all that. I'm going to tell you exactly how to trade all that in my new mentor program. It's actually not even out yet. It launches on Sunday by the time I launch this. But in the meantime, you can also watch how I turned $80,000 into 7 figures in 30 days on that first Trump pump. This one right here. Boom. And then called the top. Here, January 8th. That is a great video. It teaches you my framework, the Millionaire Crypto Trading Strategy. And again, I got my new mentorship program, applicants approval only. This is not for everyone. Okay. But anyways, I'm back on YouTube. It's been a little bit. Why? Because I was building this whole fucking brand new mentorship program for the last fucking year. God damn it. So sick of doing it, but it's finally finished. Let's make some bank. 2025. Let's go. See you guys in the inside. Subscribe and like this video also. Peace. In today's video, I'm going to show you exactly how to turn thousands into millions in every altcoin cycle, from the one that we're going through right now and into the future. Every altcoin cycle that happens into the future, you will be able to use the exact same framework that I'm going to teach you today to turn thousands into millions. But I'm going to need you to do a few things. One, you need to stop listening to all these Twitter gurus out there who continually give you their opinion about what they think is going to happen. How many times have you been in this situation where all of a sudden altcoins start dropping and they tell you, don't worry about it, guys, it's just a dip. Yet the dip just keeps on fucking dipping 50 to 90% all the way down to the point where you basically have nothing left. How many times have we gone through an epic bull market? Yet they continue to tell you that, hey guys, we're just getting started and there's so much more upside. Don't sell. Yet what happens? That was actually the top of the bull market, and then things crashed 70 to 90% and you wish you would have taken some profits, yet you took nothing and now you're left with nothing. This is what happens when you trade off of opinions. Now I'm going to reveal something to you today that is very shocking. Everything that I talk about in today's video, the entire framework that I'm going to teach you, is not my opinion. My opinion means absolute fuck all. What I'm going to show you is a framework of patterns repeating themselves time and time again. If I went off my opinion, I would be wrong all the time. We can't use our emotions to trade. We can't use our brains and our opinions to trade. What we have to do is look exactly how price operated in the past and look for patterns that continually repeat themselves, and then have the patience to wait for those patterns to rear their heads so we can pounce on the opportunity and make bank. Now, I personally have used this framework to turn thousands into millions. And in fact, I've called the top of almost every bull run in the crypto market by using a very, very simple framework. All you have to do is understand how it works. And that is exactly what I'm going to teach you today. A very simple to follow framework to turn thousands into millions in every altcoin cycle, the one that we're going through right now, and every altcoin cycle into the future. A few things here, guys. Okay, why listen to me? Well, because I've had $450,000 months, $90,000 days using the exact framework that I'm going to teach you today. Okay, $20,000 to $1.7 million in just over a year. You can see the screenshot from my coin stats on that from the actual previous bull run cycle. Okay, just for an example, some of the patterns that we're going to learn today. Wild, $47,000 profit. Block, $64,000 profit on some of these. Okay, also, some things that I mentioned before. When we're looking at what other people's opinions are, rather than looking at what the facts are, looking at what the chart and price is telling us based on how
price reacted in the past. What you need to understand about price action is when we're looking at a chart, we're looking at a literal painting of how the entire neural network of traders as a whole reacted under certain situations. So when we look at that, this isn't our opinion. This is us just analyzing how this neural network of traders reacted under all these circumstances. And when we see those circumstances arise again, we can basically forecast about how the neural network of everyone involved might react again. If you start using your opinions without any basis for why you think this is going to happen, it's just fucking ludicrous, okay? So what I said here, I said the fact that all these crypto YouTubers, twatters, and TikTok cunts are pumping 100K in desperation because their hopes and dreams depend on it is not a bullish signal. We have all these other influencers saying Bitcoin is cheap below 70,000, take advantage. The top is not even close. That was at Bitcoin 70K. Raul Powell, I don't expect perfection, but I've done something like a 30 to 100% rally from here and probably year end. I am so bullish on crypto. Just one second there, guys. You're probably wondering, where can you trade all these altcoins? There's this new broker called Blofin, and it's actually a little bit mind-blowing because not only do they have all the best altcoins to trade that you would see on your major exchanges, they also have a huge list of coins that aren't at the major exchanges. And it's sometimes those little nitty-gritty degenerate coins that have the biggest ROI and the biggest returns. Okay, so this is actually the platform. You can go into futures or trading spot. I trade both futures and spot, but it's actually a really, really sleek platform with a shitload of actual coins to trade on here to choose from. Okay, and that's one of the biggest hurdles that a lot of people face is they don't have the coins that they want to trade. Blofin has one of the widest array of altcoins to trade in both spot and futures. Another major thing about it is that there's no KYC registration required to actually trade, deposit, and withdraw on your account. That is one of the biggest hurdles for most traders out there. And so that is where Blofin kind of stands out above the rest. Not only does it have a huge variety of coins, there's also no KYC required. So use my link below to get access to Blofin. I promise you it's going to be a really good experience. And I do really like the platform, especially since there's so many variety of altcoins to trade. What are we trying to do? We're trying to find all the best opportunities in altcoins. So definitely check out Blofin below. Ben, Evergrande makes impacts. We're still bullish. Bitcoin's in consolidation. Okay, what fucking happened right there? Okay, I said right here, that's what we call a trend reversal on ETH and a bull trap on Bitcoin. Okay, so that's basically me just calling all these retards out because what are they doing? They're using their opinion, whereas I was actually using factual data of how the entire neural network of traders had reacted in the past under the same circumstances. And that led to the ending of the bull run right here when I said that is what we call bull trap and a trend reversal, and then priced eventually dropped about 70 to 80, 90%. Okay, so this is an example of why you can't listen to these people who are using their opinions. They're not just fucking saying anything. They're just saying, Bitcoin is cheap, take advantage. Like, what does that even mean? What are you even talking about? They're using hope and opinion for their analysis. And that literally makes zero sense at all. And it's going to get you into big trouble. But look at the facts, look at the data, look at how price reacted in the same exact situation in the past. And we can forecast exactly how it might react in the future so we can game plan for taking advantage of it. Okay. So with that said, guys, let's just take a look at the cycles of how price action works in every altcoin cycle. Now, every time it reacts maybe just a little bit differently, but overall it's extremely similar. And a lot of times the way to take advantage of this is mostly just patience. And it also has to do with being able to identify what these things look like so we can actually identify them and then have the patience and wait for these things to actually come into fruition. And then we take advantage of it. So first and foremost, it's the most simple way to identify the end of a bull market is when the 50-day moving average breaks down on Bitcoin. Okay, that is the end of a cycle. Okay, and if we can look here, a lot of these tweets, this was from May 6, 2021. I said the last two bull runs for Bitcoin upon breaking the 50-day moving average resulted in 83% and 62% declines from the top. Not predicting anything here, just an observation of the trend shifts from past history. Okay, like I said, this is not my opinion. It's never my opinion. I just look at the data and exactly how the neural network of traders react in the past. So we can forecast that that might be happening in the future. At least that gives us a higher probability of gauging what might happen rather than just focusing on your opinion and hopes that it might go up. So we can see the 50-day moving average the first time, 83%, that was a 2018 cycle. Then again in 2020, 50-day moving average break after a run, 62% cycle. And at this point right here, Bitcoin is breaking the 50-day moving average again, and I was predicting, or it did drop 22%. It did eventually drop quite a bit farther down from there. As you can see, the 50-day moving average breakdown right here on price, which led to, from the peak, down 55%. Okay, and then it came back up, and I'm gonna be honest, at this point, breaking out and then consolidation and breaking out all-time highs again, there was a brief moment where I was actually bullish because it was looking like a pattern that I called the force pattern. But as soon as this actually broke down right there and then broke the 50-day moving average again, that was game over. That was a signal. It was time to get out of all positions, and the bull run is over. And what happened next? From the top to basically the bottom, 75% drop in the markets. Now, what most Furu Twitter influencers out there told you the entire time is like, listen, guys, it's just a dip. 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 Oh, fucking shit. We are down at 20,000. Fuck. Right? How many times have you been in that situation? If you've been involved in crypto, I guarantee you have been in that situation before. Now, what I'm going to show you is how to identify what happens next after the 50-day moving average, which then leads into the first pattern of the cycle of the next run, which is called the revival pattern. But yes, that also means that you might have to sit on your fucking hands and go trade something else like forex, which is not cyclical. You can trade it year round, of which I also give all of my alerts in the QCR report. You can see here all my forex trades that are live, as well as future trades. I do trade all those things in the QCR report as well, which is the same fucking membership. Okay, it's not different. So you might have to wait for freaking basically before this ever actually reversed again. Almost 718 bars, okay? That was a very, very long, very, very gruesome bear market cycle where altcoins really didn't go on any sort of big runs for quite some time. There were some opportunities within these moves, like right here. I believe another one was right here, which I believe that was like 2022. Can't remember when these, July. Yeah, so this was in August of 2022. So there are some opportunities within there, but you have to wait for these things to actually come into fruition. You can see locking in a 85% gain on this trade, alerted in here. Here's the actual proof of the profit. But most people don't lock in profits and they say, oh man, this is the fucking beginning. Everyone's talking about how this could be the next thing. Fuck you, bro. Okay? Lock in your fucking gains and get out of that position, because what happened on that trade next, it went back down to where I bought it. Okay, so you have to understand these things. So let's just take a look at the actual cycle of how this works, and then we can look at some of the actual charts to see that this actually played out time and time again in the market. So first and foremost, step one is always the 50-day moving average breakdown, and that is the end of the cycle. It might not happen every time this exact same way, but according to a lot of these different things, basically from 2017 to 2020 to 2022, as well as the latest one that we just saw, the 50-day moving average breakdown is the beginning of the end, but only after a massive run to the upside, okay? And after that, we have the revival pattern breakout. And basically what this is essentially, there is a lead-in trend that is super bullish. There is a lead-in trend that is super bearish, basically a lot of times after the 50-day moving average is broken down somewhere up here. And then we see a bottom with a rise to the first peak of the actual flat top breakout, and then continually higher lows along the way, but we're usually around horizontal across the board for price action. And this creates an ascending triangle breakout. But the differentiation of this is that the lead-in trend is super bearish. And this is why we call it a revival, because it's essentially reviving itself after a bear market. So that is the first pattern that I really like to look for. But again, right, this took 700 days for this to actually come into fruition. So you might be thinking, fucking Cam, wait 700 days for altcoins? Yes. How much money did people lose by fucking around throughout all this shit when you could just sit on your hands and do nothing? 50-day moving average breakdown? Okay, I'm off. Gonna go do something else. Trade forex, trade stocks, trade anything else except for crypto. Because a lot of this is where most people give up all their money. They continually buy the dip when we're actually not forming any sort of actual pattern here. Okay, so what you need to do is have the patience to wait for revival patterns to form up. And you can see it actually forming up here. First, initially breaking out about 24,000 on Bitcoin. Didn't really do a whole lot, really. But we also had the previous lows here and lows here, as well as the low consolidation here at about 30,000. And that was actually the beginning of the major move once we broke out above that revival and then went on an epic run here. We also had this pattern here, which I call this the survival. Basically, after the revival pattern, we see a move up and then a breakdown here. It's either a wedge pattern or then an ascending triangle pattern that breaks out just below the previous high and then just shreds through. We can see the illustration of that here on the actual chart. We see the big push up that was triggered by the revival, usually a wedge pattern that forms up, and then maybe a flat top breakout that forms up here. Then that move runs up and retests those highs. You can either trade this and just get out right here, or sometimes the bull market is super strong and we just continue shredding through. That's exactly what we saw here on Bitcoin. And that was the next leg up to potentially just continue to run up. Now,
This happened very, very quick, and prices continued to pump up. Now, the actual next part of the cycle is what we call the force pattern. Now, this can happen on Bitcoin or not on Bitcoin, but this can happen basically on a lot of other altcoins along the way. But it's essentially a longer term breakout of an ascending triangle after a bull run, okay? And that's basically what we're seeing here right now on Bitcoin. Now that it's October 15th, we're essentially seeing, if we break this down more so on the weekly chart, there's also a beautiful one on BNB, which I'll show you. Basically a flat top breakout forming up here, long-term ascending triangle. And we're about to potentially see a massive run to the upside for Bitcoin, okay? And that's what we call the force pattern. And that is the next part of the cycle, okay? And that's when you see Bitcoin break out over all-time highs once again, and then we see a massive pump again until finally the 50-day moving average breaks down, and then we see a 70 to 90% drop across the board, okay? And then this cycle just repeats itself. We see a massive drop to the downside, we see revivals form up again, however much longer that takes, survival, and then again into a force pattern, and then again the 50-day moving average breakdown, and then a 70 to 90% drop. Now, this pattern is continuing to repeat itself over and over again, okay? We can see this happening here. Huge run, 50-day moving average broke, came back down, started off with the revival all the way down here. If we look on the weekly chart here, this was revival that triggered right here. But how much patience did you have to have, okay? This was that last cycle. From here to here, before it finally broke out, that's over a year long, 469 days. Whereas most people continually tried to buy this dip and trade throughout all this fucking chaos when you didn't need to. You could have saved yourself so much fucking money by just exiting on the 50-day moving average breakdown on the daily chart rather than listening to all the foolers out there saying, guys, just dip, guys, just dip. It's not a bear market. It's a fucking bear market, okay? You have to acknowledge the bear, otherwise it's gonna fucking destroy you and eat you up alive, okay? Wait and have the patience for these revivals to form up again, as we can see here on Bitcoin. Once that revival broke out, we saw the massive pump to the upside. Now, this was the COVID drop right here. But again, what do we form up? You could essentially say that this was kind of like a force pattern breakout here on Bitcoin. Revival, or you could almost call this a survival, but the same exact thing. Look how much price action is in here doing fuck all, fucking with everyone before it finally reared its head, a predictable pattern. It takes so much patience to wait for these setups, I know, but this is where the big money is made. And most money is lost is in between, in the gray areas of these, where people have FOMO. They're listening to all these fools on Twitter about what their opinions are, rather than just looking at the data and how price reacts, how the entire neural network of traders react as a whole, repeating themselves time and time again, okay? And then we see the actual retest of all-time highs followed by a flag pattern breakout, and that's what we would consider a force pattern, and then we went just on an epic fucking run. Then the 50-day moving average broke down right here. Then it again broke down right here. But again, like I said, this was a little bit of a tricky situation at that top, because right here, leading into this, right, that looked like a potential force pattern breakout right here. Okay, this move right here was like, okay, this looks like a force pattern. We should be long. And I was long right there. But as soon as that broke down right here, this candle, that invalidated. Then it broke the 50-day moving average, and that was it. That was game over. And that's when I tweeted, that's what we call bull trap and trend reversal on Ethereum and Bitcoin. From there, dropped 70 to 90%. Now, again, this isn't perfect. There was the potential revival pattern here, but once it breaks down and fails that's invalidation. So that means you need to exit and get out of those positions. Okay, and then we can see down here, there was another mini revival pattern, but again, the smaller and more condensed it is, the less trustworthy it is. Okay, so there was a move here. We can see Bitcoin pumping, ripping, breaking out of a small revival pattern, and you can see exactly that's where I took advantage of that trade. You can see that's exactly where I took advantage of these trades in August. Though there were short-term movements, $47,000 on Wild. This was also the revival pattern that was forming up on Block here in August of 2022 as well. We can see that forming up, breakout to the upside. What happened after that? This came all the way back down because it was just a short-term, small little revival pattern that formed up. It's the longer-term moves that we want to take advantage of. And if you see something small like this, we don't know what's going to happen. So these are small-term, short-term advantages that you can take advantage of within these cycles. But again, it's the big long-term ones that are going to be the beginning and the end of big moves in the market. If we look at price action right now across the board on Bitcoin, right? Bitcoin did break currently the 50-day moving average right here at about 67,000. And now while Bitcoin remains sideways, another thing that we need to factor in to be looking at is others and also Ethereum. But others is essentially, it's the total market cap excluding the top 10 of all altcoins. Okay, so this is going to be the real gauge of how crypto altcoins look in general. So this is even more important to look at as opposed to Bitcoin. This will give you a little bit earlier signals and be a little bit more accurate signals about how altcoins are looking. Because while Bitcoin broke down the 50-day moving average around the same time as the others did, what happened to others? Others dropped 50 to 60, 70%, while Bitcoin remained sideways. So it's important to understand that you need to be monitoring the others ticker. It's OTHERS, and this is total market cap. And what we can see right now across the board is that we do have a revival pattern forming up here on the others chart. 50-day moving average breakdown. How low did we go from the peak? It's almost 60%, right? So that is a significant pullback across the board on others. And now we have the potential revival pattern forming up. We did see here lower high, lower high, lower high, higher high. So the fact that we have a higher high forming up right now, and here's a lower low and then a higher low, that is a shift in market structure that we can take advantage of. And I've been loading up on a lot of these altcoins because I do believe we are in the beginning of the potential next run, right? That's not my opinion. This is just looking at the analytics and the data of how price and the neural network of traders reacted in the past. It is not my fucking opinion. You can never use your fucking opinion about anything when it comes to trading. Look at the data. Look at the analytics of how this entire neural network of traders reacted in the past, and that is how you make money. All we're trying to do is steal money from all the retail traders out there who are using their opinion and hopes and dreams to try to make money, right? We're gonna crush their fucking dreams. We're gonna steal their money while they think that the fucking altcoin season is just getting started up here. Wrong. 50-day moving average breakdown, negative 60%. And while that dropped 60%, a lot of altcoins dropped 90%. Okay, this is including all the best performing ones as well. Okay, but we can see the same thing here. Looking at others, right? 50-day moving average breakdown. What do we have here? We had a revival pattern breakdown that took a lot of time and patience to actually come into fruition. And that was the beginning of alt season, right? Pretty much from 50-day moving average breakdown, big pullback, survival, rip to the upside, the secondary 50-day moving average breakdown, as well as failing to hold those highs, which is what we call a bull trap. Huge fucking just breakdown. How long did that take? Of just altcoins doing fuck all and most people just losing all their money and their fucking mind. 600, 700 days, okay? This is where you tell crypto to go fuck itself and you go trade forex, okay? Forex is not cyclical like crypto. Forex is sideways at all times for the most part, and you can take advantage of supply and demand. Crypto moves in cycles and it takes a long, long time. Look how fucking long this was, sideways, doing nothing. But the entire time, it was forming up what? A revival pattern breakout that you can take advantage of by understanding the framework of 50-day moving average, 70-90% drop, lead and trend bearish, phase 1 is revival, phase 2 is survival, phase 3 is the force. We can take advantage of all these big moves, but when the 50-day moving average, we might have to fuck off for 700 days before something actually meaningful comes into fruition again, okay? So that is why you have to take profits. You just fucking have to take profits along the way up, guys. The only way to ever make money is to sell. If you don't sell, the money's never yours and you never make any money. So whether or not, if you want to fucking hodl, fine, but at least take some profit. When you see these fucking moves pump to the upside, okay? And then you see people like this saying the top is not even close. Bitcoin is cheap, take advantage. I am so bullish on Bitcoin. Evergrande makes minor impacts. We're still bullish. After a fucking big run, oh my fucking God, guys. Sell your fucking bags, at least some of it, if not all of it, because that means we are getting close to the end, okay? And just like I said before, guys, this was me tweeting in 2021, talking about the 2020 and the 2017 one. The last two bull runs for Bitcoin upon breaking the 50-day moving average resulted in 83%, 62% declines from the top, okay? Now, you could hodl throughout this whole fucking time if you want, right? But that's not why you're on this channel. You're on this channel to trade and learn how to make money and learn how to take advantage of cycles, okay? And that is what I'm showing you right now. This is how the cycles work every fucking time. It's not my opinion. This is fact, okay? I don't use my opinion in trading. That's fucking ludicrous to use your opinion in trading. And it's very clear. That is what all these gurus are telling you. I am so bullish. The top is not even close. Bitcoin is cheap. Take advantage. What the fuck does that even mean? They're just stating their opinion. They're not giving you any sort of reason. So never buy into all the FOMO that people are trying to give you, okay? Because it just simply doesn't work. And I'm sure if you've been involved in crypto in any way, shape, or form, you've gotten completely fucked and destroyed, and you wondered why the hell you didn't lock in any profits. Okay, so it's so simple. It's just the 50-day moving average. It's a free indicator on any fucking platform. Okay, well, it's not perfect. It's a pretty good fucking guide to be living by. Okay, but right now, guys, we're on the cusp of another big run in crypto altcoins. We can see a revival pattern forming up. Okay, Bitcoin is on the brink of a potential force pattern breakout. Ethereum is also potentially forming up a revival pattern breakout. And in fact, it just broke out above the descending trend. It's now in a revival pattern breakout after a big decline from the top, about 40–50%. Now, this doesn't mean it's guaranteed to happen. We've seen false formations set up before. The election is coming up. Maybe Trump winning or losing, could it affect this? But it doesn't matter. I'm not using my opinion. I'm just following the charts and understanding that these cycles repeat themselves. And all I can do is try to have the patience enough to wait and do nothing when these patterns aren't there. And when these patterns are there, take advantage of them and act on it. So anyways, guys, that is how you make money and turn thousands into millions into crypto altcoin cycles, not by fucking listening to Twitter furus out there, not by even listening to me if I say anything at all. It's usually not my opinion. I'm just going off the data, okay? But don't buy into the FOMO. If we go on a fucking epic run and people are telling you we're just getting started, you should probably be locking in some profits and ensure that you do keep some of your money, because it's very easy to give everything back in crypto. It's the only asset class that can go on meteoric runs and then drop 90% within 6 months later. Why would you want to hold anything that has the ability to drop 90% in 6 months? That's insane. You must lock in profits along the way up. But anyways, guys, like, comment, subscribe on the video. If you want to join my exclusive group, join the WAP. You're going to get the Quantum Cipher report where I give you all my trades way ahead of time, preparing you to take advantage of these before I actually get into them. It's not just crypto, it's also futures and forex. And I promise you, you have to be a multi-asset trader if you want to be involved in crypto, because there's literally fucking 700-day sprints where we go into a full-blown bear market and you don't want any involvement in crypto. It's that time when most people try to just turn a mountain out of a molehill when there's no opportunity there. The only reason why you're trading it is because you're not trading anything else. So walk away from crypto during those cycles, wait for the revival pattern, and trade something else like forex or futures, okay? So I'm gonna teach you all that stuff in the WAP as well. And also check out my other YouTube channel. It's Foos Trading. This is my original channel, which I quit, and yes, apparently now I'm back, but only for crypto degenerate fucking coins. That is it. This is just altcoin picks on this channel and nothing else, okay? The other channel is gonna be mostly about trading forex and futures and getting funded at prop firms. But anyways, guys, thanks for listening. Thanks for tuning in. Let's see what happens on this next cycle. But basically, you got the framework. That's the framework right there. Boom. Catch you guys in the next one. Peace.
Yo, what is up, guys? Cameron Foos here. Today, we're gonna shoot a little bit of a day in the life vlog out here in Bali, where I've lived basically since the beginning of COVID in 2020. Now, I bought this land in the middle of COVID. I was able to do that because the last bull run, of which we're in the middle of another bull run right now, I turned 20K into about 1.7 million in just over a year. Now, I'm already about to break that record in the first 35, 40 days of this bull run, but with that, I was able to invest in other projects like these villas here. So this is my villa, which is now complete. The worst thing about being the first villa complete is that I have to deal with everybody else's bullshit construction for however long this is gonna take to finish. But we also built this villa, which is basically a similar copy of this villa, but they're doing a little bit different theme. This is gonna be Tulum. And then this one down here was supposed to be a New York theme, but the guy who bought it from me is actually just doing another version of Tulum. So I will say it's been fun, but is the ROI worth the time? It's a little bit hard to say, because this has been 2 years now I've been in the middle of this project, and it's a lot of fucking time and stress for much less significant gains than crypto, but it's a lot safer. Crypto, you can lose so much money so quickly if you don't know what you're doing. So real estate is a good place to put your gains from crypto. So for instance, even if, however this bull run turns out that we're in right now, my plan is to go buy another condo in Bangkok, okay? But anyways, I haven't had my coffee yet, so we gotta go to Starbucks and get my morning coffee. Now, we're going to Starbucks right now, which thankfully they have here. And a lot of my Australian friends here think it's like the most obnoxious American thing for me to do because there's so many good coffee places and cafes here in Bali, and I choose to just still go to American Starbucks to get my morning cold brew every day because I'm obsessed with Starbucks cold brew. So I'm in here every day at like 6:30, so I didn't even order. She just knows what I want already.
Yeah, one moment, yeah, sorry.
Okay, thank you.
Thank you.
Have a good day.
You too.
Nothing like the first sip of coffee. Best part of the day. So, the worst part about driving in Bali is that we literally live in the middle of a village. Like, this was not built for cars and vehicles. This was like a small, tiny village with a bunch of locals, and then a bunch of asshole tourists like myself came in, and it just became this huge, like, international smorgasbord, whatever you want to call it, of just foreigners from all over the world. Like, it's one of the most unique places in the sense that there's a lot of locals here, but there's also just people from all over the world just living here. It's like one of the only cities or villages, you could call it, in the world where there's so many people from so many different parts of the world all living in a very condensed little tiny village. But with that, the roads are so small. Like, this, the only time I ever drive this car is sometimes if it's raining, like right now here, because it's rainy season in Bali, which is the worst time to be in Bali. This is the first time I've been here in Bali in December in 4 years, and I'm leaving to Austria next week. So terrible time to come to Bali. Never come to Bali between December and January. It's raining, it's crowded, the streets are fucking small, and it's filled with traffic. So terrible time to come. But this is the only time I ever drive this car. That, and then every Sunday or Saturday go play golf. That's it. But other than that, there's absolutely zero reason to ever have a car in Bali because the roads suck. You're just way better off driving a scooter. All right, guys, welcome to my crib. I literally drew this place in an iPad, and I gave it to an architect, and I was like, hey, I want you to build this. And so this is kind of what came into fruition. So pretty happy with it overall. Definitely some minor things I would change, but overall, not bad. So let's just kind of go over the last month of trading, because it has been my best month by far trading. So we're actually experiencing the first pullback in the markets of this current bull run, but I deposited about nothing in this September, and then I deposited $224,000 on September 30th. Going into the Trump election, basically what my thought process was, okay, if Trump wins, this is gonna be a huge catalyst. The charts are all set up there. I have a whole video explaining the process of how the market cycles work. And the market cycles were in a certain pattern formation. If Trump won, then that was the catalyst to push us out of that pattern, which would then we would see a huge run. So I was like, all right, I'm gonna put about $250,000 on a brand new fresh account just so I can track the stats of this bull run and kind of see how we can do. We can see it right into the election, everything just absolutely ate shit. And I did get stopped down in a few positions, like maybe like a third of the positions I got stopped out on. So you can see it went all the way, my drawdown was actually quite big, down to 84K. So I was a little bit over leveraged, but you can see with that, it went from 84K on November 3rd, all the way up to 1.4 million on December 8th. So in 34 days, we went from 84K to 1.4 million. We're now down to about a mil because we're seeing the first pullback. Like we can see here, one of my positions, my biggest position, I'm up 187,000 on this position right now. So there's a lot of opportunity. We did just see the first initial pump of the markets. And with that, you always have to expect that we are gonna see some pullbacks. I even just said in my Wolfpack group here, just alerting everyone, said, hey guys, we have inverse movement on Bitcoin and Ethereum versus alts. This is not good. I smell potential further downside for altcoins in the near future. So the most important thing you can do, for me, I am like probably the most pessimistic trader you'll ever meet. And what that means is that I play defense more so, way more so than I play offense. Most traders fail because they only play offense. They only think about the fantasy. They only think about, oh man, if it gets to this price, how much money I can make. And they create these crazy price targets, crazy expectations, and crazy dreams that never come into fruition. So with that, they never fucking sell. And they also never acknowledge that what goes up does come down. So for me, I am always defense. Like if you come into my group, I'm rarely gonna be talking about how good things are gonna be in the future, guys. My only focus is, hey guys, here's the worst case scenario. How do we prepare for that? That's how you survive in the market. That's how you thrive in the market, so you can survive to continue to play the game. There's about a 95 to 98% failure rate in trading in general because everyone's so focused on fantasy rather than thinking, okay, we are in a situation, what is the worst case scenario? And if that did play out, how do we set ourselves up to turn that into an opportunity rather than our downfall? And that's basically the secret and key ingredient to becoming a successful trader. And basically how I do that for my students is, one is I give people all these theories and thoughts about what are all the worst case scenarios that could happen in trading. And then I also send out something called the Quantum Cipher Report. Every Monday, I give a breakdown of what I think the outlook is for Bitcoin, what I think the outlook is for others, which is the altcoins outside of the top 10. So that gives you a real good view of what is the health of the altcoin market. So I give an analysis of that. And I also give full setup and trade plans for either trades that were closed. These are the live trades that I have right now. And these are trades that are potentially coming into fruition. So like, for example, Solana. I'm going to give you guys a way ahead in advance saying, hey guys, if price comes into weekly demand, this is where we want to buy. We don't want to buy up here. So rather than sending out like an alert like, hey guys, the train's leaving, you better hop on before it's too late, I tell you when the train is coming to the station so you can buy a ticket and hop on at that point. So that's kind of the main difference. Pro traders wait for the market to come for them. Newbie traders hear about something that's pumping already up 100%. They're like, hey man, is it still a good time to buy? If you're ever asking yourself, is it still a good time to buy? No, it's fucking not. The train has left the station. You are now trying to jump on a moving train. And that's dangerous, and that's where big risk comes into play. So like I said, I'm a pessimistic trader. I only wait for the market to come to me. Sometimes I chase, but it's on a rare occasion, only if the situation is 100% in play. So that's basically what we're looking at right now. Everything's been looking good. My biggest closed trade so far was Lumia. I can show you here. This thing just absolutely pumped, right? We got in down here on this breakout prior to it actually pushing. Sold right here. We can see P&L on Lumia, closed positions, last 180 days. So yeah, 180,000 in at 130, out at 212. That's the biggest closed trade that we have right now. I still have a decent amount of open positions. Then we had another one of which I'll show you. I would have been up about $300,000 instantaneously on Mocha. Like, look at this fucking move from 10 cents to 38 cents in literally an hour or two. And the unfortunate thing is I sold right there. I got stopped out right before it fucking happened. So you win some, you lose some, but the most important thing is that you live to see another day. And most traders don't, because they only think about fantasy. The only thing I think about at all times is what is the worst case scenario and how do I protect myself if that does come into fruition. This is why you don't come to Bali in December. It's just a terrible time to be here. I'm ready to go. See that, baboos? All right, guys. Now it's time for the morning injections. So I've been on TRT for probably the past three to 5 months. I had done it before, but I stopped because my face was getting too puffy, my hair was falling out, and that's not good. I want to keep my hair. 40 years old now, got to keep it. But I've been on a little bit of a different protocol, which seems to be working. And the difference is I've been microdosing TRT. Rather than doing like 2 injections a week, I microdose every day. So every single day I do a TRT injection, and I'm only taking about 105 milligrams per week. And typically the starting dose for just starting is about 125. And when I was doing 125, my test levels got to like 1100, which is out of range. That's super physiological. So when I'm doing about 105, my T levels are like 850, which is like that's like completely within range of a normal young 20-year-old youthful man. So a lot of people think like taking TRT is like you're taking steroids. It's not. All it basically does is put your testosterone levels back to what a early 20s male would be. And so it just makes you feel more youthful, more vibrant. Basically the foundation for me, why I like TRT and what it does for me, it just gives me more energy so I can be more productive, have better workouts. Obviously there is gonna be a little bit more muscle growth, but at the end of the day, you still gotta work your ass off at the gym if you wanna look good and have good muscle growth. But, so basically that's what I do. I do about 6, whatever that is, the number 6 on a half milliliter, 50 unit insulin syringe every day. So I do that, and then I also do HCG, which is kind of for keeping your balls in check, keep your sperm function still going. But there's still risk of you becoming infertile on TRT, which is just part of the risk. So I don't know why I can't open this, but I froze my sperm before I got started. So it was funny, I did it in Bangkok, and you literally walk in, and there's this little Thai, probably like 50-year-old woman. She walks me into a private room because I got to go rub one out to give my sperm samples. And I walk in, and she turns on the TV and puts on Japanese porn. Like she picked the porn and put it on out of a folder file, which is funny. It was just a very unique experience. But this is HCG, and this is just for keeping your balls in check a little bit better. So I don't think you need to take HCG, but I think this also just helps with overall vitality and energy. I would recommend taking TRT. It just helps you be fucking better at life. And then this is also Ozempic, which I've been experimenting with. I'm actually not taking it now. Semaglutide. Basically, my blood glucose is a little bit elevated due to some medication that I take, but it also helps you keep your caloric deficit in play. But I'm not taking it right now. I was just taking it in the US, and I traveled with this to the US, but you have to keep this refrigerated. Then I didn't refrigerate it for like 3 days during the fucking flight there, so I think I ruined it, so I kind of stopped. So right now I'm not taking this. But if you want to keep your caloric deficit in check so you can actually get abs, of which I don't have abs right now because I stopped taking this, but I'll probably start taking this when I come back, because we're going to Austria, then Bangkok. Then I'll come back and start taking this, because this is how you're going to get abs with cheat codes. A lot of people don't want to talk about this stuff because they don't want to tell people they're fucking taking this. I could care fucking less. I'm not trying to put on a show for anybody. If there's a cheat code to have better workouts and feel better and be more productive, I'm gonna fucking take it, because I'm trying to get ahead of everyone else. So I would recommend talking to your local clinic. If you're above 35, talk about getting your test levels taken and getting on some TRT, because I think it helps for sure. Just got my TRT juice injected. Now me and my girlfriend are gonna go get an outdoor workout in. Even though it just rained, we'll go try to get a little workout in outside, so let's go check it out. When I bought this, I knew that there was gonna be a lot of construction because we're gonna get surrounded. So we have this one here that just got built, but now we have the neighbors behind us building this whole fucking thing, which is literally gonna be, here, I'll even grab the camera and show you guys. This is just chaos back here. This is what we listen to every day. Hello. Hello. Good morning. Weather for it, but we'll do a quick ice bath and then hop in the sauna. Oh, don't even think about it. Woo! That is good. After like the first 15 seconds, it's pretty good, pretty easy. It's never fun though. I don't know anybody who says they like this, I think they're lying. It's not easy. But you definitely feel good afterwards. Is my girlfriend gonna join? She's already getting in the sauna. Alright, time for the sauna. Alright guys, I definitely needed it to be a requirement to have a sauna in the villa. So we built one, infrared, but we did it in like a Japanese style. My architect came up with this idea to do this circular door. So pretty nice, infrared.
It's cold. It's cold. Woo! Cold, cold. The leg is red.
Southwest rainy season.
That's what rainy season looks like in Bali. So, bro.
Very wet.
Oh, dude, it's been raining so hard this morning. This is like the worst day to film.
Yeah.
It's just been raining all morning.
Yeah, I was just waiting at the house for the rain to stop, and I was like, okay, cool, let's go. Raincoat, helmet.
But anyways, this is DY. He runs Hydrafunding with me. So we actually met, I think like 5 years ago, and DY started running the ads for my old stock trading website, Iconic Traders. And then we just decided to start a prop firm. So it was actually DY's idea. He's like, dude, there's this thing called FTMO.com. They do funded trading. I was like, what the fuck is funded trading? And then next thing you know, here we are running Hydrafunding for the last 2 years. So it's been a bit of a bumpy ride throughout the whole landscape, but now we're just gonna kind of discuss the latest things that we got going on with Hydra, but we're not gonna do it down here. We're gonna go do it on the golf sim. So let's go check it out. So this is the golf sim, guys. I recently became obsessed with golf.
also DY's idea.
What can I say? I'm here to provide good ideas into your life. So here's the story. I'll tell you guys the story. We were in Thailand for our birthdays. Our birthdays are like a couple days apart. And I was like, you know what, I just started playing a bit again. And I was like, you know what, for Cam's birthday, I'm just gonna take him out for a round of golf in Bangkok. We went further around and pretty much he bought clubs, he bought everything, he bought a golf sim. That's the end of the story. One round, that's all it took. And we're fully in the life.
Yeah, once you get the bug, it's just complete obsession. Too much obsession.
Needs to be able to hit some 300-yard drives.
Yeah.
You know? Right, so I think we have a plan for January.
Yeah.
The idea, I think, is to run lots of competitions.
Okay.
That's gonna be, we're gonna probably do like 2 private ones for
ASFX and
and then Will. I think Will said, I'm asking Will if he thinks we'll be able to get like 200 to 300 traders to turn out, and then we kind of adjust the prize pool based on how many. Because if we have bigger turnout, we can do a little bit bigger prize pool.
Yeah.
And then if it's going to be lower number, we can just do like 3 prizes. And I'm going to do the same with James. We're going to set up a separate contract for like to make sure the ASFX as a community is promoting it for us, so we kind of get additional reach there. But I think that should be a good way to onboard a bunch of new members to start the year. And then we'll also do our own free trading competition that we normally do, but we'll kind of space things out a little bit.
Yeah, it'll be, I think it'll be good. So we've been, we started in 2 years ago when prop firms were just, everyone was starting a prop firm. Everything like revenues and sales and just the entire industry was just skyrocketing to the upside. It was like the gold rush era. Things were going good, and we had like an okay deal with our tech partner, but we saw some other people migrating to another place, and they offered us a much better deal on paper. Unfortunately, it just did not go as planned. So then it basically turned into us pumping, growth was just fucking like exponentially growing, to then us pulling back on everything, basically almost shutting our business down while the market and prop firms were growing. And we just ran into a bunch of headaches, snags, technical issues where we couldn't even focus on growing the business. All we were doing was dealing with problems the whole time. And then so we decided to go back to our previous partners, which then also took more time. So it's just been, it hasn't been an easy journey, to say the least. But during that transition period, that's when the entire prop firm industry almost collapsed. My Fund and Forex, what was the other big one? Or all the big ones that just went under? TFT was another big one, SFT.
Since then, you know, there's been almost like a collapse every other week.
Yeah.
And, you know, we look back and, you know, I think one of the biggest lessons was like, I think we ended up deciding to prioritize the right thing at the right time. Like we sensed kind of where the industry was going, and we're like, we really need to make sure that, you know, we're not headed in the same direction as these other firms that have kind of like participated in this race to the bottom, you know, and yeah, we kind of, I feel like we managed to, looking back, I feel like we managed to make some very good decisions. We made some bad ones, like changing this tech provider when everything was actually great.
It was, I think, a blessing in disguise, to say the least, because there was a lot of FOMO. We saw all the competition dropping their prices way lower than ours, making it much easier for their students to pass versus ours. So while everyone else's product looked like a better product on the surface, what they were doing was setting themselves up for failure. And a lot of people don't understand, or if they might do, or if you don't, basically when you make a sale at a prop firm like ours, part of that percentage goes into us being able to run the business, covering our expenses, salaries, us paying ourselves. But the biggest part of it goes into a capital reserve. So when traders do get payouts, there's actually money to pay people out. what happened with all these other prop firms is they became insolvent because they didn't leave enough money in the capital reserve to be able to make payouts if traders were profitable. And so they ended up upside down in their books, and then too many traders decided that they were too profitable and they wanted payouts, and the firm couldn't pay them out because they had no money left because they all went out and bought Lambos or did whatever bullshit they did. I honestly don't know how they did it. It's a matter of poor risk management and greed of paying themselves too much and not having enough reserves in the books to be able to pay out traders. So we've managed to get through that safely, and our priority was mostly just like, okay, what is the lowest risk model that we can be running to ensure that we have survival and can continue to run this business into the future. Whereas most people there's so many people opening up all these firms offering the lowest prices. So if you're out there and you see firms with really easy to pass trading plans or like 50 to 75% off, that's basically just a money grab that firm's trying to do because they're running out of money to be able to pay out traders. So they're trying to run a massive sale so they can bring in more capital to have in the reserves to pay out traders. So it's a very risky game to be playing if you're not doing this in a very conservative manner. So you have to keep those margins in check. So it'll be interesting to see where the industry goes, but we're still around. We just launched our crypto firm. So we have the forex side, CFD sides, which you can trade some crypto on there, Bitcoin and Ethereum. But we also have the crypto firm, which you can trade 28 different coins on, and it's just strictly crypto. So especially during the bull run right now, it's definitely a big opportunity to take advantage of. We'll see how the year goes. I think 2025, we're gonna make a mark in the industry.
Yeah, agreed. I think, at the end of the day, what this industry is about and what we've learned from being here for 2 years is that this, on the surface, looks like a marketing game, but really, more important than that, it's a risk management game. Because firms that don't know how to risk manage and don't prioritize risk management end up going underwater, as we've seen. A lot of firms have just blown up using marketing tactics, running discounts, making challenges easier, and they've been able to grow their top line, but they never considered the back end, which is at some point traders are going to want to get paid out. And if your books are not managed properly, if you're not managing your risk properly, then your firm's going to go underwater. And at the end of the day, the goal, I think, for us here, and we've aligned on this pretty much since the beginning, and especially through that really tough period with, prop firms collapsing and all that, all these industry problems, is we prioritize being solvent, being able to pay traders out. And I think, that ended up being one of the best decisions that we've made, even though at the time it looked like we weren't able to compete at all on the product side, and we were like, we can't match that offer, we can't sell it that cheap and make it that easy. So we were losing out a lot on sales, but they say hindsight is 20/20, and now we're still around, and most of these other guys that were doing this, they're not here. So
Still around and growing, so that's all we can really ask for. However, as fast or slow that growth is, as long as we're growing and as long as we pay out our traders, I think that's just the most important thing. Because that's what everybody wants to know. That's the whole elephant in the room of prop firms is, can this firm pay me out? And
I was just at BGS. I just met this guy. So BGS is a cafe I go to. I just met this guy like a couple days ago, and then we sat down, and today he was like, "Oh, do you work? I saw your Instagram. Do you work with Cameron?" And he was like, "Oh, I've been following Cameron for like the last 14 years since he was trading stocks." And then he also knows about Hydra. He's like, "Yeah, I was kind of hesitant about, I wanted to buy a challenge, but then there were all these problems in the prop industry, and I just wasn't sure." And he was straight up like, "So, but now I'm gonna buy a challenge because I know you, and if you don't pay me out, I'm gonna see you here."
That's funny. Yeah, that's what everybody wants to know. So we've never missed a payout, and I don't see why we would. We're not set up in a position where we can't. So yeah, it's an interesting game, but it's a beautiful product if the company is run well, and if a trader can find profitability. There's no better way to learn, because you're not risking all your capital up front on a broker, which most brokers are safe, but some are not. But if the prop firm can be trusted, then
It's an amazing product because you learn proper risk management. You're basically forced into using risk management, or you blow up the account very quick, and you also get access to a lot of capital, whereas most people have, 75% of traders have accounts under $25,000, and if you're working with under $25,000 on a normal traditional account, it's very difficult to do a whole lot with that without risking a huge amount of money. So that's why the prop firm industry has been blowing up, because if the firm is trustworthy and they can pay out, it's a great product for traders to learn how to leverage and actually make some profitable trades on a bigger account without having to over risk. Smash.
Two different levels, I cannot relate. You never win if you playing it safe. It's all a game until you get paid. You speaking so loud.
1.5.
Oh my God.
Friends in this business, that's why I keep my family close. Put in work and secure the bag and then take it back to my foes. Time will only tell. You can try me if you want. Like it get real crazy. You can try me if you want. We gon' find out soon. We gon' find out soon.
Sounds good. Oh, there it is. Look at this. Draw.
Yeah,
Been
working on the draw, baby. Right down the middle.
Solid.
Let's go. Now, if I could hit that on a real course.
Casio is the owner of this restaurant on Sunday, and I'm an investor, so I own about 20%. So it's funny, me and Tangmo used to always go to your other restaurant, The Loft, yeah. And then you guys closed that during COVID, and we're like, dude, what's going on? That's our favorite spot. And you're like, well, I'm opening another spot. And then so you're like, we're looking for investors, so that's how we kind of got connected. We already knew each other for a couple of years before that, but now I'm part of it. So.
Now we're business partners.
Yeah.
As well. It's beautiful.
Yeah, the food here is fucking amazing. It's actually fully packed in here right now.
Yeah. For lunch, it just got so much good traction.
Yeah.
The food is just, that feedback of being so homey and like well prepared.
Yeah.
So people come here to have their lunch. They feel well fed by us.
Yeah.
It's good.
No, the food's amazing. So you guys have done a great job.
Super happy, man.
Yeah, for sure, bro. Cool. Should we order something?
Yeah, man. You guys want to start with some coffee? Do you want to?
Yeah, I'll do a. What's the specialty stuff we got going on right now?
We brought over 2 beans from Brazil. One of them we're doing espresso, the other one V60, specialty coffee from southeast part of Brazil. We have a Sumatra or a southeast Brazilian bean. Both of them single origin for pour over. The Brazilian one is pretty good, so maybe I'll get one of that. And actually, no, I think I might do the espresso for Brazil and the Sumatra for pour over. Get us different flavors.
Yeah, let's do it.
So the way that we decided to work here in Sunday, we decided to source the green beans, import them here, and then collaborate with our friend from Ubud, Nadia, from Soleil Roaster, to do the profile for us. So we work together with her, create the profile, and then we're gonna get a second grinder to start doing that offering as espresso as well.
Yeah.
So you would have the possibility to have a more chocolate body or fruity. So this would be more fruity, would be more on the fruity side. So,
I like the chocolatey.
Yeah, higher palate, chocolate.
Yeah.
You
like your coffee?
I love
this one is smell more fruity, right?
Yeah, smell it. It smells pretty.
Oh yeah.
I can't start my day without coffee.
You guys want anything else?
No, I'm good, man.
Good?
I'm good, bro.
Gravy, bro. Full of caffeine and food. Settled.
Yeah. Nice. Thank you. Thank you for coming over, man.
Always, brother.
Always good.
All right.
Pleasure.
Always.
Later, Rick.
Yeah.
All right, guys. Just got done with lunch at my restaurant. About a year and a half ago, I invested in an upcoming gym called Omni Wellness Club. So I think we're about 3 months out from finishing, but this is gonna be the biggest luxury wellness gym in Bali. So super pumped to be a part of it. And this is the first time I've seen it in probably like 6 months. So we're pretty close to be finished. We're gonna go meet one of the co-founders, Henry, and he's gonna give us a little tour. So let's go check it out. How you doing? What's going on, brother? Good? Long time no see, huh?
Yeah, you are?
Yeah, good.
Thank you, otherwise I'd pour coffee on your back. Hey, how are you?
Yeah.
Good, how are you?
Yeah, not too bad, thank you. Not too bad at all. Welcome. When was the last time you were here?
Shit, man, I think a long time ago. I haven't actually, like, I think me and her came, like...
Try to sneak up.
Sneak in? Yeah. But that was like when it was just kind of like a shell.
Yeah.
So there really wasn't
Okay,
anything,
so you've really not seen much at all.
No.
Well, also, that I haven't been here in a few days, so much is changing day by day.
Yeah.
Including all of the gym equipment's just got thrown into this room.
Yeah.
So we've now got like matrix equipment absolutely everywhere.
Yeah.
Yeah, let's just pop back outside a second. We're building this whole like textured brown across the whole thing. And then you're gonna have a massive Omni logo here, and then this is all gonna be like greenery in a garden. Not many places have actually just put a lot of effort into what it looks like just to come into, right? The presentation from the front, so I think that's gonna be really nice. This is where you'll come in.
Yeah.
So this whole area is parking. And the whole theme of the building is really like these curved like architectural walls. So you've got all this curve here throughout the entire building. It just follows these curve and oval shapes.
Yeah.
And this is going to be a 360 waterfall entrance.
Yeah.
So you've got water coming down all around here in this oval, and then even just behind here it drops down. And the idea and the thinking really is that it's like a way you like to escape Chengdu. You suddenly feel like, okay, right, Zen water sound.
Yeah.
You're out of that messy world and you're into this whole new serene wellness space.
Little sanctuary.
Exactly. And it goes like it's a big curve oval, so you can see it goes all the way around there. And then it's a shame the scaffolding's here, but it's this whole oval shape in here. This is the reception. So we've got this massive rock desk here, and then a big Omni logo behind. So basically, when you enter, you've got two options as to what you want to do.
Yeah.
You can either go left into the co-working space, or you can go right into the main facility.
Okay. Well, I want to ask you, just for the audience watching right now, what is like the vision of Omni, and how are we standing out from everyone else here?
Yeah, sure. So I think it was born out of a frustration that everything in the wellness space is super like disconnected, right? If you want to go and get your blood tested, you go and find a doctor in Denpasar or something.
$1,600 from Protea to get my blood test done.
To go and get it done, you've got to go travel, then you're like getting the analysis from them, or sometimes even doing it yourself. You want to see a therapist, you've got to go on like the internet, do a load of research, go on Zoom with someone random.
Yeah.
If you want to go to the gym, it's one thing. If you want to learn how to meditate, you're finding like a Buddhist center or a retreat somewhere. Everything's just like super disconnected. So the concept here was, can we take everything that's scientifically proven to help physical and mental health and bring it all into one facility and make it personalized as well. So when you join, you do a whole variety of blood tests, like gut testing. You'll do a questionnaire, you'll have a mobility evaluation, you'll see a therapist, you'll do all these different inputs and consultations, and then based off your weakest areas and the things you want to improve, we'll give you a personalized health plan to help you achieve it all. This is the main co-working space. So you've got this area here is a quiet concentration zone. So that's going to be no talking. We're going to have like large curved monitors. We've got standing desks. It seats about 100 people across the entire room.
And those are all this monitors and everything you can just unplug your laptop into and
Plug up your laptop into, you're good to go. You've got your own private station in many of the desks. Some of them are motorized standing desks. Just around here, there's another layer of glass, and then on this side of it is a louder area where you can eat, you can meet with colleagues, you can take calls, and then we've got these 6 private call booths that are going to be soundproof. We're going to have like professional ring lights so you can take calls and it looks good on Zoom.
Yeah.
You've got a meeting room as well, so if you want to do a session with the team, have the TV up on the side, that's there as well.
Yeah.
So then if you come in on the left here, this is our wellness lab. So this is kind of where all the techie stuff happens.
Yeah.
So we've got our 3D like high-tech body scan machine here. We've got our 2, if you come on in, we've got this, it's all going to be curved up everywhere, and then this is got a drop down light. So this is going to feel like one sort of infinity based massage room, which will be really cool. And then shout out to Connor for his favourite place in the whole thing. Not that it looks very impressive on camera. Back here is our lab. So here, this is where we've got all the equipment to actually test everything in-house.
Okay.
So that enables...
So all the blood work, all the analysis.
Exactly. And by doing it in-house and having some of the most advanced machines, we're actually able to test more biomarkers at a better rate, so we can give customers more information without charging them like through the nose. This is all a massive lawn. So we're going to have a fire pit here. We're actually building a water feature coming out of the plants. And yeah, the idea is really to create, sometimes some of the lawns can feel a bit cramped and like, everyone's like lined up like sardines on the beanbags. So we wanted to create a really like expansive space.
To have your space.
To have your space, exactly. Yeah. And it's cool that as when you enter, you kind of walk down, that's all to your right. This is a space for heavy weights, so we know that sometimes if you were doing like big deadlifts and stuff on the upper floor, that can shake the building.
Yeah.
So what we've done is we've moved all of the heavy racks, deadlifts, everything down here into a dedicated legs and heavy weights room on the floor. Nice. This is the indoor cafe area. So we've got a bar here. This is going to be a towel drop so that you don't have to keep walking between here and reception to get a new towel or whatever. And then this is the kind of like indoor covered area. So you're going to have all of the tables and hangout space here. And then if you move out here, this is going to be like this sort of semi-open air outdoor space of the cafe as well. So we're going to have this like coconut jute material above here, so it creates shade, but you still feel like you're outside in a kind of like garden cafe. Yeah. And then this takes us out onto the pool. So all massive 25-meter lap pool, which we're going to run lap sessions on in the morning. And then you've got wooden decking all along here with sunbeds. And what I really like is we've built these sunbeds mattresses into the pool. So on here is going to be double mattresses with the stairs, and the water flows right up along the side of them.
Okay, yeah.
But we've got a 4-degree ice bath here. We've got a 10 to 15 degree ice
That'll
bath
be mine
here.
one there. 4 degrees way too cold.
Oh man, I love this one. And then we've got a jacuzzi on the far left. So
okay, so this is on.
yeah.
Yeah. Big.
Yeah. So 3-sided chairs, and then that overlooks the entire lawn, and as I said, that glass is like a curved glass, which will be really cool.
Yeah.
This is the steam room, which we've started to tile already, which is cool.
Oh wow, yeah.
It's all black, and then we're going to just put the black routing in. We've got lots of these little small downlights that look like stars. So the whole idea is to create like a night sky in the steam room with the steam everywhere.
That'll be really cool.
So big.
We've got a full-scale massive kitchen back here. So the idea again is really to take the F&B to a whole new level. So we're going to be listing macros across everything, whether that's an a la carte dish or whether that's you're building your own bowl. You're going to know exactly what's in your food, so you can really dial in your nutrition.
Yeah.
And yeah, we're going to have smoothies, shakes, the whole works. And we've got an amazing head chef in from the Marriott who's been working on a concept with a consultant who specialises in healthy food. So nice. I think we're going to really nail it.
Crush it, yeah.
This is the outdoor calisthenics area. So this is for like body weight training. We're going to have a load of rigs, we've got a sled track. It's for all the people like Connor who like, are you an outdoor guy? You're an outdoor or indoor guy?
Because I was just asking, is this a separate area from classes for people to just come use freely, or is this going to be classes?
We're going to have classes in here as well, but we've kind of dedicated an area where it will be free from the classes. So if you want to come in and train while the class is on, you'll have your own
because I think that's
space.
one of the biggest issues at all gyms right now.
Is
that you can't even use it because it's always classes.
Well, we've tried to counter that by creating like a side of the section where you can use it at the classes. Like we've got 2 rows of walls of racks basically, so one will be used for classes and the other side will be available for people to use.
There should be enough. That'll be nice.
This space I'm in love with because I've got to be honest, I didn't realize how tall these ceilings were until I came in here the first time, and we were like, whoa. It's amazing. It feels like so much more airy and open than other places. So yeah, this is the main AC gym. And we've got our brand blue on the ceiling now, and that's going to match a lot of the equipment that we've got branded as well with that blue. So yeah, we've got huge big windows on this side, and this is where a lot of the cardio and treadmill machines are going to be, so that when you're having a run on a bike, you're overlooking the beautiful lawn and nature. You can see your mates hanging out down by the pool. Coming up from the stairs here, you're now into the class space. So this is for kind of more mellow classes. We've got a really nice wooden floor, so you're going to do yoga here, there'll be meditation, there'll be Pilates classes, and we've built actually a water feature here. So there's little fountains all the way along here with running water, so you kind of...
This will be open air space?
This is all open,
Again, and I guess you got ocean views here too.
Yeah, you can see the ocean back there. Tarpaulin is killing us today. But then again, you can overlook the whole garden space and the ocean on the other side. And yeah, the running water to really kind of create that tranquil vibe while you're in the space. And then what we've done as well is we've built a dividing door here that can open and close. Like it's a wooden door that has panels and can slide back and forth. So we can either have this as one really big class space for like popular yoga sessions, or if we want to divide it up so we can offer more classes, we can close it off and have different spaces. So then out here we're building another plant pergola, so this will be covered with nature and there'll be a place to hang out. So just after you finish having a yoga class, you want to just sit and have a coconut for a second and overlook the ocean, or
you got both. You got the mountain views over here, I guess.
Is
that Batur, or is that a gun?
It's a clear day for once in Asia, so you can see the mountains over on that side and the ocean on the other side. So yeah, and sunset's really nice of it on here as well, but again, tarpaulin isn't helping us out. So what's cool as well is you can see we actually own, beyond the sauna and spa area, right up to that grey building over there, we own all of that space. So again, this allows us real flexibility to see what's popular and what we want to expand in future. I think the main plan is probably to build a boutique hotel so that we can really have people come here, do retreats, get all their blood tests, come and do ice baths in the morning, and just have like a full-on omni immersive experience, which is going to be cool.
That'd be awesome. Alright guys, just got finished looking at the gym I invested in. Now I just bought 16 Ara here, which is 1,600 square meters. So that's about 3 times the size of the land where my villa is now. So this is going to be my next home that we're going to build. So we'll just go walk over here and take a look. So as you can see, you really can't escape construction anywhere. Even my place right now is 360 surrounded by construction, and obviously when I bought this land, none of this construction was going on, and now clearly they're building all around it. So it's crazy to see how much Bali is growing. So if you're looking for peace and quiet, you're not going to find it, because it's just a continuation of more and more people coming here, more and more expansion. They're building a whole entire other airport on the other side of the island, brand new highway across the island. So the amount of growth here is insane. So you can't escape this construction noise, unfortunately. But what we have here is basically the base of my land. It goes all the way down to the edge line over here. You can see that white line, and that's a river right there, so we don't have any neighbors on that side. And then we go all the way up here. These guys actually built their little huts on the access road, and my land goes all the way there. So that'll actually be the access. I'll have like maybe some sort of like roundabout parking garage there. The villa will be actually up here, and then this whole area down here will be a huge yard. All our pool, sauna, we'll have a gym down there, guest bedrooms. And my plan is actually to build like a par 2 golf course here, where the green will be down there with the hole next to the pool, and then starting from back here, it'll be probably like a 40-yard par 2. So it'll be cool to have, like, you'll walk in from that area, and then you'll have like your little tee-off box, maybe some nice little grass. I'll probably do like little square hitting mats, like 40 yards, 30 yards, 20 yards, so I'm not digging into the fucking grass. So you'll be able to practice hitting from all different areas of inside the range of 40 yards. So that'll look cool, because the first thing you'll see when you walk in is, one, the grand entrance to the villa, and then you'll look to the left and you'll see like a par 2 golf course going down into the vast area of the yard. So I'm super excited to get started on this project. I haven't found the architect I'm going to work with yet. It's a complicated process, and unfortunately this is still like 2 years away of me ever moving in, and who knows where life takes me in 2 years. Maybe I don't even build it. I don't know. Who knows? That's way too long for me to think ahead. But yeah, I'm super excited. It's a great piece of land. This is out here in Timbuk Bayou. It's a little bit away from all the chaos of Baralo where I live now. So yeah, I mean, this whole area is gonna be all villas right now. Right now it was so peaceful. Everywhere I go, I have another piece of land in Chimagi right now that's for sale for about $500,000 US. And when I bought it, it was just like beautiful ocean views, 100 meters back from the water, peaceful rice fields, and now it's just absolute chaos of construction all around it. So that's for sale. I don't want it anymore. So hopefully that sells soon. I have a potential interested buyer, because that also helps fund this project here. All right, guys. So that's a wrap for looking at some of my investments, and now I believe I have a phone call with Jasper, my podcast producer, to give me some latest updates on the current framework for which guests are going live next and who we got coming up. So let's go have a call. I have a meeting with my podcast producer now, who's over in the UK. We actually just did a full USA tour. We interviewed Nor Trades, Q Banks, Lamba Raul, Colin Yerskin, and our next one coming up is Raja Banks. So we got to discuss of what's going on in the next plans for the podcast. So also, there'll be a link below. If you're not subscribed to the Profile Podcast, you should definitely subscribe to that channel as well, because we got a lot of really cool guests coming. So let's see what the latest is with Jasper in our Zoom meeting here. Yo, what's going on, brother?
I'm good, man. I'm missing Miami.
Yeah.
I'm not enjoying this fucking shit weather back in the UK. Made up for Greece.
Yeah, you should have seen it today actually here in Bali. It was just absolutely dumping. We were supposed to do like a workout upstairs, and we just did the workout in the rain because it's just dumping out.
Yeah, I saw your story. What on earth?
Yeah, no, we're ready to get out of here. We're actually leaving to Austria. So what's the latest status update, bro?
Yeah, so the promo window for Colin is now complete. We're getting everything ready for Raja. We're really nice and ahead with everything. So we've got, we have Nor, we have Q. So basically all of the US guests sort of lined up for the next couple of weeks. I think that takes us over nicely until February. And I think we were talking about a potential trip to Dubai.
Yeah.
As we have a few people on our radar there. Things are looking good. The analytics are looking good. The channel's growing nice and strong. The conversions are great. I think we're currently up. We're closing on 700 subscribers for the month. So everything's very much moving.
Cool. Yeah. I was thinking maybe like, so I guess I get back from Bangkok in February, March. My girlfriend's birthday is April, beginning of April, 3rd.
No.
Yes. 2nd. Second?
Second.
Third.
Come on.
One day off. So probably after that. So yeah, probably late April, early March, we could do something in Dubai, which would be cool.
Yeah, no, we have a good buffer. We've got some really solid guests. Again, the channel's growing some really we're seeing some really good numbers with the channel at the moment. The show is growing as a podcast, but my main ambition was to make it work for the overall brand. And I think we've managed to do that really nicely in such a short time, given that you only created this YouTube page like 2 months ago. So yeah, everything's good. Subscribe to the profile.
Yeah, let's do it, bro. Cool, man.
Perfect, man.
All right, guys. Meeting is adjourned. And now, 6:30, it's dinner time. So my girlfriend is gonna cook us some, what?
Bibimbap.
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 Korean food. It's delicious.
Yeah. So, we're cooking? We are cooking.
Oh, you're cooking, I'm watching.
You're watching?
Mm-hmm. That's the support team. I'm the cheerleader, bro.
You have a seat.
Sing?
Yeah. Have a sharing.
So, you see this photo right here. January 3rd, 2020, Bangkok. This is one of those photos you post on Instagram on your story, but clearly there's 2 glasses of wine there, but you don't reveal who the other person is.
Soft launch.
Soft launch. Because we met New Year's Eve in Bangkok 2019. And then this is our 2nd or 3rd date, because that was our first date, was on New Year's Eve. And so I soft launched her with that wine glass right there in 2020. And now it's 2024, almost 2025. It's been a long time. 5 years ago. But then COVID happened. So then I left to Bangkok, or I left from Bangkok back to Bali. I was gonna move to LA, but I didn't have a place to stay in LA, so I was like, maybe let's go to Bali and look for places to stay in LA, in Bali. And then within like 30 days, all of a sudden COVID started and just got stuck in Bali. And then I thought maybe we will see each other again. I was like, oh yeah, that girl was really nice. That was fun. Maybe she'll come to Bali. But then COVID happened, so I was like, oh, well, I'm not gonna see this girl. But we kept in touch for 1.5 years. And then the world opened again, and then I said, hey, do you want to come to Bali for a few weeks?
Yeah. So, oh, just come here, you know, for 3 weeks, and you know, like everything is super normal here. There's no lockdown, so I was locked up in Bangkok that time, and it's like, oh, this place is gonna be so nice, you know. And the first day I land, there's like a big news, like I don't know, they say like it's gonna be a lockdown. So
pretty much the first time they did any sort of lockdown in Bali, after I had been here living the good life with no lockdowns in Bali, as soon as she gets here, once they first kind of opened up again, then they basically like closed everything down. And then they were basically saying everything's gonna be closed and you can't really leave the house. I was like, great, she just got here and now we're gonna be locked in my condo for fucking 3 weeks. Like, it's not the best vacation. But then things went pretty well, and then you never left. And now it's 3.5 years later.
Moved in on the day 1.
Yeah.
Yeah.
First date went well, apparently. Well,
he actually showed me like, oh, this is gonna be the last flight. You wanna leave, you know? Like, I just got here because if I have to go back, then I will have to do quarantine. So like.
No, well, there was a deadline for if you wanted to leave without getting the vaccine, you had to leave before a certain date.
Yeah, that's right.
And so it's like you either get vaxxed and stay longer, or you don't get vaxxed. If you didn't want to get vaxxed, and you have to leave now. So that was the
crazy time.
That was the hectic moment. But now it's been 3.5 years. She's still here.
Still here. He said 3 weeks. So.
Yeah, things are great. Yeah. Going to Austria on Saturday. There's no better market to be involved in when it's a bull market, but once it's into a bear market and just a choppy sideways market, it's just like, it's pretty chaotic and it's very easy to get whipsawed around. Whereas Forex, I find, is just very similar all year round, right? If you look like at a 20-year Forex chart, it can be flatlined basically with a bunch of sideways movements in between. Whereas Forex, or crypto, it goes up on these massive bull runs and then crashes 80-90% every time. So you don't want to be part of the 80-90% crash in crypto. You want to exit out at some point when things are still going up. Problem is, most people never accept when the bear market is there, and they end up giving all their money back. So that's just the way the cookie crumbles. Exit out of the crypto space when you have a nice bag, okay? If your account doubles from here, maybe 2x's, 3x's from here, exit. Get out, lock in your gains, realize the gains. Because if you don't sell, it's never yours. And every single bull market that we've seen in crypto, the aftermath is a 70 to 90% drop. So if you feel like giving back 70 to 90% of your money, then you hold on. But if you want to lock in some gains and actually put it into something useful, like me building this home, and now I live in it, I can actually see it, feel it, experience it, I think that's much better use of your money. So that's the plan.
Take note.
Take notes, guys.
Listen to the pro and take note, and don't do stupid things. Cause yes, take
Even
note.
though sometimes I'm the guy that does a stupid thing.
Yes, trust me, it's not fun. It's not fun for me too.
And I get stressed out. Life is difficult sometimes as a trader. This is the way the cookie crumbles. How do you say very good in Indonesian? Bagus banget?
Bagus banget.
Bagus banget ya.
Bagus. Enak banget.
Yeah, that's for the food.
Enak. It's been delicious.
Enak banget.
Enak banget kan.
I love it. It was delicious.
It's okay.
The best bibimbap.
It's okay, you can be honest.
No, it's actually really good. But that was so much food.
It's
Look how
a
big
big
this
bowl.
fucking bowl is.
It's a massive bowl.
Bulking season. But anyways, guys, thanks for tuning in today. We're actually getting ready to go to Austria for Christmas and New Year's. Gonna go ski. So we gotta get packed, and I'll see you guys on the top of the mountain. Peace.
See ya.
Alright guys, we are coming to a closure of this vlog. I really hope you enjoyed it. We're off to Kitzbühel, Austria for Christmas. We're gonna go snowboarding and skiing. It's gonna be Tango's first time ever seeing the snow. So really looking forward to it. Let me know what you guys thought of this vlog, and I'll see you on top of the mountain. Alright guys, we are bringing this officially to the close from the top of Kitzbühel, Austria. As you can see, this vlog hasn't been a whole lot about actually trading, because typically how I trade now is once you learn the skill, it's mostly just monitoring as opposed to sitting on a computer all day, day trading and trying to figure out if you're going to make money today. The way I trade and the way I teach is learn the skill set. When you find the good opportunity, you patiently wait for that trading opportunity. You enter it, you already have your preset plan, you set your stop, you set your TP, and then you walk away and you get off the computer and go do something like this, which is we're out here spending Christmas in Kitzbühel. Got my buddy Sven here, who's also trying to learn the trading game as well. A bit stressful sometimes, huh? Yeah, stick in there. Yeah, but that's just part of the game. I wouldn't trade it for anything else. I've been doing it for 20 years. But if you want to learn from me, guys, definitely join the Wolf Pack. There'll be a link for that below. It's 30 hours of educational content teaching you my full crypto trading system. I also have the Quantum Cipher Report, where I give you all my best trade ideas for crypto and forex every Monday. I also have the Quantum Cipher course coming out in 2025, which will be a full spectrum multi-asset trader course, because when the bull run's done, we want to exit out of crypto
and start trading more safer assets, because in the bear market, that's where everyone loses it. And we don't want to lose it. We want to keep it, go put it into assets like real estate and shift into non-cyclical assets like forex. But anyways, thanks for tuning into the vlog today, guys. Hope you enjoyed it, and I will see you in the next one. Merry Christmas. See you guys next year.